Activity falling to its lowest level in more than 2 years in this private survey, so keep an eye on the likes of Glencore. And finally, Prosus, their chief investment officer, stepping down, so we keep an eye on those shares in Amsterdam as we head towards the open, Anna.
OK, so some individual sectors and companies to watch out for. Yeah, really interesting what's going on with the mining sector. Over in the Chinese session, in the Asian session, we saw actually Hong Kong and Chinese markets going higher on expectations of stimulus. That doesn't necessarily translate, though, into higher commodity prices. So let's have a look at what the European Open has for us this morning. Waiting to see a little bit of positivity on the board this morning, although it could be short-lived given what we know that the US futures are suggesting. So FTSE 100 futures up by 0.1% out of the gates first this morning. Not a huge amount of news flow then, Lizzie, that we're dealing with in terms of European corporates. Stock 600 up by 0.1%. Yesterday's dynamic was pretty interesting. A number of stories over the weekend throwing markets around a little bit. We saw weakness coming through in steel. We saw strength coming through in defence. We saw energy stocks going higher as a result of higher oil prices. But those themes, we've left some of those behind, and some of them continue to move into these markets, I suppose, defence being one of those. So broadly higher across these European markets seems to be the way to summarise it this morning, Lizzie. What do you see deeper down?
Yeah, let's look at the sectoral picture then. So we've got about 3/4 of sectors in positive territory this morning across Europe, but at the bottom of the basket we have basic resources. So they're down 0.6%, and this is what we expected, isn't it? Because we've seen the base metals falling after that China manufacturing data. A private survey, I should say, it's the Caixin data, but at its lowest level in more than 2 years, and that hitting the likes of Anglo, their shares down 0.9%. Glencore, though, taking a beating, down 1.8%. Rio down 1.8%. Anto about the same as well. You talked about defence. If we turn to that sector, so Kleinmetall is up about as much as Tradegate was suggesting, so 1.2%. Also gains for Leonardo, BAE Systems, Safran, Airbus, all in the green, but Saab a little weaker this morning. What else should we be watching this morning, Anna?
Yeah, I'm actually just going to linger further on one thing you've already talked about, Lizzie, which is basic resources, because that is a real underperformance from that sector. Rio Tinto, Glencore, you can see coming through there on the Stocks Europe 50 performers as some of the worst performers, both of those down by more than 2%. And the sector as a whole is down by 1.3%, and is one of there are only two sectors in negative territory, and that's quite a big movement to the downside. So as is often the case, that is the most direct read across from Chinese markets into what we see here in Europe, and we see a bit of weakness then coming through in basic resources. Financial services, the best performing sector, a fairly mixed bag of other performers this morning.
Yeah, Prosus was another one that I had said to mind, because the CIO, Irvin Tu, is stepping down. The Amsterdam tech investor, of course, but really not that much market reaction, only down 0.2% at the open. And the broader tech sector really in the middle of the basket, up 0.1%. But let's get more analysis now. We can bring in Georges Debas, who is head of European equity derivative strategy over at BNP Paribas Markets 360. Lovely to have you with us round the table. I wonder if it's fair to say that the reason that not much is happening in this market this morning is because we're all a bit fatigued by all the tariff news.
Yes, I think it's a fair assumption, and it's also a function of where we currently are trading. So if we take a bit of a step back, the market has rallied back quite a lot. We are even pre-liberation days, even though there's more uncertainty and there's a bit more fatigue. So right now, I think investors and the market are taking a bit of a step back and say, okay, let's wait until we either have a bit more clarity around the trade negotiation or more clarity around fundamentals, because right now people are expecting either a weakness coming from earnings and also from growth, or a bit more of a stagflationary and inflationary. So we need to see where the data will take us. But in fairness, fatigue is very much part of the narrative also.
So we're waiting for the hard data, but we're also waiting for all these all-important deadlines, the 90-day deadlines, of course.
Correct.
How much upside is there left for European equities when we get some certainty?
Yes. So, listen, I'm also a bit of a student of the market. And if you look at the technicals, we're only 2% from the all-time highs in Europe. In order for us to reach that, it doesn't require quite a lot, because if you look under the hood, positioning is still light. So even though the market is back to almost the highs, the positioning and investors' allocation are still a bit more underweight than they were back in March, let's say. So on that metric on its own, you could have a continuous grind higher. But in order for us to breach new highs and create a new trend, we need to have this fundamental momentum. And in Europe, we have quite a positive and constructive narrative, basically with the fiscal stimulus coming. But we don't expect that to drip until H2 of this year. So it's going to take a bit of time. And right now, most, at least us and investors, are questioning what's going to happen this quarter.
Yeah.
And our corporate are going to wait, or going to invest, or are they going to restore the confidence as quickly as the market has seemed to have?
Yeah, you say we're not far in European stocks. We're not far from all-time highs.
Correct.
Should we, and you talk about the grind higher, maybe to those levels, should we not expect to go much higher than that? Should we expect George to go much higher than that, given what Europe is doing, what Germany in particular is doing in terms of fiscal spending, and everything we're hearing from the United States, things that are causing investors to pause when thinking about further exposure to the US? How much further has Europe to go, I suppose?
Well, I think there is what you call the tactical versus the strategic. On a strategic view, on the medium to long term, I think there's still more room to go. And if you look at where valuation are compared to history, we're currently trading at 50 percentile. So on that metric, we still have a bit more room to grow. And especially if we converge towards the divergence between the US and Europe, it's still quite a long way. However, tactically, on the short term, like I said, because positioning is relatively light, you could have a grind higher. But what we've seen over the past month is earning downgrades, because a lot of the positive constructive narrative in Europe is going to feed in later, whereas the tariff implication are a bit more short term. And that's what you're trying to mitigate, the short-term technicals versus the strategic, a bit more medium to long-term.
Okay, and I wonder where you think we go on the America First trade. I received an invitation yesterday. It was not from BNP Paribas, from someone else, which was called From America First to Global Financial Anarchy. I mean, maybe that's a stretch.
Ah, yes.
But
it's a nice one. I've never heard that before, but yeah.
But I wonder where you think, and maybe that's too binary, but I wonder where you think we land on investors' preference for America, speaking as people who are based in Europe and witnessing what we're seeing in the big, beautiful bill with this Section 899.
Yes. I think the Bill 899 or Section 899 is just another one of the many reasons why people or investors are rethinking their allocations globally. And if you've had a good decade or more where U.S. assets in general outperformed the rest of the world, which meant that investors, including Europeans, have over-allocated to the US. Now there's a bit of loss of confidence in the Trump administration, and there's also a bit more loss of confidence around the uncertainty that's stemming from all of these policies, which means that people are reallocating to other parts of the world, which have self-help story, like Europe, for instance, which is a very good candidate right now. So on that metric, if you look again of all the inflows that the US have had compared to the rest of the world, there's still quite a long room for that trade to go.
Well, you mentioned the data. We're waiting for cracks in the hard data to impact US equities. What do those cracks need to be to stop this rebound? We've got the jobs data on Friday.
Correct, the job data. I think right now, it would be surprising if we have a very big crack. What we've seen today and yesterday are first signs of a slowdown in activity or uncertainty. But what we've learned from 2022, the surveys and the economy are not really working as they used to be. And so we just really need to see what the earnings is going to give us, which is in July as of now. And right now there's this wait and see what corporates are deciding to do. Look, if you're a CFO or a CEO of a large company and you have to steer the boat over the next 3 to 4 years, what matters is not the level of the tariff or what's coming in the bill. It's a certainty around what are your constraints that you need to work with over the next 3 to 4 years. And right now, there's no certainty around that. So that breeds a bit of loss of
and do the conversation, and when you're talking to clients about derivative strategy and about hedging, is it all about hedging for uncertainty? What is it about, George?
No, a lot less. It used to be pre-Liberation Day. Now, actually, we've restarted a bit of this conversation, but like I told you, many investors have already reduced a bit of their exposure, which means that the hedging is a bit less needed. But given that also volatility has receded a lot with the sentiment narrative a bit lower, what we're seeing and what we're telling investors is now is a good time to potentially hedge ahead of your summer and into potentially the end of next year. Or if you still have quite a large exposure to equity, use the lower volatility to do some what we call stock replacement. So it's a better way of allowing to have a beta exposure without actually a lot of downside.
Can I just flag what's been happening in the defence market since we've been talking? Actually, Rheinmetall, Saab and Leonardo have all turned into the red, which I think is interesting given, of course, we've got to factor in the Ukraine talks yesterday.
Yes.
But we did have the UK Strategic Defence Review giving a boost to UK defence stocks just yesterday. Do you think that was a bit of an overreaction? Because the Prime Minister's not committing hard to the 3% spending on defence. Correct.
It's all a question of also positioning and what's embedded in the price. If you look at the defense sector in Europe, it's up 25% as a sector over the 1 month, which is a very large number. So a lot of positivity is already baked into the numbers. We have been the structural buyers of the team, and we still think it's a very secular long. But ahead of the NATO summit or into this month, I think the risk reward is if you have been long and you have had a hefty profit into these trades, maybe reducing a bit and waiting for, again, the trend to reaccelerate, just because expectations and valuations now are a bit overstretched. The fundamentals are not going to change. Strategically, we are going to spend more on defense over the next decades, however you slice and dice it. How you fund that is less important for equity investors. But again, what's in the price and what's positioning, and right now it's quite a consensus long. So that's where one has to be a bit more worried.
Could be more important for bond markets, though, couldn't it, maybe than for equity investors. So just to finish the conversation then, George, I mean, you're bracing for lower. You think volatility goes lower from here in the second half of the year? Does the second half look less volatile?
I would say the second half of the year is potentially more volatile, but in the next month we could have a bit of less volatility until we get into the summer. The reason why we potentially could have a bit more of a volatile is because we expect in H2 of this year, that's when the US stagflationary environment starts breathing in. So the slower growth, higher inflation, and also if you look at Trump 1.0, if you look at the sentiments around tariff in general, they go through waves. And we had a peak of uncertainty. Now we're back in the low. Yeah. Most probably, if you use just that playbook, by H2 you will have a bit more volatility, again receding.
And in that stagflation environment, what's your assumption about the Fed's reaction function?
That's quite a difficult one. I think the Fed right now will have, I think as a BNP view in general, the Fed will have a lot more difficulties acting as long as the labor market is quite resilient. So as long as the labor market is resilient, their first mandate will be on inflation, and they will actually make sure that that's quite impact. If then it comes in balance, what we've learned from them, they're very data-driven, and they will take actions depending on that.
Okay, George, thank you very much. Thanks for joining us. George Abbas, Head of European Equity Derivative Strategy at BNP Paribas Markets 360. Guy's not here, but his core six are still here. Let's have a look at what they are doing this morning, shall we? This is the picture, fairly mixed, actually, across some of these heavyweights in Europe. The biggest move we see on the screen there, Schneider Electric, which in fact features twice. In fact, a couple of them feature twice. Anyway, that's going higher, which is nice. Let's get the individual stocks on the move this morning. Joe Easton has a briefing. Joe.
So we are seeing some pretty significant moves lower in the mining stocks this morning, given that data that we saw out of China. Remember, it did show that the manufacturing gauge was in contraction, below 50, below the key number in the latest reading. So Glencore coming down 1.9%, Rio as well, similar amount, Anto, all of those slipping with the copper and also iron ore prices declining on that data. So clearly a bit of a feed through into that one today. Then UBS, actually the best performer on the Stock 600 this morning after that rating change that we flagged earlier today. So that one up 3.6%. Now remember, UBS has this big update on Friday around the capital, how much capital they need to have on their books, given the takeover of Credit Suisse a couple of years ago. And UBS is a buy at Jefferies, given they think potentially concerns around that event are overdone. So it's a nice move on that one. Pretty happy that that one moved higher after we had it in stocks to watch earlier. Then one stock not looking very happy at all is MJ Gleeson, down 26%. Pretty rough for that stock today. Remember, that is kind of more of a smaller cap home builder in the UK, warning that the housing market not recovering as much as they had hoped. This is more affordable housing in the north of England, in the Midlands as well. That one getting hit pretty hard. We did have some data showing yesterday around mortgage approvals not coming up as quick. Potentially that is playing into that as well, but more of a specific thing maybe for MJ Gleeson. Then staying in real estate, we have got a bit of M&A, not much M&A going on at the moment, but we have got Confinimo. I've probably got that one wrong on the pronunciation, but it does look like that one is around 3% higher. We've got Takeover. It's in the medical real estate sector, I'm told. So Confinimo getting a takeover bid. We did actually know this was going on. It was just a pricing that we've got on that, hence why the move in the stock not actually that big for that one, but Confinimo rising nonetheless today. And then finally finishing on the broker moves, ASMI, don't get confused with ASML, excuse me. Couldn't get those, get my ASMs right this morning, but that one up 1.7%. Barclays switching preferences. They like ASMI more than ASML because ASML has seen a drop down in orders. They prefer that one, and that one is gaining 1.8% in Amsterdam this morning.
All right, Joe Easton from our equities team, we thank you with your movers. 14 minutes into the session, the stock 600 only up 0.1%, but it's green across the screen for European equities so far. We've been talking a lot on the programme about trade policy, the market reaction. We're going to dig into how it impacts businesses next. European regulators and retailers bracing for the impact of Trump's trade war with China. That's next. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
From our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
there's no question in the short term with what we've seen coming out of Washington and the challenges of the trade negotiations, it's choppy.
We think we've got about a $500 million residual cost challenge as a result of those tariffs.
Since tariffs were announced on the 2nd of April and until the state of execution on April the 9th, we have seen some softening.
Things are steady, as we've been saying publicly for quite a while now, and we're reassured that our premium demand is holding.
Some of these events that we're seeing at the moment are short-term in nature, and therefore, they're not going to have a long-term impact.
They've got to just take stock and take a medium to long-term view as to what their costs are going to do, and then have a conversation with us as to what that may be.
Aviation industry executive speaking to Guy Johnson at the International Air Transport Association's meeting, the IATA meeting, taking place in New Delhi. Quite mixed movement on airline stocks this morning. They were talking there a lot about the availability of aircraft, the supply chains, that sort of thing, and other dynamics. But the trade conversation, though, Lizzie, no doubt very close to the minds of those airline executives. And with one eye on cargo, possibly wondering how many of those small packages are going to keep coming from China into Europe.
You lead me nicely to the issues that are happening for Temu and Shein at the moment. The Trump administration's trade war with China has really many European regulators and retailers scratching their heads, holding their heads in their hands and bracing for a flood of ultra-cheap Chinese goods. But this tide of products from e-commerce platforms like Shein and Temu may not yet be coming. For now, let's bring in Bloomberg's Sonia Vind, who's been writing all about this. Sonia, we've had Temu and Shein spending heavily in Europe, but are those efforts paying off yet?
Well, based on our reporting, we're seeing there's a real tension between what the platforms want and what the Chinese sellers on the platforms are doing. So Temu and Shein, they have pulled back on advertising spendment in the US and poured it into Europe. They are also offering to subsidize shipping costs into Europe. But that doesn't seem to be enough to convince these Chinese merchants. One merchant we talked to described entering Europe as entering hell mode. What he means by that is that Europe is very complex. It's a fragmented market with varying rules and regulations, multiple languages. So it's not as easy as the US market where things are more uniform. And initially, sellers did take a look at going into Europe, but they quickly realized it's not that simple. And with the US tariff reprieve, they were quick to prioritize the US market again and milk that market as long as they can.
Okay, so Sonia, if the aim is to keep cheaper products out of Europe, and that might or might not be the aim, then it seems that the lack of common regulation and the lack of a real on-the-ground single market might be playing in that direction. How is Europe then preparing for a possible surge in cheap imports from China? Because I hear what you're saying about maybe it's harder to send those parcels into Europe than into the United States, but some in Europe must be concerned about what impact that might have.
Yes, definitely. And Europe is trying to get ahead of that because it's true Chinese sellers might be hesitant to push into Europe, but we've also seen a massive rise over the past years of low-value parcels coming into Europe. And the European Union and the UK needs to do something about that because many of these products are actually not compliant with the regulations and the rules. And it's also a pain for the local retailers who are complaining that it's unfair that they have to spend money and invest into complying with the rules, whereas many of the products that are coming in do not. An example are, for example, toys that exceed the legally allowed threshold for chemicals or laser pointers that are so strong that they could cause blindness. So European regulators, they have been ramping up the custom checks. They are investigating Temu and Shein over the sale of illegal products, and they are also considering to scrap the de minimis rule, something that the US has recently done. So there are various measures they are implementing, and it's yet to be seen how that will play out. But it's clear that at some point when the Chinese sellers might have to come into Europe because the trade tensions worsen again and it's just not profitable anymore to simply rely on that alone, then it's clear that the environment they'll be walking into here in Europe will be more tightly regulated.
Okay, Sonia, thank you very much. Bloomberg, Sonia Vind with that interesting story around retail, global retail, Chinese retail, those small products and their way into Europe. Let's talk European politics then, Lizzie. We've had some headlines coming through.
Yeah, the far-right Dutch leader pulling out of the government, triggering its collapse. This, of course, is Geert Wilders. He'd threatened to quit if a majority of his party's proposals on migration were not adopted, and indeed he has. They had been struggling with these migration plans, failing to reach consensus. We'd spoken to Oliver Crook earlier about part of these plans, for example, being returning Syrians to Syria. They'd faced lots of legal headaches, concerns that the laws could put too much pressure on the legal system. And the talks were set to continue today, but here we have Wilders actually quitting because of the lack of progress. So you aren't seeing that much of a reaction when it comes to Dutch bonds, but we have seen the AEX dropping. It's now down 0.3%, straight off the back of this news. A real plunge in the Amsterdam index.
Yes, not hugely out of step with what we're seeing elsewhere on European markets, but yes, we do see some evidence of that response there. Let us pivot our attention to the global economy, though. The OECD has slashed its global economic forecast due to Donald Trump's trade policies, citing the impact of tariffs and uncertainty on confidence and investment. Bloomberg's Valerie Teitel joins us around the table. And Valerie, I take away from this chart, ably supplied by our colleague Dan Curtis, that the OECD has cut its growth expectations, its growth estimate, but it's still quite high. It's still an outlier.
It's still above at least the Bloomberg survey of economists' expectations. We have great tickers on the terminal for this that I watch very keenly, but the consensus estimate for 2025 U.S. growth at the moment is around 1.3. So what the OECD came out with recently is they're calling for 1.6. So it's still slightly above a consensus estimate. But look, it just goes to show that there has been, at least in the last, at the beginning of this year, there has been a very steep downgrade of what economists had penciled in for growth this year. You know, at the height of the excitement and euphoria around Trump's return to office, we were penciling in 2.2 percentage points of U.S. GDP. That's really been slashed, not in half, but taken a percentage point off that due to the trade war that was unleashed and all the uncertainty that was unleashed around the new administrations and the way that they're going about the tariff policy. But at least for me, and at least I think what the market cares about, is beginning to see upgrades to U.S. growth. Now that we have this tax bill, more certainty around the tax bill, more spending to come, fiscal spending to come that will keep the U.S. economy strong, and a lot of this uncertainty and kind of the worst fears about the trade war have kind of been put to bed. So I'm more interested to see if anyone is upgrading their U.S. GDP forecast.
Well, yeah,
on the
just
back of that.
Feed that into the Treasury story then, Val, because as you've said earlier, that you saw the 30-year poking, I love that word, above 5%, but it's pretty calm in the Treasury market today.
Yeah, it is calm in the Treasury market today. Across really fixed income is really taking a big breather today, and that's nice to see. But maybe if we connect how the long end is trading, connecting that to global growth, better global growth means there is a higher term premium that should be baked into longer term yields. So I mean, you can read the rise in longer term yields in maybe a more positive spin, is that it's just pricing in maybe the effect of all this fiscal spending keeping U.S. growth okay.
Okay, Valerie, thank you very much. Bloomberg's Valerie Teitel with another take on the bond markets and what we've seen there. And the latest from the OECD and their growth expectations. Coming up on the programme is European leveraged finance set to benefit from U.S. uncertainty. We get Deutsche Bank's view. That's coming up next. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Welcome back. This is the opening trade. 30 minutes into today's session. And I was just about to say that we were making gains. I will say we were making gains at the very start of the trading day, but that didn't last long, did it? We're down by 0.3% on the stock 600. The FTSE 100 holding its head up a little better. And in fact, the FTSE mid, so the periphery getting worse hit, down by 0.7% right now. So that optimism, such as it was at the start of trade, did not last long. US futures have continued to worsen just a little bit as the market tries to pass the latest lines on trade policy, and the likelihood of any meeting, any conversation between Presidents Trump and Xi, that continues to be one of the big questions for markets. Let's pivot to leveraged finance, though. Bankers are waiting for clarity from private equity firms, corporate borrowers, and the Trump administration to move forward with deals. That's a read from the Goldman Sachs Leveraged Finance Conference in California. Goldman's global head of credit finance, Christina Minnis, lent her perspective. Let's have a listen.
The cost of capital is higher, which puts a bit of a governor on the amount of debt. So the quantum of debt's a little bit lower. It's about a turn lower than it used to be. And so I think companies just have to be much more nimble and very thoughtful about how they manage their businesses, whether it's their CapEx plans or working capital. And yes, probably not taking that last quarter half turn of leverage and thinking through putting a little bit more equity in.
Sticking with this theme, Deutsche Bank is set to hold its annual European Leveraged Finance Conference here in London, bringing together more than 1,000 investors and issuers. Deutsche Bank's co-head of capital markets for EMEA, Hobie Bouvat, joins us now. Hobie, nice to speak to you. Thanks so much for coming to talk to us. So you're about to host this event, and clearly before then you can't know what the conclusions will be, but what kind of mood do you think participants will arrive at this event in? Within leveraged finance markets, capital markets broadly, what is the mood right now?
Look, I think the mood is generally positive in Europe, I would say, as far as capital markets are concerned. What we have seen so far is recovery from global markets, obviously, after the heightened volatility we've seen, post-tariffs announcement early April. And we've seen a recovery across asset classes. I think we've seen also rotation away from U.S. equities into the bond market, also into the leverage markets, also into European assets. So, we are hosting about 100 companies today. A lot of them are global companies, European-based.
Yeah.
And I would say that from a access to capital markets perspective, their sentiment is positive on the basis of what we're seeing, in markets.
Okay, so expecting that positive sentiment to arrive with participants then at this event. But what about a lack of M&A and a lack of deal flow? Because that's sometimes the thing that drives companies to want to raise more money or can get bidders into the leveraged finance market. So what's the link there? Break down the link between that part of capital markets and where that leaves your side.
Yes, I mean, absolutely. When we look at European leverage markets or global leverage markets, one of the greatest use of proceeds is acquisition finance, so LBO financing. What we've seen over the past 3 years, you're right, is that the proportion of acquisition finance into use of proceeds of financings has gone down tremendously. So it used to be around 60-70% acquisition finance driven, and now it's gone down to 30-20% even year to date.
So a decade low, I think you're saying.
So a decade low, absolutely. Why is that? The lack of deal making comes back to also the size of the LBO transactions and P activity in acquisition finance for leverage markets as well, and that has gone down materially, even though announced M&A volumes have gone up actually over the past couple of months. And there is a significant shift actually in terms of the LBO environment when you think about it. As Christina Minnis said, we have a higher interest rate and base rate, so cost of debt has gone up. That has had an impact on the amount of leverage that a company can take. You've also had a discontinued trend in terms of the multiple expansion that we've seen, in asset prices since 2021, 2020, after the post-COVID environment. That has also changed, quite materially, also based on where the base rates are, have been, and their impact on asset prices generally. And then the third thing is we've also entered an era of lower growth prospects. And so we've gone out of the sort of inflation-driven growth that we've seen post-COVID. And of course, we've always, tariff headlines. There is definitely, a change in sentiment in terms of growth prospects across the world and in Europe.
So with that backdrop, what are kind of the underappreciated risks, shall we say, when it comes to European leverage finance? I mean, are there sectors in particular that you think present signs of stress at the moment?
Yes, this is a good point, because actually, as far as the markets have recovered, there is definitely pricing dispersion. And there is definitely sectors that have recovered better than others. So the more defensive sectors have recovered generally well. The more cyclical sectors, heavy industrials, autos sectors, and auto parts as well by extension, have underperformed, generally when you look at cash prices for, listed assets. So what we are hearing from investors, and this is one of the reasons we're having this conference today, we have about 800 investors as well, is really to listen to, that they have cash, the technicals are quite strong in the market, but we'd like to understand what are the sectors that they would like to buy and at what price. I think at the moment, there's still quite a lot of uncertainty around the impact of tariffs into earnings. And we haven't really seen that playing through in Q1. We think it's going to play through more in Q2 and probably more H2 of this year.
And where do you think you're going to see the greatest default risk mounting?
I mean, it's generally going to be around the sectors that will have the most impact from a raw material prices perspective, the ones that will have the most cost increase from a supply chain perspective. And then there will be some impact as well on consumer confidence. I think we've started seeing that, even if consumer spending has held up okay globally. I mean, there is definitely a change in consumer confidence and perception of discretionary spending. So the sectors that are the most impacted will be around, those ones.
And Hobie, you were talking about opportunities in Europe, and maybe that's been quite a theme of the last few months as investors have increasingly been looking at Europe, maybe less so at the United States because of a host of factors, not least of which policy-driven. But I wonder, we just got a reminder of the possibility of volatility in European politics this morning. The Dutch government has collapsed, migration talks failed, and as a result, the far-right lawmaker has left the coalition. How do investors think about political risk in Europe? We saw this in France, didn't we? And in some markets, that political risk really sticks, and in others, it doesn't seem to matter.
Yes, I mean, I think political risk is perceived by investors as just one of the risks, obviously, that are out there. There is a strong perception now in Europe of political will for more European autonomy. In terms of, we've seen on the defense side, on the infrastructure side, on the energy side. So as far as Europe's concerned, investors are buying into the political willingness, around countries and also at the European level. But you're right, the execution of this political will is really the key. And there are a lot of different things that have to happen, and a lot of the decisions will be made at country level, hence the importance of stability at country levels as well. But going back to, the French episode, for example, yes, we've gone for a time of heightened, premium for French risk. But overall, I wouldn't say that we've had a sustained, perceived weakness of France, and definitely not a desire from investors to not participate in sovereign issuances and also company issuances from that country.
Okay, so really interesting, keeping the political uncertainty in mind. I just want to end, Hobie, with a comment that you made the last time that you were on Bloomberg, and you said that investment banks are going to need to work with private credit more to satisfy all of the needs of the new economy, the capital expenditure. How do you see that dynamic playing out, and is it happening at the pace that you expected?
Right. I think it is happening, and we're all part of a financial system and an ecosystem where everyone is playing a part. Definitely, there's been a lot of cash inflows, funds inflows into private credit, and those players have to deploy, this money that they've raised. And then, similarly on the bank side, if I take our example on the defense side, for example, we do see a big role to play, in particular in bringing some of the small and medium-sized enterprises into financing, their capex and their investment in order to supply the bigger OEMs, for example. So to answer your question, I would say, we will probably always want to move faster. The great thing is that, the needs are there. And that's also the feedback we're getting from companies that they would really like to have, a broader pool of capital markets in Europe, so public capital markets, supportive banks, as well as access to this, really increasing pool of private credit funds.
Okay, Hobie Bovat, who is co-head of capital markets for EMEA over at Deutsche Bank. It's lovely to have you with us around the table before your conference today. We wish you luck with that.
Yes, and we were just ending our conversation there with Hobie talking about private markets. So a nice opportunity to remind everybody that Kriti Gupta will be at the Super Return Private Equity event, which takes place in Berlin. We will be featuring a host of great conversations during Wednesday and Thursday's programming here on Opening Trade.
Coming up on the programme, Russia and Ukraine failed to reach agreement to end the war, but they do lay the groundwork for a new prisoner exchange. We'll bring you the details next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome back to the opening trade, 8:45 here in London, so 45 minutes into our European session, which is showing some weakness. US futures haven't deteriorated much in the last 10 minutes or so, but they are weaker than they were at the start of this program an hour and 45 minutes ago. So we're down by 0.5% on E-minis right now. Now, some of the political risk we're monitoring here in Europe is in focus. The Dutch coalition has collapsed after it failed to reach an agreement over far-right lawmaker Geert Wilders' Freedom Party's plan to curb migration. Oliver Crook joins us now to talk about the latest. So, Oliver, we have these headlines telling us that he's left the coalition. The coalition has collapsed then. So what's the latest detail?
So once again, the perennial issue in Dutch politics is this issue of migration. It's what triggered an election not too long ago that ousted Mark Rutte and then put the Freedom Party by Geert Wilders party into government after many, many, many months of coalition building. And this is a government that has stood now for less than 1 year, 11 months, before it's collapsed to be brought down again once more by this issue of immigration. What precipitated this was last week, Geert Wilders put forward a 10-point plan on immigration. These points included using the military basically to guard the land borders of the Netherlands, turning away all asylum seekers, temporarily halting family reunification, also sending Syrians back to Syria, which he considers now a safe place for refugees and other migrants to be sent back. He said that if the majority of these 10 points are not agreed to by the government, yesterday he threatened to pull out of the government, and today, just a few minutes ago on X, we have him saying no signature for our asylum plans, no changes to the main outline agreement. PVV, the Freedom Party, leaves the coalition, and that is how we got the news this morning of the collapse now of the Dutch government. The next steps will be likely another election that will have to be called in the Netherlands. That was supposed to happen sort of by the term limit in 2027. That, of course, has now been accelerated with the fall of the government.
So, Ollie, what are the implications then for the rest of Europe and the Netherlands' position in Europe after this?
Yeah, so very interestingly, I mean, listen, we just had an election in Poland in which you had basically this liberalizing force of Prime Minister Donald Tusk elected 2 years ago, trying to get his agenda through. It had basically been blocked by the former president and will continue to be blocked by the next president. And when you think about this from the sort of European and the perspective in Brussels, who is currently waging trade warfare with the United States, trying to show a sort of sign of solidarity, political stability, pro-EU, that is definitely not the sort of context that we get over the last 24 hours. In Poland, you basically have Donald Tusk, the pro-European, hamstrung in terms of getting his agenda through. In the Netherlands, which is going to host, by the way, in just 3 weeks' time in The Hague, a big NATO meeting that will be attended by Donald Trump, where all of these NATO countries are basically seemingly auditioning for continued participation of the United States. You want to project strength, you want to project stability, and that is not something you're going to be able to do, particularly when your host country's government just collapsed with many of the same themes that you've seen in the political disagreement in the United States and many of the sort of MAGA themes running in Dutch politics, in Polish politics, and of course politics in Germany, France, and elsewhere.
Okay, Bloomberg's Oliver Crook, we thank you for the latest out of the Netherlands, the collapse of the Dutch government. And let's turn now to the geopolitics and dive more deeply into what that means for the rest of Europe. Because, of course, we already had Russia and Ukraine laying the groundwork for a new prisoner exchange yesterday. And that's after a second round of direct talks in Istanbul failed to bring the two sides together closer to ending the war. Now, these talks come as Prime Minister Keir Starmer's new defence policy aims to show the UK's commitment to being a key power in Europe and NATO, but the funding for those plans remains unclear. So there's a lot to thread together here, and I'm pleased to say joining us now is Rachel Elhouse, who is Director General of the Royal United Services Institute, RUSI, and she was also previously the US Secretary of Defence's representative in Europe and Defence Advisor for the US mission in NATO, and she contributed to the UK's 2010 Strategic Defence and Security Review, so she really is a true expert. Rachel, it's great to have you with us on the programme this morning. Thinking back to that strike by Ukraine on Russia, the many strikes over the weekend, I just want to start there and ask to what extent they weakened Russia militarily or shifted its negotiating hand as we went into the talks in Istanbul yesterday. Is that perhaps why there wasn't a success? Oh, we're just struggling to hear Rachel here, but we will get back to her as soon as we can. Anna, it's a really fascinating moment for defence, of course, as we tie all of these threads together. I had wondered whether, the fact that Russia didn't want to agree to peace at this point was perhaps because Ukraine had been so strong into these talks, and maybe it wanted to wait for a moment when Ukraine was weaker. Let's try and get back to Rachel Elhouse, the RUSI Director General now. Rachel, can you hear me?
Yes, I can.
Perfect. What's your answer to that question? Is this strike perhaps a reason why we didn't get closer to peace yesterday in Istanbul?
The strike is a really great example of how Ukraine has performed throughout this conflict. They've always contained an element of surprise. They've always innovated. They cannot outmatch Russia en masse, but certainly when it comes to innovation and creativity, they have used those things to their advantage to gain the upper hand. So I wouldn't link that with the failure or success of the talks, because in my view, the problem with the talks is from the outset, they haven't included all parties, and they haven't held Russia to account for its role in this war.
Do you think that's something that the US administration is going to do, Rachel? Good morning.
Good morning. I believe they're slowly coming to the realization that any sort of sustainable ceasefire or agreement must take account Ukraine's views, the views of Europeans who are alongside the conflict. But it's been a long time going, and Ukraine has to continue to assert its agency in this fight and its demands, as do European countries, in order to be heard.
Well, we had, of course, the Strategic Defence Review out of the UK yesterday. A lot of money being spent on heavy weaponry. But when you think about what happened in Russia by Ukraine over the weekend with these $200 drones taking out heavy weaponry, does that suggest that maybe the money is being misallocated, or just the vulnerability of these big, expensive assets in modern warfare?
It's important that the review has a balance of both mass in terms of people and capabilities, but also a focus on innovation. Again, if we take the example of Ukraine, they've really shown how you take those more conventional capabilities and forces and you pair them with unmanned systems, satellite communications, the element of surprise. So I took the defense review as a move in the right direction because it does have a clear focus on transformation.
Yeah, move in the right direction, Rachel, but is there enough money behind it? 3% has become the new target, and others talking about whether it should actually be 3.5% as we move towards that NATO meeting later on this month. How important is that kind of detail? How do you project strength when these conversations are all about 0.5% of GDP?
You're correct that the NATO ambition, as we anticipated for the Hague summit, is 5%, with 3.5%, excuse me, of that going towards core defense spending. And so even 3% by 2034, as the review anticipates, will fall short of that. That having been said, I think we do need to look at the quality of the spending. We need to make sure that every year there is a real term increase in spending. So while it's probably not as much near-term cash and uplift as many had anticipated, it is a step, again, in the right direction. And if that money and that increase in spending can be paired with a sustainable plan that makes cuts where needed and strategic investments to get that innovation edge, then I think we can be relatively optimistic.
What about the investment in nuclear deterrence, Rachel? Because we've reported that the UK is planning to take an enhanced role in NATO on that front. Do you see that capability being necessary in the near term? And if so, under what circumstances?
Certainly, given Putin's careless use of messaging his intent to use nuclear weapons, in particular tactical nuclear weapons, I think the UK, the US, and France having a safe, capable, modernized, responsibly managed nuclear deterrent is absolutely important. It is a very expensive capability, and it does take up a lot of the defense budget, so controlling those costs while getting the maximum effect in terms of messaging towards the Russians is going to be very important. And working together with the United States and France to use that messaging together to send that signal.
Yes, Rachel, if I could broaden the conversation, picking up there on what you said about working with the United States, given the extent of your experience on both sides of the Atlantic, how do you assess the US reaction to any attack on a NATO ally right now? How much has it really changed since years gone by? I was reminded recently that European leaders have often had doubts about whether the US would really respond, from Adenauer to de Gaulle. What's your assessment of the US response?
I think we are seeing an evolution in the U.S. thinking. A number of U.S. Leaders in the current administration have signaled a desire to lead from behind when it comes to Europe. That's due both to a sense that we've got more pressing problems in the United States that have to be addressed, as well as a desire to be more active in the Indo-Pacific. That having been said, I think Europeans have shown that they're willing to step up and spend more in defense and take on more responsibility within their own theater. I was really pleased to see a NATO-first approach in the Strategic Defense Review, because the UK is a very important partner in making sure that security and defense in Europe is really solid and taken care of, in particular if the United States does step back from that leadership role in the alliance. But for the time being, the United States nuclear deterrent is still extended under that NATO umbrella. U.S. forces remain in Europe. U.S. leadership continue to talk about the importance of NATO. And even more importantly, the U.S. Congress and public are firmly behind the alliance.
Okay, Rachel, thank you very much. RUSI Director General Rachel Elhoos, we thank you for your time. Quick reminder then, Lizzie, some of the data points we're watching out for today. We get Euro area CPI, which is expected to come down just ahead of that ECB meeting. That's
no more inflation problem for Europe, it would seem.
2% or below,
Yeah, reflect that. And then they can cut on Thursday, and then it's, do they cut again? That's the question.
And then we'll get US durable goods later on today. We get US jobs. We talked a little bit about that coming before the non-farm payrolls data. That is it for the opening trade. The pulse is up next. European stocks just on the back foot a little. US futures pointing 0.5% to the downside this Tuesday morning. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The White House looks to dial down trade concerns, saying Presidents Trump and Xi will talk soon. There's U.S. praise for the EU coming to the table, but Europe warns again about possible retaliation. The OECD slashes its global economic forecast, with the U.S. among the hardest hit as President Trump's trade policy take their tolls. Plus, the Dutch government collapses after the far-right Freedom Party pulls out in a row over migration. In Poland, the Prime Minister, Donald Tusk, looks to shore up support with a vote of confidence after his candidate lost this weekend's presidential election. So there is quite a lot going on, quite a lot of stories that we need to cover, from politics to trade and, of course, everything in between. This is what the market is doing. Look, U.S. stocks actually dipping a little bit to extend days of fluctuations, pretty big fluctuations. Again, traders grappling with a fog of uncertainty surrounding the global trade war, so they look to this and that, but there's no clear picture that's actually emerging. This is 2 months after Donald Trump's sweeping tariff announcements and push for new trade deals. And again, there are very few signs of a breakthrough, certainly when it comes to talks with China or the EU, the biggest U.S. trading partners. The U.S. 10-year yield, 4.4181, euro dollar 114.11, and Brent 65.08. Let's also take a look at the European markets map that usually follows what happened in the U.S. at the close and then in Asia. And we're seeing a little bit, again, of wait-and-see situation. Risk off, not huge, but the CAC 40 down some 0.3%. The FTSE MIB in Italy 0.6% lower. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the White House says President Trump is likely to speak this week with Chinese leader Xi Jinping as the two economies remain locked in trade turmoil.
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls.
We're joined by Rosalind Matheson, our EMEA News Director, and then in a second we'll speak to Janet Henry. So there's a lot going on, of course, as always, Ros, in terms of trade. There doesn't seem to be a massive breakthrough. I mean, it's been 2 months since actually we heard what Donald Trump wanted to do. What's the way forward? Like, what are the main sticking points?
Well, with China, they're complex and they're many. And it's interesting to see the US officials talking repeatedly about the prospect of a phone call this week between Donald Trump and Xi Jinping. It's almost like they're trying to will this call into life, and it's been radio silence from China, I guess unsurprising. But for Xi Jinping, the real question is he's not going to rush to a call unless he has a clear sense of what he's going to get out of it. But it does reflect, as you say, like months on, we've got a bit of a framework deal with China that's wobbling heavily, accusations on either side of breaching understandings, US, criticizing China over rare earths, China bringing everything in the relationship into it in response, including student visas, including AI chips, you name it. So that doesn't seem to be moving anywhere. Meanwhile, very slow-moving, complex negotiations with the EU. Again, a lot of conversations, but not a lot of progress. And, Donald Trump's coming up against a lot of self-imposed deadlines here to get a lot of deals done, or at least framework understandings done. And so far, what has he really got on the table? The UK, which was arguably a fairly easy one to achieve, but a lot of hard stuff still very much on the table.
Ros, I mean, first of all, the overarching, basically, theme of trade, do we have a better understanding how the Trump administration is trying to get through it?
Well, we do and we don't. We can see the negotiating styles that are coming in from the US. We can see how countries in turn are learning how to deal with the US in response, and looking at some of the examples and saying, well, you need to some extent, stand up for yourself against the US. And that response is somewhat respected by the US, even if it makes the conversation more difficult. But again, what is it that fundamentally the US is trying to achieve here? Donald Trump went into the election with a bunch of promises that he made to the American people, and he's trying to show that he's enacting on those promises. And, how he gets there is for him probably less important than trying to get there and show that he's getting there. And meantime, you can see in the US economy, the concerns are coming in about the impact of this whiplash on trade, on sentiment, on jobs, on companies, on behaviour. So he's got a very close eye on that as well. And he's clearly just trying to get some sort of announcement out there in the coming days.
Ros, thank you so much. As always, Ros Matheson there on the politics of the trade war. She is director our EMEA News Desk. Now joining us is Janet Henry, Chief Global Economist at HSBC, to understand the implication that has on inflation, monetary policy, and many other things. Janet, as always, thank you for joining us. I mean, because of the trade uncertainty, how difficult is it to set the right monetary policy right now?
Very, very hard indeed, which is why what we're hearing from central banks, particularly from the Fed, we need to wait and see. And that's why they are going to very much wait on the sidelines. And as Ros was saying, there's so many complexities to a lot of these discussions that President Trump is having, or his administration is having, with various countries. And while we've got this July 9th deadline at which the pause ends, we really don't know whether we'll then get the step up in the reciprocal tariffs thereafter. And clearly markets have taken the view that tariffs are now primarily a negotiating tactic and we're not going to be ratcheted up again. But the recent path has shown we really can't be sure what is going to happen tomorrow. So central banks have to stick to their mandate. And their mandate, in the case of the ECB, is price stability. For the Fed, they have to balance the two. And if inflation is still a little bit above target and the economy is still at full employment, you just wait on the sidelines until one of those tips the balance towards trying to set policy. And for now, it's all about inflation expectations.
Yeah, and that's the messaging clearly from the Fed and numerous Fed governors, right, that they worry about an uptick in inflation in the third and fourth quarter. Is there a danger that some of the things that we were expecting to show up in the data is not showing up? Is that because there's something structurally with the economy, or is it just being delayed?
Well, that's the question I am asked most frequently by investors. They say, when will these awful surveys show up in the hard data? And you know, what we saw in the April surveys was that they absolutely tumbled. Some of them were at COVID type of levels in terms of consumer confidence and business confidence. And then they revived a little bit in May. Now, we haven't even got the May labour market data. We'll get that on Friday. And I think you are going to still have this difference between survey data, which is now stabilised but not back where it was, because maybe people are thinking, well, maybe this isn't really going to happen for sure, and then the uncertainty impact. Yes, you're not seeing mass firings at this stage, but you're certainly seeing a slowdown in hiring. But the Fed also has to consider what's happening to the supply of labour against a backdrop of potentially slower immigration. But certainly on our outlook, we've got the worst point for growth being the fourth quarter and the first quarter. Some of it's the impact of higher inflation weighing on consumer spending and real incomes, and then you get the impact of much weaker hiring and a potential increase in unemployment leads to the sharper weakening of growth.
So are you expecting a cut from the Fed?
Yes, we still have cuts. Well, by the end of 2026, we have a bit less than is priced into the market. We've got 75 basis points of rate cuts, but obviously the market is repriced to some degree because, of course, in 2026, you've got the additional complications of what happens to the budget reconciliation bill and when that takes effect, and, of course, a new Fed chair next year. But based on that view, now that we might get a little bit of fiscal stimulus next year, actually, I think some of the prospects for bigger rate cuts next year are overdone. Actually, you know, I don't think the Fed will be easing through 2026 because the growth may be disappointing, but the inflation numbers will still be quite sticky.
Janet, you mentioned the ECB. I mean, it's the big one. After they cut rates, you know, now on Thursday, which, or in June, actually, which is pretty much priced in, what happens?
What happens? Well, a lot of that depends on what happens in terms of legislation or executive orders generated by the White House. So I think they sit and wait. And absolutely, we're going to get a great inflation number. It could even fall below 2%. So that will be helpful. The ECB has been clear that they are in neutral territory already at 2.25. We get the cut today to take it to on Thursday to get the 2% level. And I think they certainly are on hold in July before you have to take a view at later meetings. Are you seeing further downside risks to growth? Do you need more accommodative policy? But again, in no hurry, because there is going to be higher fiscal spending in Europe and core inflation is still at 2.5%. So they can afford to wait a little bit in the absence of a really disappointing growth outlook.
Because I guess, I mean, interest rates at 1.75 for the ECB, it must mean that the economy would be really in bad shape, right, to get to that level, or is that unfair?
Well, that's a little bit unfair. So I think it's, you know, what they consider to be the neutral range is 1.75 to 2.25. There was a time not so long ago when people were saying, oh, the ECB needs to slash rates to sub 1%. We got so used to rates being at that zero level. But I think 1.75 is still just about in neutral. Do they need to go super accommodative only if they see big downside risks to inflation? Europe's had weak growth for several years, but inflation has not been below target. And on their new projections, which is what the market will really have its eye on Thursday, how low do they go on inflation? Is it 1.7? Is it 1.8? When we look at 2026 and 2027, their mandate is very clear. And their forecast for growth will not have the fiscal impact in it because they won't have had time to process that. And in Europe, you never quite know when the fiscal spending will hit the ground.
But Janet, do you worry about inflation undershooting, basically 2% in the Eurozone for quite some time?
If there is an undershoot in Eurozone inflation, I suspect it will be primarily driven by what happens to energy prices. If core inflation is but obviously the ECB, they forecast headline inflation. But if core inflation is at 2.5%, you would need a severe weakening in demand against a backdrop of what is a complicated supply picture in terms of productivity and labour supply in Europe to lead to big downside surprises and undershooting in the Eurozone.
Janet, what do you worry about the most? So, you know, we haven't talked about China or Japan, many concerns there, but also the UK. Is there something that we're missing given all of the uncertainties?
Well, I think, the market always has to price in all of the available information as soon as it comes through. And I think, everyone's looking at the world knowing that this is unlikely to be good news, what is happening, what is underway globally, even if some of the worst case scenarios are not where they were perhaps on April the 2nd. So I think it has more become about the relative winners and the relative losers, who's less exposed to the US in terms of selling consumer goods or the sectors that are subject to those sector-specific tariffs. So, this is why some people are saying, well, actually, you mentioned Japan. It's still, a very large bond market. Maybe we'll reach a stage where there are opportunities there. Others have pointed to Australia. If only 4% of exports go to the US, obviously they need some domestic growth drivers if China's still going to be somewhat sluggish. So I think it's all about the relative stories in this world.
Okay, yeah. We could talk about this for another 2 hours. You'll have to come back, Janet. Thank you so much. Talking, as always, extremely insightful, talking about the relative values and the relative plays given all these bifurcations. Janet Henry, Global Chief Economist at HSBC. Now, coming up, our interview with Bill Winters, the Chief Executive of Standard Chartered. We talk regulation, we talk tariffs, AI, and of course the company's outlook. That's next, and this is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Well, chip giant TSMC sees profit rising to a record high this year and is maintaining its sales growth outlook. The company also says there's strong demand for chips used in humanoid robots. Now, let's bring in Robert Lee, a senior analyst at Bloomberg Intelligence. Every time I say humanoid robot, I kind of slightly freak out. But what stands out, Robert, from TSM's results?
Okay, there was a lot of talk on different topics. I would say nothing substantially new, and in fact the stock actually traded off in the local session here in Taiwan. Having said that, it had been flirting with its 200-day moving average, so there's a technical line of resistance there, which is failing to break through in the short term. But there are a number of different areas covered. One was on the future locality of their fabs, and as I guess yourself and most of your viewers are aware, TSMC has committed $100 billion over the next 5 years to build out new fabs in Taiwan. The CEO actually shared some personal conversation he'd had with President Trump. President Trump's message was essentially, do your best, because building out $100 billion of fabs in 5 years is a very tight deadline. And the main issue that TSMC faces is finding the appropriately qualified production staff who can run these things. So that was one issue. They recommitted that Taiwan remote will remain central to their CapEx plans going forward. They referred to the local fabs there as their mother fab. In other words, they'll develop and perfect the technology before transferring elsewhere. But AI dominated the conversation. But overall, I think it was a steady as you go sort of message. Some short-term impact maybe from the Taiwan dollar on their earnings. But again, that's well known and well factored given the moves we've seen in currency markets in recent weeks. So, but a reassuring message that steady as she goes, and they remain bullish on the long-term outlook.
So meanwhile, Robert, Elon Musk is selling $5 billion in debt for his artificial intelligence startup. What more do we know?
Okay, well, what we know is that this $5 billion they're looking to raise, if that is confirmed, is likely to be part of an ongoing CapEx rollout plan at their so-called Colossal Fab, which is in Memphis in the US. They've currently got 200 to 300 GPUs installed at that facility. They're looking to add up to 1 million at an adjacent facility. So it's likely the funds raised will be in support of that, which reconfirms that CapEx remains strong. Although I would say, you know, what about the monetization? I think that remains the elephant in the room here and thing that investors need to continue to focus on given the proliferation of free or low-price products in the market.
Robert, thank you so much. As always, Robert Lee there from Bloomberg Intelligence. Now, private credit firms enjoy a significant capital advantage over traditional banks. That's according to the chief executive of Standard Chartered, Bill Winters, who says banks have to deal with higher capital costs, and this won't change anytime soon. In a wide-ranging interview, as he marks a decade at the helm, Winters discussed UK bank regulation, the impact of tariffs, his own future, and the role of AI.
I think that the biggest challenge for an organization like ours is what are the use cases that are existential for us. Right. Because when you talk to, as I did, I spent a week on the West Coast 2 weeks ago of the U.S. And you talk to hundreds of people about their AI strategies, and there are thousands of absolutely, I mean, everybody's got a use case. We're all using ChatGPT or Claude or whatever. And the key is to focus. So what we've really tried to do is say, well, what are the one or two things within each of our key businesses that are existential for us? Because those things we have to build ourselves. We have to be at the cutting edge. For a lot of the rest of the stuff, RFP generators and file reconcilers and PowerPoint editing, we can take somebody else's application, bring it in.
Is that what you see as your ultimate job? Is yes. If you look at trade tariffs, if you look at AI, it's these big shifts in society.
That's right.
And that's what basically is that what gives you a certain buzz today?
It gives me a buzz. Those are also the imperatives. And if there's one thing that finding myself in the position where I've got a great team that runs the business day to day, every single day, and I've got a great chairman who's new, but the old chairman was also great. I'm in that middle zone where I can really think more strategically, and AI is a huge part of that.
How do you think about regulation?
I mean, it's interesting to see how that pendulum swings. So, I was on the UK Independent Commission on Banking back in 2010-11.
Yeah. You were one of the architects, actually.
Well, for better or for worse, right? Out of that came ring fencing, but we made some assumptions at the time about the likelihood that the Basel Committee would continue to be pretty light touch in terms of the way that banks' risk was calculated. And as a result, we put structural recommendations in place, like ring fencing. Now, as it turns out, the Basel Committee has been super rigorous, and some would say too rigorous, but let's just say the Basel 3.1 endgame, for those of your listeners that aren't in banking, they'll know that's intended to be the last stage of bank capital regulation. It's pretty conservative, I would say. So the cost of capital for a bank is significantly higher than the cost of capital for a private credit company. Okay, that's just a reality. I don't think that's going to change anytime soon. The result of which is banks are disadvantaged lenders.
De facto, right.
De facto, and that's okay. And banks also have the opportunity to be very leveraged and take insured deposits.
But is that okay, or would you actually roll back some of the ring fencing?
Well, the ring fence, that's a different question. I know there's a debate now about whether the ring fence entity should be allowed to be bigger or take. more deposits before you have to ring fence. I think those kinds of refinements make perfect sense. But the Bank of England did a review, or Keith Scott, I guess it was the Treasury, Keith Scott did a review 3 years back on the ring fencing. I can't add much. I might talk to him quite a bit during that. Yeah, he said it's fine-tuning, yes. Fundamental rethink, not necessary. I like the fact that UK banks that have ring-fence banks have different views on this. Well, okay.
Is there one regulation that you would get rid of if you're in charge today?
There's not one regulation that I would get rid of. I would say that we've erred on the side of very, very extensive micro-prudential supervision. We've got really huge numbers of individuals in the UK, in the PRA and the FCA, who are focusing on our business. And I think one, they're too intrusive. It's too costly. And two, I don't think you actually get a good return on that, because at some point the board and senior management start to think, well, if it's okay with the regulator, it must be okay, which is a terrible conclusion to reach. Of course, we don't make that consciously. But deep down, I think there's a risk that we get there. So,
but I mean, every day do you wake up to, of course, service your client, but is it to also have a fair share of beating the likes of J.P. Morgan? And actually, what needs to happen?
Thankfully, J.P. Morgan is one of our great partners, but
or someone else.
But I mean, we're an interesting bank because our biggest single customer base, broadly, is banks, other banks, because we're a banker's bank. But of course, we also compete with them in many markets. No, I would like to wake up every morning, most mornings I do, thinking, how do we give a better service to our customers? If we get the customers right, including banks, if we get the customers right, the rest is going to follow.
So Standard Chartered is also known for its prowess in trade finance. How does this change because of the trade wars?
It's fascinating. Every day is a new adventure. If there's, I think we all have our assessment of what's likely to happen here, and a base case, call it the base case. And the base case that the whole market is assuming is there's going to be some increase in tariffs, maybe 8 or 9% from 10% from the U.S., that the rest of the world, that China will be at 30% or something like that, with some gap, which means an ongoing evolution of this China plus one into all the markets that we call home. So, of course, China is already adapting to that. China has been adapting to that for some time. With Chinese manufacturing, Chinese corporations have been moving to Malaysia, Vietnam, Indonesia, increasingly to India, fascinatingly, despite the geopolitical tensions there. So, we have a very important business in China, but most of it is cross-border. So, as Chinese corporations reach out to the rest of the world, and as international corporations are diversifying their own supply chains, they're going into the markets that we call home. So it's actually been feeding a lot of our growth.
Right.
And so I'm not saying that we're complacent about the trade war, because if we get anything like the kind of scenarios that have been mooted from time to time coming out of the U.S., there will be a severe economic implication. Right? And recession, we'll see, but definitely a cost. And that's not good for anybody.
Bill, the next 10 years for Standard Chartered, what does that look like?
Oh, I think it's going to be a glory decade, actually. I really do. And so right now, the core of our strategy is focusing on the affluent population in Asia, Africa, the Middle East, and focusing on global corporations' cross-border needs, but with an anchor in Asia, Middle East, and Africa, but we have a big business in the U.S. and Europe. Both those things feel really good right now. Structural growth in both demographically and in terms of wealth creation in Asia. In particular, global Chinese and Indians, but it's everywhere. And the cross-border needs are getting more and more complex, and we've got a very, very relevant role to play. So obviously, lots could disrupt that period, but if we get it right on our core infrastructure is actually very good. We have single sets of systems to serve those clients. We've got to incorporate everything AI and data related effectively. Jury's out whether we can deliver. I'll make the bet that we can. And then we have to navigate some of these geopolitical tensions. And I don't see the U.S. and China bifurcating. I see constant antagonism and disintegration, but bifurcation is many, many years out, if at all. And in the meantime, there's lots of roles for a player like us, which is global.
Bill Winters there, the chief executive of Standard Chartered, speaking to me a little bit earlier. Now, Microsoft has cut an additional 300 jobs just weeks after its largest layoff in years. where the tech giant slashed 6,000 roles. The cuts underscore the industry's efforts to trim costs, even as it plows billions of dollars into artificial intelligence, while Microsoft and peers, including Meta, have touted the effectiveness of AI-assisted coding tools in speeding up the software development process. Coming up, Polish Prime Minister Donald Tusk calls for a vote of confidence after an electoral defeat over the weekend. We'll have the details next, and this is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The White House looks to dial down trade concerns, saying Presidents Trump and Xi will talk soon. The OECD slashes its global economic forecast as President Trump's trade policy take their toll. Plus, the Dutch government collapses while in Poland, the Prime Minister, Donald Tusk, calls a confidence vote after his candidate lost the presidential election. Now, we'll have plenty more on that story, but Polish Prime Minister Donald Tusk says he will seek a vote of confidence in his government.
Over 20 million Poles elected a new president of the Republic of Poland, showing their strong commitment to democracy and its key principle, free and universal elections. No matter how we judge the winning candidate, we should recognize his victory and congratulate his voters, which I hereby do. I also thank the loser for his determination and fighting for every vote to the end.
Well, Oliver Crook now joins us to talk about the latest. So, Ollie, what is Tusk's motivation for this confidence vote?
This is Donald Tusk's attempt to basically shore up confidence in his government, in his coalition, in his cabinet after his ally in the Polish presidential election lost by less than 1 percentage point in favor of the hard-right candidate from the Law and Justice Party, which is the party that Donald Tusk himself replaced about 2 years ago after 8 years of rule. And this is really a big blow to Donald Tusk's liberalizing agenda, and it really would have made life a lot easier for him if he had the president on the same side. Because of the Polish system, you have a huge amount of veto powers from the presidential side of things, so any legislation that Donald Tusk puts forward that the president doesn't really like, he can very easily veto. There's also powers of appointing the central bank governor that lie with the president. This has been an issue in Poland in the past where there's been claims of politicization ahead of elections, that basically monetary policy is pulling for one side or the other. And then, of course, there is the big question of billions of euros worth of EU funds that were basically re-released to Poland on the idea that there would be more liberalizing, particularly in terms of judicial reform. That is potentially also at risk. So these are all the issues that now Donald Tusk needs to deal with, which he would not have to have dealt with if the vote had been different by 0.9 percentage points. Very, very close race.
Ollie, elsewhere in Europe, the Dutch government collapsed this morning after failing to reach an agreement over migration. What happens next?
This is the perennial issue in Dutch politics. It's what has brought down the government several times in the past. Geert Wilders, the head of the Freedom Party, has threatened to pull down the government. Even earlier this year, back in February, he did not pull the trigger. He did pull the trigger today. This is the biggest party in the Netherlands. This is the far-right party that is anti-immigration, anti-Islam. He put forward a 10-point proposal to deal with immigration, being very frustrated by the pace at which the government had been dealing with it. And some of those points on the proposals were to use the military to guard basically the land borders of the Netherlands, turning away all asylum seekers, temporarily halting family reunifications, sending Syrian refugees back to Syria, which he now deems a safe place for people to be going, closing the borders basically to all asylum seekers. These are some of the issues that he said, if you do not pass at least the majority of this 10-point plan, I'm going to pull the plug on the government. And that is exactly what he did just over an hour ago on X, saying that he's now leaving the government. This now precipitates another election, which will automatically be triggered. And we should say that he right now in his party, the Freedom Party, is polling #1 in the Netherlands, in part probably why he feels bold enough to call this election, though he will lose a number of seats. You know, in the last election, they had 37 seats. They're now polling at about 31. But Geert Wilders feeling empowered to pull the plug on this government and now threatening an election. We should say just 3 weeks before Donald Trump is meant to arrive in the Netherlands for that NATO meeting.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Poland, the Netherlands, and NATO coming up. Now, nearly 1 year into Britain's Labour government, sentiment in the City of London seems to be shifting, with new tax rules seeing an exodus of wealthy non-doms. Meanwhile, asset managers are pushing back on mooted pension reforms, and a much hoped for boost to deals has actually yet to materialize. So here to take stock of all of this and more is one of Britain's most powerful bankers, Tina Lee, Citi's UK Chief Executive. Tina, as always, thank you so much for being with us. Look, there's a lot of things going on. I know we've spoken in the past about the UK. It's almost 12 months since the Labour government have come in place. What kind of impact have their policies had on the City of London?
So they've done a lot. They really do have an ambitious growth agenda, which has followed on really from the prior Conservative government and the actions they took, particularly around the Mansion House Compact and listing rules, for example. But there's still an enormous amount to do. So if you sort of think about some of the reviews that we're about to see, both in terms of the pensions investment review and also the financial services growth and competitiveness strategy, there's still a lot to play for. And the government has been very open in terms of engaging with the industry. At the end of the day, financial services is a key industry for the UK, but not only as a sector in itself, but also as a powerful transmission mechanism for capital and investment to other sectors in the country.
Tina, what's your business like actually here in the UK? I know there's an overlay of uncertainty because of trade, because of volatility in the markets. Chief executives don't really want to spend that much. But are you confident that IPOs will come back to the UK and the City of London?
Absolutely. Look, I mean, there's a couple of things. I think when I think about the UK IPO market, you know, clearly, as we've seen across the piece, there has been a delay in terms of investment decisions, in terms of coming to market. So transactions that we thought or were hopeful that would be executed in 2025 are still absolutely in the pipeline, but are more marked in for 2026. But at the same time, anecdotally, we are hearing from clients that actually there's fewer inquiries about US listings, a desire maybe to stay a little bit closer to home. So that, of course, is a real opportunity for the UK. And I think it's also important to note that, of course, the IPO market isn't the only thing that is here in the City of London. So when we're speaking to clients, whilst there may be delays, for example, in big long-term investment decisions, delaying CapEx, for example, because we know that rewiring supply chains just takes a long time. At the same time, we're seeing a lot of clients that are thinking about how to rebuild their balance sheets, increase liquidity, and of course using Citi's global trade platforms to mitigate any short-term supply chain pressures.
Does a rebound in IPO in 2026 go hand in hand with M&A?
Absolutely. So we have seen a pause in M&A, particularly after Liberation Day. So no surprises there. But at the same time, particularly in terms of sponsor IPOs, we do see a pretty healthy pipeline for 26.
Tina, HSBC recently debuted this new loan that helps U.S. clients cope with the price of tariffs. I mean, is there something that more banks should be doing? Is this something, the disruption in trade, is it here to stay? And have you had any UK clients actually asking for mitigation or services like that?
Certainly not at this point. So when we actually think about the impact on tariffs, and again, what we're hearing from clients is that, more broadly, a permanent 10% tariff rate is something that our clients and their consumers can probably bear. Anything that's sort of 25% and above certainly requires a different type of calculation. But in terms of taking those strategic long-term decisions, actually our clients are saying, look, we need a lot more clarity, a lot more certainty before we actually, pull the trigger.
I mean, I guess, because of the trade and uncertainty, it's not great for IPOs, M&A, but it's great for trading revenue.
Absolutely.
And that continues?
That's right. So we've seen tremendous momentum in Q1. We've seen a lot of market activity. So again, when we think about what our UK clients have been doing, they've been increasingly hedging across asset classes, in particular G10 rates, core currencies, as well as commodities. And we've also seen pension funds and insurance companies just begin to edge away slightly from the US towards other areas, for example, Japan, India, and of course parts of Europe, including the UK.
Have you had, clients question the fact that you are a US bank, or has there been some of the European banks say, look, they're hoping to win business because they're European and, there's maybe more of a heart pulling towards a domestic bank. Have you seen anything like that?
None whatsoever. I mean, Citi is in really, I think, quite a unique position. We've been on the ground and are on the ground in 94 different countries, in some cases for over 100 years. So what that means is that whilst we are a global bank, we are very often the only foreign bank that is on the ground locally. So what that means is that we're in actually quite a unique position to advise clients through this uncertainty.
When it comes to your staff in the UK, is there any unsettled, staff because of the proposed changes to the settled status? And actually, what would be your preferred outcome?
So we have heard nothing on that front at this point. Of course, we have a whole mix of nationalities that are located in the UK. We don't believe it would make a considerable difference. What I would say is that we're continuing to hire and make sort of strategic senior appointments in the UK. We recently hired a new head for EMEA ECM, of course, located out of London. We've appointed a new head for our global asset manager group. Financial sponsors are a key focus for our investment bank, and we've appointed a new head for our wealth business here in the UK. So in terms of senior leadership in the UK, it's never been stronger.
Have the non-dom rules affected either staff or actually clients a lot in the UK?
Very little impact in terms of staff. We know that our people are committed here for the long term, so they don't come for 3-4 years, and we have many nationalities that have been here for decades. What is interesting is, of course, from our wealth business, we continue to monitor whether there are clients deciding to move out of the UK into other jurisdictions. We've seen that selectively, but we still continue to have a considerable number of clients for whom the UK is their home.
Do you think the government is very in tune with some of these changes? Will we see a recalibration when it comes to some of the rules on that?
It's one of the topics that we continue to engage with government about. We're very fortunate in the sense that we see these flows firsthand, but I think it's also important to acknowledge that the government is also in a very tight fiscal position and therefore have very limited options with regard to how to maximise the tax take. So when I think about the UK and I think about the government, really it's less about fiscal policy now and probably more about monetary policy.
You've been in banking for quite some time. What makes you most nervous about now? I know that, a lot of chief executives point to, the fiscal situation and actually a bond auction that could go sour in the U.S. and maybe in fact, also things here in the UK. Others say it's the flow of capital. It's the fact that it's now a new world order where we don't know where globalization goes. What do you concretely worry about?
So we do think a lot about the fragmentation of the global system. We've always been of the view that we are moving into a multipolar world. And actually what has happened since the beginning of the year has only reinforced that point. But for Citi, that just means there's only opportunity. We have clients everywhere. So it's actually just helping them navigate through that uncertainty. But certainly it's something we're continuing to monitor. But at the end of the day, we're a US firm. And when we think about the US, it still has incredible advantages. So whether that be deep capital markets, a very flexible labour market, or of course an incredible entrepreneurial spirit. So the US isn't going anywhere, but certainly the geopolitics is going to be super interesting for the years to come.
Yeah, and we're also seeing a bit of more closeness between the UK and the EU from a governance standpoint, but also the Bank of England last week weighed in saying there should be stronger trade ties.
That's right.
And that makes a difference.
It absolutely does. Certainly, I think the summit that we saw last month between the UK and the EU was a welcome first step in terms of further collaboration in what are really strategic areas such as defence and security. And of course, don't forget the UK-India trade deal. India is one of the fastest growing countries in the world, so that's a big win for the UK. And of course, the trade agreement with the UK and the US. We're very hopeful as well that there will be an agreement around tech. So I think that there are absolute wins that the UK has been able to achieve in the last couple of months.
On the slight changes to the pension funds, I mean, does it make not maybe a material difference, but does it change risk perception? Will that lead to more, retail investors and just a risk appetite for the UK?
We are hopeful that it will. I mean, Citi has long advocated for a consolidation of pension funds. The landscape is highly fragmented in the UK, so the creation of mega funds with assets under management of £25 billion or more certainly is welcomed. We believe that will reduce costs, increase efficiency, but most importantly allow diversification of investment assets into alternative asset classes such as private equity or indeed infrastructure.
Tina, thank you so much, as always, for joining us here on Bloomberg. Tina Lee there, the Citi UK Chief Executive. Now, back to politics, and Russia and Ukraine have laid the groundwork for a new prisoner exchange. That's after a second round of direct talks in Istanbul failed to bring the two sides closer to ending the war. Now, it comes one day after Kyiv staged one of its boldest aerial attacks inside Russia. Greg Sullivan, our Russia government and economy editor, joins us now. Greg, thank you for joining us. So was there any progress towards peace or even a temporary ceasefire after yesterday?
Well, on the face of it, it appears that the two sides are no closer to a ceasefire agreement, despite the second round of talks. The biggest thing to come out of this round of talks was an agreement to prepare a prisoner exchange, especially of the heavily wounded and younger prisoners, those under 25, as well as an exchange of the war dead. In this, it sort of mirrors the first round of talks that happened in Istanbul, where the biggest thing to come out of that was also an agreement on a prisoner exchange and not a ceasefire. That being said, both sides did exchange a memorandum that laid out their points and positions needed to move towards a ceasefire. That was expected from this meeting. Ukraine did say they would take back the Russian two-part memorandum and study it, and did propose another meeting later in the month. Now, it is important to note that this round of talks is happening to the backdrop of intensified fighting. Russia has really upped their missile and drone attacks, the intensity of those strikes on Ukrainian cities, and of course we saw the most audacious Ukrainian operation within Russia striking those strategic bombers. So even as the talks continue, the fighting does not seem to be abating.
Greg, thanks so much. Greg Sullivan there with the very latest on Russia, Ukraine. Now, South Koreans have been at the polls today to elect a new president. It comes after an attempt to impose martial law at the end of last year triggered its worst constitutional crisis in decades. Sherry Ann has the latest from Seoul.
One of more than 14,000 polling stations across South Korea. This one is an elementary school in central Seoul where voters cast their ballots for a new president. South Korea has gone through 6 months of a leadership vacuum that hit the economy and deeply divided society. Voters are focused on the candidate's economic policies. One 32-year-old man I spoke to here explained the importance of housing policies for young people and the big economic and political gap between the older and younger generations. Leading candidates Lee Jae-myung and Kim Moon-soo have both pledged billions of dollars of new stimulus measures, a big fund to support the tech sector, and prioritizing a trade deal with the United States. These expectations have led to a rally in Korean assets in the lead-up to the vote. Promises of corporate governance reforms from candidates have also spurred optimism in the market. Whoever wins, however, will have the challenging task of balancing ties with the U.S. and China. Lee has pledged pragmatic diplomacy based on a strong alliance with the U.S., but also stable relations with China and Russia. Sherry An, Bloomberg, Seoul.
That was the latest on the South Korea elections. Now, coming up, the OECD slashes its global growth forecast, citing the impact of tariff onslaught. We'll have more of the details on that next, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry An in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Well, a new report by the OECD finds that Donald Trump's combative trade policies have tipped the global economy into a slowdown. Now, the organization forecasts global economic growth to slow 2.9% this year from 3.3% last year. With us to discuss these findings, the OECD Chief Economist Alvaro Santos Pereira. Mr. Santos Pereira, thank you for joining us. What worries you the most going forward about the world economy?
Well, good morning, everyone. First of all, I think the key word is uncertainty. There's been a huge increase in trade and economic policy uncertainty. This is having an impact on consumer confidence, on investors' confidence, and also on activity indicators. And if you take this into account, and you take into account our own estimations about the impact of tariffs going forward, we revise down almost everybody. It doesn't matter if you are a G20 economy, a non-G20 economy, small or big. Almost everybody was revised down, and was exactly because of difficult circumstances and all this uncertainty going forward.
It does seem that a lot of the uncertainty comes from the U.S. Because this is man-made. Could the reversal come quite quickly?
Well, we do have a scenario. In fact, we take into account the possibility that trade barriers coming down. We think that the top policy priority is exactly to avoid further trade fragmentation. So basically, to avoid increasing trade tariffs, trade barriers going forward. And in fact, to get an agreement, sit down on the table, get an agreement so that we are able to bring down trade barriers. If we do that, we would expect that growth will be brighter than we are forecasting right now. At the same time, there'll be less inflationary pressures. But if we continue to insist of having increasing trade barriers, this will lead to a decrease in growth in the world economy in most countries of the world. At the same time, that will have additional inflationary pressures in the economy.
When, because of the downgrade to global economic growth, is this actually the worst slump since the global financial crisis, maybe excluding COVID?
Well, it is since COVID that it has been the lowest growth rate of for the world. It's one of the lowest growth rates since the global financial crisis. Usually, when the world economy was at cruise speed, used to grow around 3.84%. Right now, we're talking about lower than 3%, which means that there's a part of the world that is not growing much, and then that means there is not enough jobs being created, and there's not enough prosperity going forward. So that's why we think it is absolutely essential to get an agreement so that we are able to bring down trade barriers, but on second, to focus on policy to revive investment, which has come down significantly after the global financial crisis. Just to give you an idea, just in OECD countries, investment came down for more than 22% in OECD countries, and for EMEs, the cut in investment was around 33%. So massive decrease, which got even worse with COVID. So reviving investment is key.
I mean, how do you see it going forward? If the U.S. downgrades seem particularly hurtful, so why do you see it so weak going forward? And is it entirely on the trade tariffs, or is there also more structural things, maybe post-COVID, that could explain it?
Well, it is explained by what we see in terms of business indicators and consumer indicators. It is also explained by the impact of tariffs and in the short-run impact, which according to our own models, lead to lower growth. And so that's why we think that it's advantageous to everyone, including the United States, to get to the table and get the agreement. On the other hand, there's an upside risk that we think it could be quite important, which is the diffusion of AI and an investment in AI. And this is an area where there's a widening gap in terms of productivity between the United States and the rest of the world. China is also in the lead here. But if the investment in AI continues, this will likely bring more productivity and more growth.
Has the trade uncertainty inflicted some lasting damage, actually, on the global economy, even if some of the trade policies are reversed?
Well, I think certainly the effect is the short run in terms of uncertainty and all these indicators. But let's put it this way. If in the next few months, countries get together and are able to sign trade deals that bring down significantly trade barriers and tariffs, this will give a boost to the world economy. Together with the boost that could come from AI, that means that likely we're going to have much brighter economic outlook going forward.
Mr. Pereira, what surprised you the most, actually, in putting together this growth outlook? I know India is meant to have one of the biggest growth numbers going forward. Is actually India the new China?
Well, India is certainly the champion, the growth champion of the G20 right now. And India is investing in many areas that I think will be the future. And so you see very strong investment in India. The thing that I like the most about India is the reforms. In the last 10 years, there's been massive reforms in terms of taxes, in terms of also competitive federalism, and right now also part of the property rights reforms and so on. These are this reformist attitude is bringing a lot of growth, and we expect that this would entail even more growth in the future for India.
Yeah. And very quickly, in 30 seconds, how much do you worry about the UK? I know, the thin fiscal buffers are something that may put some people sleepless at night.
Well, the most important, I think the key for the UK is going to be boosting productivity, keeping fiscal discipline. We think that as long as fiscal discipline is maintained is important, but most important, how can the UK boost productivity? So investing in AI and the new technology is going to be absolutely key. And also to address skill shortages. So I would focus on that.
Thank you so much, Alvaro Santos Pereira, there, the OECD chief economist. Now, tomorrow and Thursday, Kriti Gupta will be at Super Return, private equity event in Berlin, speaking to some of the biggest names in the industry. We'll talk credit. We'll talk, of course, the revival and some of the debt issues out there. Up next, Bloomberg Brief, and this is Bloomberg.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today, we have the nation's biggest Wi-Fi network, and we have more customers, and 90% of your cell phone usage, 90% is Wi-Fi, right? And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning, it's 5 a.m. in New York. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures dip as trade uncertainties linger, and the OECD slashes its global economic forecast, citing President Trump's tariffs. The president presses on Republican holdouts to back his multi-trillion-dollar tax bill as senators return to Capitol Hill, and Microsoft cuts more than 300 jobs in addition to the company's largest layoffs last month. Let's take a look at what's going on in futures at this hour. As I said, we have a little bit of a dip here. S&P futures down 0.5% right now. You can see NASDAQ 100 futures also down just a little bit less than that. This after we finished the day yesterday in the green. So at least a positive kickoff to the month. In terms of what we're seeing in treasuries, the all-important bond levels here are being bought. So you're seeing the yields come down. The U.S. 2-year yield at 3.92, the 10-year yield at 4.41, and the 30-year at 4.93. So backing off that so-called danger zone. We're getting some breaking economic news right now in terms of CPIs for the euro area. You can see here that we got preliminary May CPI. Looks like the CPI month over month was a gain of 0.4%, year over year 3.5%. And in terms of the core year over year number, 2.3%. The Eurozone CPI is then coming in, and you can see the euro dollar right now at 114. Let's get some more on in terms of the market this morning, the stocks that you need to be watching on both sides of the Atlantic. For that, we go to Joe Easton in London. Joe, what have you got?
Morning, Matt. So we are looking at Microsoft. As you mentioned there, we are seeing more job cuts at the tech company, potentially around 300 more layoffs following those thousands of layoffs that we heard of just a few weeks ago. Microsoft recently hitting or approaching at least a closing record high, but coming down very slightly today. We're down 0.3% at the moment. Then we've got a big mover in the pharma space. It is a Swiss-based company that does actually trade in New York. This is being taken over by Merck, which we have on the screen here. We're down 0.2%. Merck potentially going to be taking over Moonlake Immunotherapies, which makes some skin drugs, and actually it's worth a few $1 billion. That stock was rising around 20% in the pre-market, but Merck itself actually slipping very slightly, given that news flow, that report out of the Financial Times. Then finally, in the online dating space, a bit of a move to the downside. Bumble hit today. We're down 5.5% on this one. Gen Z not doing enough dating online. Now, I think they prefer the IRL in real life dating, according to JPM. So JPM cuts the stock to underweight, says the price target needs to come down, and also potentially the new users and new additions in the next quarter are going to disappoint. And as usual, take a look at the before the bell opening wrap for a wrap up of all these news movers and more. Back to you, Matt.
Always read that at 5:30 a.m. New York time. Joe, thanks very much for that. Now, in just moments, we're going to speak with Paul Donovan, the chief economist at UBS. And then later this hour, we're going to get JP Morgan's Kelsey Barrow joining us to discuss the labor market. I want to take a quick moment to correct the CPI numbers that I read on air, because you saw the correct headlines on the Chiron, but I, for some reason, have Croatia plugged into my terminal. So it wasn't 0.4% and 3.5%. Month over month, the CPI was unchanged for the Eurozone specifically, and the core year over year number was a gain of 2.3%. 2.3%. The expectation was 2.4%. So much more in line with expectations there. Don't miss, by the way, our exclusive conversation. You must have seen just now her picture. U.S. Secretary of Agriculture Brooke Rollins joins us on trade negotiations around food and crops. That's at 5:30 a.m. New York time, as we also watch to see how much the government allows ethanol to be put into our gasoline. We'll ask her about that as well. Now, the OECD has slashed its global economic forecast for the second time this year, with the U.S. being hit the hardest, citing President Trump's trade policy. It now forecasts U.S. economic growth to slow to 1.6% this year, down from a previous projection of 2.2%. Joining us now is Paul Donovan, chief economist at UBS Global Wealth Management. Paul, great to have you on the program. I wonder what your take is on the slowing growth picture in the U.S., as well as expectations for increased inflation here and a much more divergent decrease in the Eurozone. I just read a 0.0% month-over-month figure for CPI.
With the United States, obviously, we've got a fairly substantial tax increase. That's what the tariff amounts to, and it's a tax which is paid ultimately by the U.S. consumer. You know, we've got 4,000 years worth of history of how trade taxes work. The consumer ends up paying. So it's not surprising, I think, in the face of such a significant tax increase, that we are then going to be seeing a slowdown in the economy. And on top of that, we have the effects of the uncertainty caused by the rather wild swings in policy that we have, not just on trade policy, although that, of course, is something where, you know, President Trump announces something and then retreats and then announces and retreats. but also on fiscal policy, where there is considerable uncertainty. And that's weighing on firms' willingness to commit investments, to commit to hiring, and that is going to slow down. But the pattern that we see in the States is likely to be, first you get the inflation hit. That's going to be the first thing that comes through. And then subsequently you get the growth slow down as consumers go from rising real incomes to falling real incomes as a consequence of these trade taxes.
So do you think we see a bigger slowdown then in 2026, Paul? Because 1.6% in 2025 doesn't seem as bad as we may have feared on April 2nd.
Well, bear in mind, what we're talking about here are annual average numbers. And the way that this works means that the boost to the economy in 2024, which pushed up growth, means that when we compare the average of this year to the average of last year, you're going to struggle to get a number below 1%, let's put it that way, in terms of the annual average growth rate. So some of this is just sort of a statistical sleight of hand. If we look at the momentum in the second half of this year, then I think we're probably looking at a fairly soft momentum in the US economy. Not so much elsewhere, but in the United States, you've got that softness as a consequence of the first round shock, the inflation shock, and then the second round effects, the uncertainty, the impacts on hiring that come out of the current policy stance.
What are the effects then on global growth of these tariffs, Paul? Because, if it's just a tax and we trade taxes on tips and Social Security for taxes on goods bought, yes, it may be regressive, but we're still getting that revenue. It's no big deal. Do you see then, though, a slowdown in growth in other countries because maybe Americans don't want to pay that tax?
Well, so this is where things start to get a lot more complicated. The first point, which we need to stress, this is not the 1930s. In the 1930s, everybody was fighting everybody else. Everyone was putting tariffs on everyone else. That's not what is happening here. This is the United States versus the rest of the world. The UK is trading very happily, in fact, more happily, with Europe. Europe is trading with China. China is trading with Japan, etc., etc. So this is something which is US specific, and that blunts the impact elsewhere. The second thing is, what is the reaction of US companies to the tariffs? And that does make a big difference, because US companies have a choice. They could go for market share, keep their prices unchanged, try and take market share from their competitors. And that, of course, would be very negative for exporters in the rest of the world. But if US companies say, actually, you know what, we're not going to go for market share, we're going to go for profit margin, we're going to raise our prices under the cover of these tariffs, then that means that whilst a slowing US consumer does do damage to rest of world exporters, that damage is more muted because the rest of the world still maintain their market share. Now, I suspect that we're going to be erring towards that scenario. US companies do raise prices as tariffs come in. They don't go for the market share so much, and that means, again, that the impact on the rest of the world is a little bit blunted. Obviously, we're seeing rate cuts in many other countries around the world because they're in a disinflation environment at the moment, which the United States is not. We've also got more room for fiscal maneuver in the rest of the world. We don't have these enormous deficits that the United States has got. Again, that provides a degree of support.
Paul, great to get your take on this stuff. Obviously very complicated, so really great explainer there. Paul Donovan of UBS Global Wealth Management giving us a little education this morning. Let's get to some of the other top stories trending on the terminal. Far-right lawmaker Geert Wilders pulls his Freedom Party out of the Netherlands ruling coalition, causing a collapse of the Dutch government. That exit triggers an election which would otherwise have been held in 2027. China's manufacturing sector had its worst slump since September 2022, falling to 48.3 in May from a reading of 50.4 in the prior month. The figure was below every estimate in a Bloomberg survey of analysts. It came as higher tariffs took a toll on smaller exporters, despite a truce in the trade war with the U.S., although that looks like it's been unraveling. Elon Musk is selling $5 billion in debt for his startup XAI. It's the latest in a series of fundraising events across his business empire as he pivots away from politics. Sources say the package includes a floating rate term loan, a fixed rate term loan, and senior secured notes with proceeds going towards general corporate purposes. Coming up, the White House pushes for a Trump-Xi call while Secretary Lutnick shows optimism for a deal with India. More on trade talks next. This is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
The risk was a downside surprise, the reality an upside surprise.
The shock has affected outcomes.
There's a pretty big cliff from an economic perspective.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
American exceptionalism continues.
This is not what we're going to experience in the upcoming months.
Is it going to be Biden data or Trump data?
The May Jobs Report, Friday on Bloomberg.
Trump wants to talk at the very highest levels. That's not always how the Chinese want to do business, and I'd be curious to see if they're able to make any headway. Trump doesn't want to go through the back channels. He doesn't want to go through the ordinary course of business. That's never been his style as a leader, being in business or in his first term in office. He wants to talk to the principal. He wants to talk to President Xi himself. So we'll be curious to see if the conversations that the White House has telegraphed actually do take place.
That was President Trump's former White House acting chief of staff, Mick Mulvaney, speaking to Bloomberg Television earlier. Simmering trade tensions between the U.S. and China seem to be at an impasse ahead of a potential phone call between President Trump and his counterpart, President Xi, if that even happens. For more on trade, we're joined by Bloomberg's global trade editor, Brendan Murray. And Brendan, I guess my first question would be, how likely is this call to happen? Because President Trump has been asking for it, as have his cabinet members, for months now, and Xi continues to demur.
Yeah, exactly. There's a real clash of culture here when it comes to trade negotiations. As Vic Mulvaney was saying, the Chinese want to do a lot of back channeling. They want to have some deliverables that both leaders can announce after a call like this, rather than the leaders meeting and setting the tone for a series of conversations. So it would appear that the Chinese are digging in their heels here, and the U.S. side, the White House, the officials we've heard from in the past 48 hours are really pushing for this call to happen. But they seem to be that message seems to be falling on deaf ears so far. The Chinese will want some sort of concessions to the tariffs that the president has in place, but Trump doesn't seem to be ready to budge much on his side either. So it is a real a chess match here that's at a stalemate.
Right. I mean, one side is begging for a phone call, and the other side isn't. So that kind of shows you how the balance of power shakes out. What do we know about the deal that Scott Bessent and his Chinese counterparts negotiated in Geneva? Is that deal still holding, or is that done?
Well, both sides are pointing fingers at each other, saying you haven't lived up to your end of the bargain on that. That was 3 weeks ago. The U.S. wants China to sort of unlock the control it has over critical minerals, things like magnets and other sort of things that are needed for advanced technology. China wants the U.S. to ease up on export controls of high-tech equipment like semiconductors. And so both seem to be pointing a finger at each other and saying, hey, you said you do this, but you're not doing it. And so that deal, while it doesn't look to be holding at the moment, it isn't broken just yet, but it seems to be very fragile. And the tone, the move, the impetus seems to be moving toward escalation as opposed to de-escalation, at least in the rhetoric.
All right, Brendan, thanks very much. Brendan Murray is Bloomberg's global trade editor. Now let's get to the domestic front. President Trump working the phones to try and sway his party's Senate holdouts to back his one big, beautiful, multi-trillion-dollar tax bill. He's also posted on Truth Social, calling on Senate House Republicans to, quote, work as fast as they can to get this bill to my desk before the 4th of July. Bloomberg's Josh Galou joins us now for more. Josh, what do we know about the holdouts? I mean, I'm guessing these are Republicans in states that would normally be getting a lot of, for example, clean energy subsidies, or Republicans in states that are going to see hundreds of thousands, if not millions, cut from the Medicaid rolls. So how do you sway those kind of politicians?
Yeah, that's exactly right. I think there's a clear playbook for the White House when it comes to the Medicaid cuts. They're trying to sell the idea that they're really diminishing the pool of people that are going to access Medicaid rather than cutting actual benefits, by disallowing undocumented immigrants or other people who they say are able-bodied and able to work. So having that work requirement. Whether or not people go for that is an open question. Josh Hawley, of course, of Missouri, is one of the biggest holdouts on Medicaid, and he said that Trump has assured him there won't be any cuts to actual benefits, which seems to work for him. We'll see if it works for others. But whether that's enough to satisfy the fiscal hawks is another question, because the House bill, at least, is meant to add $3 to $5 trillion to the debt over time, over the 10-year period. And, you have Ron Johnson, you have Rand Paul, you have Mike Lee and others who are really pushing for deeper cuts. And where you're going to find those is tough to see. And as you pointed out, clean energy is one of the big ones, but you have people like Tom Tillis, Collins, Murkowski, that, they have enough support that if they really are willing to block the bill for that, they can, because Trump can really only afford to lose 3 votes in the Senate. So having said that, Josh, why is no one concerned that this bill doesn't pass? Is it just that changes need to be made, but eventually we're all confident it gets over the line? Well, I think there's a lot of confidence that it's going to get over the line. Whether it happens on Trump's timeline is another question, because, the things that the Senate is talking about are also very different from what the House wants. The House, it barely squeaked by in the House. And you know, the Senate, for instance, one of the sticking points for the House was the state and local tax deduction. And, you know, that's driven by high-tax states like California, New Jersey, New York. In the House, there are Republican representatives who wanted that to the cap to be raised. But in the Senate, you know, they don't care as much. The people from those, the senators from those states that care about SALT are Democrats. So it's an entirely different calculation right now, and they don't need those people to come along with them for this vote. Whether it gets, Tillis says that they're going to have a draft to Trump by this weekend. That seems ambitious given all of the discrepancies that are still out there. But, you know, it still seems like a pretty long and patchy road ahead.
So what you're saying is there's a chance that the state and local tax deduction, already capped by President Trump in 2017, is going to stay capped, possibly at a lower level than the House has negotiated.
It's certainly possible. I think the House negotiated it up to $40,000 and from $10,000 after it had been uncapped before, and the Senate is talking about a compromise there.
Josh, thanks so much for joining us. Josh Galou there talking to us about the one big, beautiful bill. Coming up, tensions escalating in the war between Russia and Ukraine. More in your front page news next. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, you know, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Time now for our front page news, a look at what's making headlines around the world. First up, the Wall Street Journal leads with the escalation of the Russia-Ukraine war. Despite saying they want peace, this follows the weekend's drone attacks in Russia. The two sides met for a second round of talks in Istanbul, but the meeting lasted barely an hour, producing only an agreement to exchange prisoners, nothing more. Next up, on the FT, the Polish government is bracing for a confidence vote on Donald Tusk. After a bruising defeat in the recent presidential race, Tusk aims to reestablish unity in the cabinet and has an emergency plan in case of difficult cooperation with the new ultra-conservative president. And in the New York Times, more details have emerged on the suspect in the weekend attack in Boulder, Colorado. The suspect came to the U.S. in 2022 and lived with his family in a suburban neighborhood. He told police he disguised himself as a gardener when he headed towards members of a Jewish group walking downtown before attacking them with incendiary devices. Coming up, we'll take a closer look at food standards and trade.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. It's 5:30 a.m. in New York City. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stock futures dip as trade uncertainties linger, and the OECD slashes its global economic forecast, citing President Trump's tariffs. The president presses on Republican holdouts to back his multi-trillion-dollar tax bill as senators return to Capitol Hill. And Microsoft cuts more than 300 jobs in addition to the company's largest layoffs last month. In terms of the indexes, futures are down, but we did finish in the green yesterday, even with a red start to the trade. The S&P 500 closed up 0.4 to 59.35. You can see S&P futures now down about 0.4 or 0.5%. NASDAQ futures down 0.4, and Russell 2000 futures falling as well. Treasuries have been all important for this market, but look relatively tame today. U.S. two-year yield coming down almost 2 basis points to 3.92. The 10-year yield coming down more than 2 to 4.41, 4.42, and the U.S. 30-year yield trading well under 5% at 4.9428. For some of the stocks to watch this morning, let's get over to Joe Easton in London. Joe, what do you got?
Hey, Matt, so Microsoft in the radar once again. We are seeing that stock slipping only by around 0.3%. Remember, we got news of the company laying off around 300 workers. This is according to a state filing seen by Bloomberg, and does come just a couple of weeks after we saw around 6,000 layoffs at the company, the biggest layoffs in years at the firm. Keep an eye on that one in pre-market. Then I've got UBS on my radar. Now, UBS has a big ruling coming up on Friday from the Swiss government around how much capital they need to have on their books following that big takeover of Credit Suisse that we saw a couple of years ago. Now, analysts at Jefferies saying there is too much fear heading into that report from the Swiss government, and they upgrade the stock to buy this morning, and therefore we're seeing the shares gaining around 2.5% for UBS in the pre-market. And then a different kind of broker move, this over in the online dating space. JP Morgan downgrading Bumble today, and that stock falling almost 6%. JPM saying that the Gen Z users are cutting back on their online dating. I think Gen Z needs to be a bit more romantic to help this stock out, but we're seeing it down 6% at the moment. JPM reckons they will see a drop-off in their active users when Bumble next reports its quarterly updates. So that broker move really hitting the stock today, Matt. Bumble declining almost 6% in pre-market trading this morning.
There's nothing you and I can do about it, Joe, because you know how Bumble works, right?
We're well past that, I think, in terms of the Gen Z element, at least.
Yes. No, I mean, we're too old for sure. But the thing is, the woman has to make the first move on Bumble. That's what differentiates it from
Right.
Tinder.
Okay. Yeah. I'm well out of line with these data.
Joe, as well, you should be. Joe Easton, get over to your desk and push the button on Before the Bell. Before the Bell is Joe's newsletter. Highly recommend checking it out. Comes out every day, New York time at 5:30 a.m. and really sets you up well for the trade. One sector at the center of the U.S.'s recalibration of trade is agriculture. Washington has been lobbied by farmers who've lost their biggest export market due to the tariff battle between the U.S. and China. Trading partners, particularly China, have also had to readjust their food and farming industries as they navigate a shifting trade landscape. For more, we're joined again by Bloomberg's Brendan Murray, our global trade editor. So, Brendan, this is pretty fascinating and important to the livelihoods of millions of Americans. What do we know about farmers' lost revenue due to the trade war?
Yeah, well, if you remember during Trump's first administration, he negotiated what he called this Phase 1 agreement with China. And in that agreement was a promise by Beijing to buy $80 billion worth of American agriculture products. Well, that deal went dormant during the Biden administration and remains non-existent today. So with the U.S. and China currently at a stalemate in these trade negotiations and trade between the two countries, that's really fallen a great deal. Farmers who've just planted their soybeans and their corn across the Midwest are looking at this summer going, well, who's going to buy these crops at the end of this? And so you've got the Trump administration trying to do these deals with individual countries. These are tariff deals and deals that address non-tariff barriers like food safety regulations and sanitary standards and those kinds of things. So the Trump administration is looking for other customers for American agriculture exports, and this is going to be a big issue for the farm vote as we head into the next several months. Now, what we understand is that Vietnam is looking to buy some, and there will be other deals between these countries. The Trump administration hopes to make up for that lost market in China. Maybe there'll be a deal with China that restores those purchases, but if for the time being, American farmers are looking out going, look, you've just, you kind of burned a bridge with our biggest, our export customer, and how are we going to replace that demand? So that's what the Trump administration is trying to address.
All right, Brendan, thanks very much. Global trade editor Brendan Murray there setting us up for the secretary. Agriculture at the center of so many of the Trump administration's negotiation. U.S. Agriculture Secretary Brooke Rollins joins us now, where She is in Rome for meetings with Italian counterparts right now. She posted on X yesterday about her mission balancing trade and putting American ag first. I'm pleased to get the Secretary on a television with us, Brooke Rollins. Secretary Rollins, thank you so much for joining us. Let me first ask what you've achieved there in Rome, because as we know, exports to Europe and the UK have been important but problematic. They have issues with genetically modified crops. They have issues with the hormone that we use in our beef. They have issues with the chlorine that we use to wash our chicken. So what can we do about those kind of non-trade barriers, and what have you achieved there?
Well, thanks so much for having me on. A couple of quick top lines, and then we'll talk about that. The first thing is this, that the president's vision to realign the world economy around putting America first was long coming. For too long, America has been subject to a tariff regime of other countries, and now that's changing, and it's changing for the better for our country. So I think that's really, really important, and from my perspective, for our farmers and our ranchers. The second thing I think is important is being in Italy today. I was in the UK just a couple of weeks ago. I'll be in Vietnam, Japan, and India next month. That it is time that we move these products and continue to work on the world stage. Last night, we had an incredible day, all day yesterday and last night, with my counterparts here in Italy. Their Minister of Agriculture, Lollobrigida, who is wonderful. We talked about getting more of our soybeans, more of our wheat, more of our great products from America into Italy and, of course, across the EU. But the third thing I'll say, and that is your point, that this concept that American agriculture isn't safe, or the genetically modified, whatever it is, there are thousands of research data compilations that prove that to be wrong. Those are called non-tariff trade barriers, and they are absolutely not real. It's not based in science, and it's time that changed. And I know our trade team from America has been working on that. They continue to work on that. We've got more deals that will be or should be announced in the next week or two, and that non-tariff part of that is a really important part. When people say the chlorinated chicken, only 5% of our chicken in America still uses that chlorine rinse, and even if more used it, it's still considered safe according to worldwide standards, not just American standards. Same on the GMOs, same on the hormones, et cetera. So we feel very confident we have the best product in the world, and we're going to keep moving it out.
Ms. Secretary, the issues that you're raising seem to be some that our own Health Secretary, Robert F. Kennedy, has with foods. The science clearly notwithstanding, right? He has issues with chemical treatments. He has issues with additives in some of our foods that are very similar to those that the EU and the UK have. Aren't you looking at changes along those lines for U.S. food standards as well?
Secretary Kennedy has been very clear that the American product is safe, and it is really the best. Now, where he comes in is, can we do better? And I think what everyone, everywhere in every product, every lane, it's always about how do we do better? How do we do better? How do we ensure that our products are continually improving? And we're doing that, and that's where he's coming down. But really, as part of the Make America Healthy Again Commission, as the mom of 4 teenagers, a MAHA mom myself, it isn't just, it's more about the ultra-processed foods. It's more about all of the other parts of the environment in America that are making our population as, more unhealthy, chronic disease, et cetera, is at an all-time high. But this has nothing to do with our soybeans, our wheat, our beef, our seafood, all of the great products that are coming from America. And Secretary Kennedy and I are very close. We've talked about this at length. He's visited farms with me in Texas. We have another couple farms we're going to be visiting in California in the next month. So we are simpatico on this. Now, do we agree on everything? No, but we agree on most things, and I think that the American people under President Trump's vision will be the ultimate beneficiary of that. But also, as we are on the world stage, continuing to move our great farming and ranching products out there. And I know your guest a minute ago talked about China. Listen, we had a great deal with China in 2019. The Biden administration decided not to enforce it, and as a result, we now have a $45 billion trade deficit in our ag products. So that's what we're trying to sort of make up for right now.
I would have thought that RFK Jr. had a real problem with our wheat. I've heard him for years talking about the glyphosate used in pesticides and linking that to non-Hodgkin's lymphoma. So it's interesting. And I look forward to seeing that the two of you together visiting farms. Let's talk about the recalibration of trade. If you lose, say, $2 billion from food aid programs, but gain it in Vietnam, I know that you're headed there and they want to buy $2 billion more of our products. That's, I mean, that's fine, I guess, but it takes time to do those things. So in the meantime, we've seen soybean exports drop, I think, 79% below the 5-year average. Corn exports dropped 49%. Do you have to make that up with some sort of farmer subsidy program? In the first administration, President Trump gave the farmers $28 billion. Is something similar like that going to happen again this year?
Well, we remain really convicted that we're just at the beginning of these renegotiations, that the market has reacted, but at the end of the day, inflation is down, jobs are up. We continue to see a positive sign. Specific to soybean, corn, really our row croppers, that's really a very direct result of China. And I know we're making progress on China. We'll continue to make progress, hopefully. But if we don't, opening up markets all over the world. Listen, EU, for example, charges a 10% tariff on average on American products, and vice versa, we only charge 5%. That's 2x. The average tariff charge around the world is about 15% on American products, when we charge on average 5%. We've been taken advantage of over and over and over again. So as we are realigning, we're also opening up these markets with the trade deal that UK just a couple of weeks ago was a massive deal. 25 years we couldn't get a deal done with the UK, and now all of a sudden we have the deal. And that will be extremely beneficial for our corn farmers, our soy farmers through ethanol, and our beef cattle, et cetera. So you'll continue to see this moving forward. Now, if around harvest time, into the summer, beginning of the fall, we see some real economic harm with our farmers, our president has been unequivocal in saying that he's got the farmers back. And if there is short-term consequences, we'll make sure to do everything we can to mitigate that. And I'm here to execute on the president's vision. So yes.
Can I ask about ethanol specifically? I'm from the great state of Ohio. I grew up surrounded by corn farmers, and I have a lot of respect for the work that that those farmers do for our country, really for our national security, and it's delicious. But I'm also a fan of the big American V8 motor, and I do not want to put ethanol-based gasoline in my car. I'll drive miles to get premium-grade fuel. It doesn't have any ethanol. What are you thinking about in terms of the level of crop-based biofuels that should go into gasoline?
Well, I think the most important thing to realize is that we've got an energy national security crisis, and that there are many different ways to solve that. And that's what Doug Burgum and Chris Wright, two of my cabinet counterparts, are really focused on. The President Trump, talk about being unequivocal. He's been unequivocal in his support for ethanol and biofuels. And it isn't just about America. And listen, this is the great thing. It's America, where you can choose what you prefer and what you want to put in your vehicle. But the ethanol conversation that's happening around the world, you talk about the UK, which, whether we agree or not, I happen to not agree, but their goal is to get to net zero, right? Net zero, which again, we could have a whole other show on that. But in order to get to net zero, they're going to need our biofuels from America to do that. So it isn't just about specific to, you know, what you're going to put in your truck when you drive across Ohio, which there may be some that disagree with that, what you just said. But it's also about where America stands on the world stage. A, how we achieve energy independence, but B, how we continue to support our great farmers and our ranchers. And food security is national security. And I think that's really important. If we don't have a strong agriculture sector, if we can't feed ourselves, we are no longer the superpower in the world. And so all of this, it's a complicated sort of balance that we're striking, that we're working to achieve. But with the president's vision, and I think with arguably one of the greatest cabinets in the history of our country, we will achieve it for the American people by putting America first.
Mrs. Secretary, thank you so much for your time. Really appreciate it. U.S. Agriculture Secretary Brooke Rollins in Rome. Coming up, JOLTS data comes out later this morning ahead of the jobs report on Friday. We're going to push ahead with JP Morgan's Kelsey Barrow next. This is Bloomberg. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
A host of jobs data coming this week, starting with JOLTS at 10 a.m. today, ADP on Wednesday, jobless claims on Thursday, and the all-important payrolls report on Friday. JP Morgan's Kelsey Barrow looking ahead to Friday, writing, quote, "We view the labor market as treading water. Companies are not firing workers, but we don't see any reason they should be accelerating hiring either, given elevated trade and policy uncertainty. On the margin, though, Shadow's slack does appear to continue to build." Kelsey joins us now. She is fixed income portfolio manager at JP Morgan Asset Management. We'll get to treasuries, obviously, but I want to ask first about this, not necessarily JOLTS this morning, but just the labor market in general. How does it look to you? Because I'm sure Jay Powell and the Fed have really been weighing which side of their mandate to pay attention to. It doesn't seem like labor is that much of a problem.
Labor is not a problem, but it's not a problem in a few different ways. So the thing that the Fed was concerned about in prior years was that the labor market was a source of inflationary pressure, particularly wages. Now, I think the labor market has rebalanced and continues to rebalance such that we feel fairly confident that labor market isn't a source of inflationary pressure right now, which is why you've seen so much stability in the front end of the Treasury curve. So today, when I look at the JOLTS report, what I'm expecting to see is a continued deceleration in job openings, a continued deceleration in the quits rate. All of these things suggest continued moderation in wages. That's not something that's going to get the Fed to jump as it relates to changing policy, but it keeps them comfortable with the current policy stance.
On the inflation side of the mandate, that also doesn't seem to be a problem, right? I mean, they want to get down to 2%, and by some measures, they're bang on that.
Right. 2.1% on headline PCE year over year. Exactly. So they're kind of in this position where they can wait and see, which is exactly what they've been communicating. But if I think about the risks, I do think that they're asymmetric towards the risk that we could see weaker growth data, weaker labor market data, particularly relative to what we saw last month. So I look at the job growth data we saw last month, 177,000 was the job growth created in the April payrolls report. I don't expect that we can maintain that pace of job growth, particularly when I look at things like continuing claims, which continue to trend higher. I look at the Conference Board labor differential. You know, you've seen a rebound in consumer sentiment, but you haven't seen a rebound in some of those specific labor market focused questions. Those continue to show it's kind of a tricky time to be finding a job.
But you do expect then, if you're more concerned about growth, then I imagine you're pricing in cuts for this year.
We do think that later in the year you may see cuts. What I would say is that the risk is that they happen later, but the risk is also that they could do more in the end. So kind of similar to what we saw in 2024, where the Fed held off for a while, and then ultimately they saw the labor market start to slow, and they reacted more aggressively.
So in a vacuum, right, if you told a trader the Fed is going to cut later, you want to own today's debt, right? But we've been seeing bouts of selling in the Treasury market, especially at the long end, and that's on concern about our growing budget deficit. How much of a concern is that? Because, to be honest, we're not at 4.5 on the 10-year. We're not at 5 on the 30-year. Like, the alarm bells aren't ringing right now.
Right, but we were not that long ago, and so I think people are still on edge. So we have been thinking about a range for the 10-year yield this year of 375 to 450, and it was tough when we were up at 450 and we were testing those levels, but it does look like we've settled in a little bit here, and I do think that there is a fair bit of term premium already priced into the long end, reflecting what are real concerns about the deficit. But those, I would say, are generally already priced in. And so I think the risk is a little bit more two-way here. And the question is, what are the catalysts that can get us lower from here? So term premium is elevated, the long end on a historical basis, valuations look quite attractive, but you need a catalyst to reprice. On the technical side, I think there are some catalysts that we should be watching, particularly as it relates to the debt management offices in the US and also abroad. You look at Japan today, they had a 10-year auction. It went well. Part of the reason it's going well and the things have stabilized a little bit is that the debt management offices there are indicating that they're going to be adjusting their issuance patterns to cut some of that long end supply. I think that is essentially kind of inevitable for the US as well, that they're going to need to start to think about where is the demand on the curve. The demand right now is clearly in the belly and the front end, and how can they adjust their issuance patterns to support where the demand for fixed income really is.
So much for issuing a lot more long-term debt. That's what this administration was complaining about the last administration doing too much at the front end, right?
Right, but we have a different Treasury market now, and we have a different curve now. The yield curve was inverted back then. The yield curve is now very steep, and it could continue to steepen. And in that environment, when you're looking at getting the most cost-effective interest costs for the Treasury, you're looking at a different situation now.
All right, so do we see the curve continue to steepen then? I mean, do you see long end demand just not there, and do those yields rise?
I don't think that they necessarily need to rise from here, but that's the risk. I think that the curve steepening, further curve steepening from here probably does need to come from some follow through in terms of expectations of rate cuts. So right now we're in a situation where I think the market is going to persistently, on like a 6-month to 12-month rolling basis, continue to price in some probability of rate cuts. But the base case for most people is going to be that the Fed stays on hold. To get a lot more curve steepening from here, I think it has to come from the growth data actually weakening. and the market pricing in a more aggressive rate cutting cycle rather than further increases in the long end.
Not from a buyer's strike, because, you know, clearly international buyers may be offended, and we had a story yesterday that DoubleLine, PIMCO, and TCW are like either not buying or shorting the long end.
Right. I mean, and Bob Michael, the CIO of JP Morgan fixed income, who I work with, was also in that article stating that you know, we need to be a little bit cautious in the 30-year part of the curve, and that there are some technical signals that we need to see before we really feel comfortable stepping in. But there has been a lot of value created, and it's about what are the fundamental or technical catalysts that are going to get term premium to reprice further from here.
Kelsey, great having you in here. Thanks so much for joining us. Kelsey Berry there from JP Morgan Asset Management. Give our best to Bob Michael as well. Let's get a look at what's ahead today. Dollar General earnings coming before the opening bell. Then we get the JOLTS numbers we were talking about, along with factory and durable goods orders at 10 a.m. And Fed Speak today from Austin Goolsbee at 12:45 and Lori Logan at 3:30. That's it for Bloomberg Brief. Surveillance is ahead. I'm Matt Miller. This is Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country, and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I think the market, has probably some near-term upside.
We do remain a bit more cautious on the long end of the curve.
When we look at the equity market, we see more risks on the downside than the upside.
If things stay status quo, then I think you have the opportunity to see the markets
move higher. What's going to drive things higher? And then it's got to be the environment and earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. All eyes still squarely on Washington, D.C., with President Trump working the phones to wrangle votes for the one big, beautiful bill. Trade tension still high, even with a possible phone call between Xi Jinping and Donald Trump on deck. And the drip feed of economic data continues with the latest read on factory orders and job openings coming up today at 10 a.m. Eastern. Just a note, John is on a well-deserved vacation. Anne-Marie is on assignment. I would be here by myself with a white flag, but alas, we got incredibly unlucky, and Damian Sassower has agreed to join me for the next 3 hours. Damian, thank you so much for doing this. I really can't thank you enough.
Oh, no, thanks for having me here. I mean, I love to be here. Let's get after it.
Are you having fun?
I'm having a lot of fun.
Honestly, I was looking
I think the makeup department's having a lot of fun this morning on me also, to be honest with you.
Well, I will say I was looking today at the series of different news that potentially could be swaying markets one way or another, and I was struck by the budget down in Washington, D.C., and how it's steadily gotten an increasing amount of attention. How much is this really going to dictate so much of the mood in effect, given the fact that bonds have been responding so much in lockstep to this?
Well, it's all about the 30-year, the price action at the 30-year. And you remember last week when we saw the move in the 30-year, that was kind of driven by that poor 30-year JGB auction. And just last night, we had a JGB 10-year auction, which came in pretty good, but we have another 30-year auction coming up in Japan. We're going to see whether that spills into the long end of the U.S. Treasury curve, or whether you're right. Maybe it is the big, beautiful bill and the rising fiscal deficit in the U.S., which is driving the zoo steepener, as Cam Dawson likes to put it.
I am sure you will get all into the zoo steepener. Meanwhile, overnight, we did get a Truth Social from President Trump talking about how the one big, beautiful bill does not increase the deficit, does not necessarily cut Medicare and Medicaid. It doesn't necessarily do anything other than just give people tax breaks and continue with their policies. How much do you think Wall Street's listening? How much do they think that there is some faith that ultimately there will be some fiscal discipline in Washington?
Well, I mean, that's a very good point. I really don't know, but I will say this, the Senate is definitely going to make their mark on this bill. I think, they are the adults in the room. They're going to try to do whatever they can, but from what I understand, President Trump is pushing through. He's working the phones. He's trying to push through its current iteration, and just how successful he's going to be is going to have a lot to do with whether or not you're right. The end of this, the 30-year portion of the U.S. Treasury curve really kind of reacts to that. I mean, I'm not so sure it will.
In the meantime, can we ignore the trade issues, or is that something that people are still paying attention to? How much has that actually been priced in with respect to a possible falling apart of the U.S.-China truce?
Well, it's funny because these steel tariffs, everyone's been pointing to that being a China issue, but it's really more of a Canada and Mexico issue from where I sit, So I think what you're seeing is the Trump administration sort of readying itself, steeling itself for those negotiations with Mexico and Canada, which are our two biggest trading partners right now.
Meanwhile, what you can see is a buy-the-dip mentality that has been taking hold pretty much across Wall Street. This morning, you do see a bit of softness, but this is where we were yesterday. If you take a look at markets right now, down about 0.4%, about where they were yesterday, and we ended with a positive tilt. Euro actually falling versus the dollar, weakening. A little bit of dollar strength. Let's see if that can hold. Yields marginally lower. This is the kind of price action exactly on the heels of what Damian was talking about, that successful 10-year Japanese bond auction. And then you have crude just a touch lower. But, to me, I think that might be one of the most interesting things, the buy-the-dip mentality. And actually, that is what we got from Max Kettner this morning from HSBC, where he said that is the reason why he is a buy-the-tip kind of guy. This is incredibly bullish action to see everything really get bought, even with some of these lingering concerns about trade.
Well, Lisa, after, declining slightly in the first quarter of this year, the U.S. economy is running hot at like 4% quarter over quarter right now in the second quarter. So, and look, inflation, I mean, if you look at JP Morgan's forecast for inflations over the 4-month period from May to, let's call it August, CPI is going to be running at something like 6%. So you're right. Where is this catch-up of the hard data to the soft data? I mean, we all wish the Knicks had 9 games to beat the Pacers, but that's just not the case. We're all going to be sitting here waiting for the hard data to catch up.
And we all wish that the Knicks could have caught up to the Pacers, but alas, there we are. Coming up this hour, Cameron Dawson of New Edge Wealth and the latest market swings, Rob Casey of Signum Global Advisors, as Trump urges the Senate to pass his tax package, and Leland Miller of China Beige Book as the White House pushes for trade talks with China. We begin this hour with stocks pairing gains on renewed trade uncertainty. Cameron Dawson of New Edge Wealth writing, the market has shown signs of resilience as it burns the overbought condition from mid-May. We think the pain trade is still higher. Cameron joins us now. And Cameron, it is so good to have you. Thank you for being here. A lot of people agree with you. And that's what we saw from Max Kettner this morning, where he said recent dips in risk assets have been very short-lived amid less supportive news flow. Our sentiment and positioning indicators are still flashing buy signals.
We still come back to that positioning indicator from Deutsche Bank, consolidated positioning, which shows that we're still just in the 23rd percentile. So despite a nearly 20% move, you still have so many people sitting on the sidelines. Now, that's important to note. It's institutions sitting on the sidelines, mostly these systematic traders. It's the lowest numbers in things like these CTAs as well as algorithmic traders, whereas you see the discretionary traders have gone a little bit more all in, as well as retail. Retail has definitely been buying the dip, and that's where we've seen the greatest flows into this market. So because you still have people sitting on the sidelines, though, we do think that it comes down to the pain trade being higher.
Does it matter that we don't have a trade deal, that the budget is being negotiated? Do any of these things that I opened the show with matter?
Yeah, we do think that they matter, and we're calling this the summer of mud, so it's a lot less exciting than hot girl summer or brat summer. It means that we're just
You're crushing it, by the way. Carry on.
It means that we're just stuck in this muddle through, which means that from a policy perspective, we don't see a lot of things that are ultimately stimulative. We think that even if you do see the pain trade be higher, you still have valuations that are rather high, earnings estimates that have room to come down. So we still think that we're stuck in this sideways choppy range, a really muddy outlook from a growth perspective. So the summer of mud is what we get.
Well, Cam, I mean, I'd love to talk about stocks and bonds, but for me, it's all about the dollar. I mean, off 9% year to date, worst start since 1973. So, you know, for me, you know, the Trump administration tariffs, just how much runway does U.S. dollar weakness have in the current environment?
I think we should all be raising our eyebrows at a dollar that can't rally as the stock market rallies. And the dollar is not oversold yet. It rolled over, it broke through or tested 98 yesterday on the DXY. If that breaks, we could be talking about 95 on the DXY, which again is a challenge, mostly when we consider the environment that the Fed is set to be more tight than what we're seeing out of the ECB and other central banks. Usually, you would think that that would translate to a stronger dollar, but now it's not, and it's all because of trade, tariffs, as well as what's going on with these budget negotiations.
Well, Cam, you make an excellent point. The correlation between the U.S. equity market and the U.S. dollar has tightened significantly. So let me ask you then this. Let's fast forward to payrolls. You know, if we get a weaker print, can we see a lot of dollar weakness? If we get a better than expected print, is the dollar going to strengthen off of that? What's your view there?
Well, I do think that we have to have this through the looking glass kind of perspective when it comes to market reactions. We do think that if you do see a weaker print on non-farm payrolls, the first order reaction is a lower 10-year bond yield, lower 30-year bond yield, meaning that we get a rally across the curve. If payrolls mostly come in below 100,000, then it's a guess of what the dollar does. The other important thing about the dollar that we have to note is that futures positioning is incredibly short, meaning that everybody is now positioned for a weaker dollar. So as the pain trade in stocks could be higher, the pain trade in the dollar could also be higher.
Are we getting a little bit carried away? When I talk to a lot of investors and I ask them, is U.S. exceptionalism over? Are you seeing this massive flight of foreign investors from the U.S. market? They all say no. They all say that actually their foreign investors that they deal with are not shifting away from the U.S. en masse at all. They might express displeasure. They might use corporate executives as their bouncing off points for how much they are concerned about policy, but they're not actually taking action with their dollars. And actually, they do have confidence in corporate America. Do you think that that's not true, or that that's on the brink of fading?
B of A just published a survey that showed that you have seen $138 billion annualized into equity flows from foreign buyers this year, which is nearly at the record that we saw $155 billion last year. So as much as we have had this narrative that nobody wants to buy U.S. assets, we're still seeing inflows. The inverse of that, though, is that if you look at the inflows into U.S. bond funds, it's only been $3 billion. So people are still buying U.S. equities, but not buying U.S. bonds. The other thing to watch, though, is that revenge tax that's in the bill that's being considered. Could that mean that we see less demand for U.S.-based assets if we start taxing that passive income that's part of the revenge tax? Big question.
Yeah, that's a concern for a lot of people. Exactly what the ramifications of this bill. I believe that that's 899, Section 899. There's a big op-ed challenging that in the Wall Street Journal today. I recommend people read it. It's sort of a compelling read. I'm curious going forward what you're looking for to understand whether this narrative has more legs to it rather than just simply a timing trade, maybe, after a really strong period in the dollar, and frankly, some concerns about duration in the U.S. right now.
Yeah, I mean, I think that that is the biggest question, is that do we see duration risk continue to be something that people want to avoid, even as yields test prior highs? We have seen people step in and buy dips within bonds at 4.8% on the 10-year, 5% a couple years ago. The question is, as you start potentially testing those levels, is the appetite for duration as much, given the fact that we are dealing with all these fiscal concerns? And I think the big question for us is whether or not the Senate's version of this tax bill is going to be even more deficit inflating than what we saw from the House, because of some of the considerations about not wanting to do as many spending cuts.
European harmonized CPI collapsed to 3% overnight. It was expected to come in at 3.8%. That all but solidifies the fact that the ECB is going to cut by 25 bips on Thursday. We've seen cuts from South Korea, South Africa, Indonesia, the whole slate across the world. Yet, if CPI is really going to be running at something like 6% over the next few months here in the U.S., just how much scope will the Fed have to cut rates in the face of all these other central banks being able to stimulate their economies?
Yeah, and I think the other thing to note is that a lot of these economies are dealing with much weaker growth than what we're seeing within the U.S. It's pretty wild to think that German unemployment is at 6.3%. It peaked in 2020 at 6.4%. So with weaker inflation as well as much weaker growth in the euro area, the ECB just has a lot more room to cut. And the Fed is telling us that they are in no rush to cut whatsoever, that they're going to look through some of this soft data that shows weaker, potentially weaker growth. Right. And note, the soft data is actually rebounding a little bit, as we've seen some sentiment rebound post the tariffs being walked back.
Yeah, this is a real key question. How much will that divergence continue? And how much is the Fed actually not going to cut, especially if you do start to see growth falling off in a significant way? Cameron Dawson of New Edge Wealth is also sticking with us for the hour, which we are so pleased about. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Senate Republicans are considering making significant changes to President Trump's tax bill. Senators are looking into the potential impact of a so-called revenge tax buried in the fiscal package. The provision would increase tax rates for individuals and companies from countries whose tax policies the U.S. deems discriminatory. Meanwhile, China's manufacturing sector slumped the most since September 2022, according to a private survey. It fell to 48.3 in May from 50.4 in the prior month, well below the 50 mark, separating expansion from contraction. The results were far weaker than the official PMI reading released on Saturday. And the government in the Netherlands has collapsed. Far-right lawmaker Geert Wilders announced on social media that he's pulling his Freedom Party out of the country's ruling coalition because the three other main parties refused to agree to his plan to curb migration. This move forces the Netherlands into a snap election. Otherwise, the next vote wasn't scheduled for another 2 years. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Coming up next, looking for savings.
I want this to pass, but there's no reason that the Senate should just simply rubber stamp it when we can do so much better. I do think, though, by and large, it will look similar to the House bill, but we just may be able to find some other places for savings.
Rob Casey of Signum Global Advisors joining us next. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Coming back to a Tuesday with a little bit of losses, but this kind of feels like deja vu. It looks almost exactly where we were yesterday, except with dollar strength rather than dollar weakness. But what you can see is a little bit of weakness across the board, down about 0.4% on equity indices in the United States. Yesterday, we started the same way. We ended positive. Why? People buy the dip, and that is telling us something. That's something that Max Ettner underscored of HSBC this morning. Under surveillance this morning, looking for savings.
I want this to pass, but there's no reason that the Senate should just simply rubber stamp it when we can do so much better. I think it was interesting listening to the leader from the House say they don't think there's any way to find more savings, and I think that's really the thing we have to do. We will not be able to pass the bill without finding some more spending cuts. I do think, though, by and large, it will look similar to the House bill, but we just may be able to find some other places for savings.
Here's the latest. President Donald Trump trying to sway Republican holdouts on his one big, beautiful bill. Trump posting on Truth Social, I call on all of my Republican friends in the Senate and House to work as fast as they can to get this bill to my desk before the 4th of July. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, I want to start there. How much is there a sense that July 4th is getting further away, and some of these calls have to be made throughout the night even more so?
Yeah, hey, Lisa, good morning. Well, it's definitely an expedited timeline, but we can say that at least one senator, Senator Tom Tillis, a Republican from North Carolina, did tell reporters yesterday that the Senate is going to try to get a finalized package in the next 10 to 15 days over to the White House to review. Now, of course, a lot of different things actually need to happen as President Trump is dealing with conflicting demands from members of the Senate who say that they want to make the remark on this House bill. On one hand, you have a group emerging that is pitching themselves to be more fiscally conservative fiscal hawks, perhaps run by Senator Ron Johnson, a Republican from Wisconsin, who did have a call with President Trump yesterday and says he plans to meet with the White House's economic team. And at the heart of this is that Johnson says he wants to see deeper spending cuts, and he's also taken issue with claims that some of the tax priorities, like no taxes on tips or overtime pay, could really incentivize growth. But on the other hand, President Trump has to contend with those more moderate members who are raising concerns about really what's at the heart of the spending cuts, which are changes to benefit programs, including how quickly work requirements could be instituted when it comes to Medicaid, and also that the House plans to freeze the Medicaid provider tax and also shift some of that cost sharing on to states. President Trump doubled down in his post on Truth Social yesterday, saying that there would be no cuts ultimately to Medicaid, but we know there's a few different analysis out there, Lisa, including one cited here at Bloomberg News that projects about 7.7 million people by 2034 could ultimately lose benefit coverage because of shifting eligibility requirements.
Tyler Kendall of Bloomberg, thank you so much for being with us. Right now, Rob Casey of Signum Global Advisors here in studio. Rob, great to see you. I want to start there. How difficult is it going to be to get some of these Republican senators on board, given the fact that, as Anne-Marie said yesterday, they're all kings at a time of very slim margins?
Yeah, it's true. I mean, many of these senators, I think that the five that you all highlight are probably the five to watch. Many of them want to have their fingerprints on this bill, right? Generally speaking, the Senate sees the House as being an inferior legislative body, right? They want to write their own bills. They want to then force the House to vote for them. But in this case, there's only one king, I think, and that's President Donald Trump. He wants a one big beautiful bill. He wants it as soon as possible. I think July 4th is a really hard deadline to meet, but I think by the August recess, he's going to be able to have everybody coalesce around this bill like they did in the House.
You said there's one king. The one king put out a truth yesterday that said that it doesn't increase the deficit, that actually it does everything good and nothing bad, and that everything bad is a Democratic fiction. Do you think that there are enough Republican senators who will just take him on his word?
I mean, the short answer is yes. Will they take him at his word? No, they're all pretty smart, right? They can read a pretty simple math equation, which is that this is going to add to the deficit. The thing about senators like Ron Johnson, among others, is that, well, first of all, Donald Trump can lose 3 of them, right, and still pass this bill. So it's not to say every single one is going to vote for the reconciliation bill. The thing about these senators, though, is they want to get reelected, right? And maybe some of them aren't reelected for another 2, 4, 6 years, but they need Donald Trump in their corner between now and then. And so, frankly, I do think that they will listen to the president. They will make their tweaks, no doubt about it. But the president himself has said that he's okay with tweaks, right? He's okay with some changes. And I think that's him setting up, going back to the House, and saying, yes, the Senate made some changes, right? Maybe SALT's a little bit lower. Maybe the deficit expands a little bit further. You now have to eat this because we're in July, and I'm asking you to.
Rob, the focus is on future spending. It's on the bill. But I want to ask you a little bit about the rescission request that President Trump is sending to the Office of Management and Budget today, the one that's going to request for a $9.4 billion clawback on all that U.S. aid funding and public radio and broadcasting. Is that just the first of many to come, and will it be successful?
The first of many, I would say probably not. The truth of the matter is, right, we've sat around this table before for months talking about cuts, right? First it was Doge and Elon Musk. Second of all was all these cuts to Medicaid and to SNAP and things supposed to be included in this bill. Some of them certainly are. But I think the truth of the matter is that this Republican trifecta in Washington is learning what many trifectas in Washington have learned before, and that is there just aren't that many places to cut, right? And it's incredibly unpopular to cut. And so do we get this $10 billion rescission package? Yeah, I think it probably passes for the most part, right? There aren't that many Republicans out there who are going to defend, USAID, NPR, et cetera. These are their punching bags. But are we going to get a lot more of that? I think probably not.
Rob, we know where the cuts are coming from, the proposed cuts, that is Medicaid, state and local tax deductions, EPA, clean energy credits, et cetera. But I want to know, where are the new tax funds expected to go? I heard shipbuilding, I heard air traffic control. Talk to us a little bit about where taxpayer funds are going to be redirected in the new bill.
Absolutely. Well, I mean, obviously, if you listen to President Trump, if you listen to him on the campaign trail and listen to him today, he's talking about no tax on tips. He's talking about no tax on overtime. Those have been really pretty significantly narrowed by the House and the Senate. What we hear from the Hill is that, honestly, Congress people aren't incredibly enthused about those policies. They don't see them as being pro-growth, growth-driving policies. I think that makes sense to a lot of us. But they understand that that is what President Trump wants to, I was going to say wants to run on. President Trump isn't running for anything, but it sort of feels like he is, right? President Trump is always in campaign mode. And so those are what they're pointing to. And then, yeah, I mean, to your point, there are some sort of shifts away from some green investment, some, a green energy spending to what I think we would think of as slightly more traditional, infrastructure investment, energy spending. But that shift is not all that significant.
Rob, not to get too technical, but will we be talking about the Senate parliamentarian this summer? Meaning, could we see her review of this bill potentially delay its ability to get to that July 4th deadline?
We definitely will be talking about the parliamentarian, potentially a lot, right? So all of this has to pass, and this is unique to the House, unique to the Senate, not so much in the House. Everything has to have a budget impact, right? That's review for everybody here, everybody watching. But the truth of the matter is, a lot of these policies may not have a budget impact, right? You were just talking about Section 889. There's a huge question as to whether or not that is going to have an explicit impact on the budget one way or the other, right? And if it doesn't, the parliamentarian is going to say it can't be included in the bill. Now, Republicans have opened up the possibility that they're essentially going to not listen to the parliamentarian. They can do that. It's been done once before. I believe it was Senator Rockefeller at the time who didn't listen to the parliamentarian, moved forward with something, and then had to apologize about that profusely. But if you listen to Leader Thune, among others, there's a chance that they essentially go around the parliamentarian, and that is akin to breaking the filibuster, right? So that would be the nuclear option. It would certainly open the door for, Medicare for all the next time Democrats have a trifecta.
And you mentioned that the Senate version could add even more to the deficit. How much more as we think about the long end of the bond market?
Absolutely. Well, I think that is where these 5 Republicans in the Senate come in who are going to kind of constrain this spending. I think Ron Johnson in particular is probably the majority maker here, right? The 50th or the 51st vote. They are going to constrain the deficit expansion from here. I think maybe a couple of months ago, consensus was that the Senate was going to blow out a lot of these spending cuts. I think the truth of the matter is most of the spending cuts stay in at this point, right? So the bill, I mean, we heard Senator Kramer, the bill probably looks relatively similar to what we saw in the House. Maybe the Medicaid cuts are pushed back out in terms of timeline, but in terms of the actual policy, like the teeth of the policy, I think they remain relatively the same.
Rob Casey of Signum Global Advisors, thank you so much for being with us. I imagine you get a lot of phone calls because everyone's a congressional expert these days, no?
Yeah.
It seems like it. Rob Casey there of Signum Global Advisors. You raised a great question, Cameron, which is essentially what will the bond market pay attention to? And what will actually trigger that Liz Truss type of moment that we've heard about, or the cracks in the bond market, as Jamie Dimon warned over the weekend?
It's one thing for you to say it doesn't add to the deficit, but we can all see the numbers. And so really the bond market's reaction, we do think bond yields would be lower if it were not this bill being debated right now.
Well, I mean, I think it's more, I mean, look, again, you mentioned it a little bit earlier. It's about positioning, and it's about position size, and it's about magnitude, and we just don't have any color on that yet.
I love that we're going to be talking about the parliamentarian, and I love that everybody is whipping out their Congress history books and understanding exactly how it works. We're also whipping out our future books when it comes to artificial intelligence. Coming up, Matt Wood of PwC on whether AI is coming for your job. The answer, it depends what your job is. This is Bloomberg Surveillance.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
A bit softer this morning as we head to the open. We've got 3 hours until the opening bell, and you can see futures lower just a bit, but this really feels like deja vu. It feels like what we got yesterday, down 0.4%, pretty much across the board, although the mix is much better in the bond market with yields lower, and the dollar market strength, something we haven't seen very often. 3 hours away from the cash open, here are your morning movers with Yahira and Anand. Yahira.
Hi, Lisa. We start with the check on Disney and Microsoft shares. Both are slightly lower after announcing fresh job cuts yesterday. Microsoft laid off over 300 workers, adding to the 6,000 jobs it cut last month as it shifts toward artificial intelligence. Meanwhile, Disney cutting several hundred roles in its film and TV divisions, mirroring what's happening across Hollywood. They're scaling back production as traditional revenue models come under pressure. So both companies navigating major industry transitions, which of course have led to these job cuts. Next up, we have shares of JetBlue. Those are down more than 1% here after CEO Joanna Garrity clarified that their new partnership with United isn't a step toward a merger. She emphasized that after years of scrutiny from the Department of Justice, the company is playing it safe to avoid any regulatory issues. The reaction telling me here that maybe investors were hoping for a more transformative deal between the two companies. And last up, we have Bumble stock falling 5% here after JP Morgan hit it with a downgrade. The analyst saying the recent rally has gone too far, and with revenue and paying users expected to drop, they are setting a $5 price target on this stock. And the problem, they say, is that Gen Z is just not feeling the love with this app, which is the one where the woman messages first after matching. I wish Gen Z the best with their love life. Lisa?
Thank you so much, Yahira. Thank you for that. On our radar this morning, the Dutch government collapsing. Far-right leader Geert Wilders pulling his party out of the Netherlands ruling coalition. Joining us now is Bloomberg's Oliver Crook. Ollie, everyone talks about how Europe is the grown-up in the room. They're the one that actually has the cleaner shirt right now than the U.S. And now we have this. Please explain.
Yeah, flying a little bit in the face of the Sell America, Buy Europe concept that they're really trying to push the adults in the room. As you say, Lisa, this is really sort of the classic issue in Dutch politics, which is a question of immigration, a question of refugees, and that is what brought down the government about a year and a half ago. It took them about 7 months to pull together a government that now held for 11 months, and they just pulled the plug on it this morning. And it was pulled by Geert Wilders, who is the leader of the Freedom Party in the Netherlands. He is a sort of far-right candidate who's sort of very anti-Islam, very anti-immigration. And what he did is he went to the parliament with an ultimatum, 10-step program that he put before them. He said, listen, we need to get a majority of these 10 steps through in order to curb immigration. If we do not, I will pull the plug on the government. Some of these points were using the army to guard the Dutch border, turning away all asylum seekers, temporary halting family reunification, and sending Syrian refugees back to Syria, which he judges now a safe place. He said he was going to sleep on what he was going to do about it overnight. Then in the morning, 3 hours ago, he pulled the plug on the government. This is the biggest party in the Dutch parliament. So now the government has come down. They're going to convene in about 1 hour's time to discuss the next step. But what it will probably mean is an early election.
All right, Oliver Crook, thank you so much. Great reporting, as always. I'm sure we'll be coming back to you again throughout the day for other developments that have been going on throughout the continent, frankly. It has not been dull. Meanwhile, President Trump putting pressure on Republican senators to pass his tax package, making phone calls and posting on Truth Social that he wants that bill on his desk before the 4th of July. Damien, as a credit strategist extraordinaire, how closely are you watching all the details and dusting off your congressional description books?
Well, for me, it's all about recession probabilities, and I just can't understand, right? If we were running an effective tax rate here in the U.S. of 2.5% last year, and I think consensus is expecting it to go to something like 15 to 20% by the end of this year, that the recession probability in the U.S. isn't higher or isn't probable as opposed to non-probable. And so I think the markets haven't woken up to the reality that the hard data will definitely follow if these tariffs kick in after the 90-day window.
The challenge is that there's so much of a lag here. We're going to get the inflation portion first, and then we'll possibly see the impact to the jobs market and to demand. So we've seen about 100 basis points come out of 2025 GDP estimates to about 1.4%. Is there further downside from there? I think is the question that we'll be answering as we go through the summer.
Speaking about tariffs, the White House saying President Trump and President Xi speaking potentially this week. We've heard this before. Both sides have accused each other of violating their trade agreement. Beijing has yet to publicly comment on potential talks. It just raises a question about whether this impasse is something that can be closed, Damien, or whether people have gotten overly complacent that they can put this particular story on the back burner.
Well, I mean, when you see the Chinese Navy circumnavigating Australia and doing live fire exercises in their EEZ, and then you see the U.S. responding by sending its own frigates through the Taiwanese Strait, I mean, the answer to me would be no. I mean, I don't see any real, any sort of agreement being reached in the near term. I think that's what the market needs to see here in order for it to snap back.
Is he being too pessimistic?
Well, we do think that it's like Trump is singing Carly Rae Jepsen, Call Me Maybe, to Xi, because he's just, we have all this intention that we're going to have discussions, but there's no discussions happening, which just means that for all the promises of deals that are going to happen, you've just seen no progress. So again, we wait through the summer to get that muddle through.
Cameron, do you have like a playlist that you go through
100%.
and you basically try to glean inspiration for all of your notes?
Yes, welcome to the Free Association.
Okay, yes, and today was a bit of Prince, and yesterday maybe a bit of Taylor Swift. Right now, let's get to some news just crossing the Bloomberg. Meta signing a 20-year contract with Constellation Energy to buy power from an Illinois nuclear plant. More evidence of technology companies' appetite for energy to run data centers and AI as the promise of that technology potentially transforms the world we live in. PwC out with its 2025 AI jobs barometer, which shows a link between AI adoption and productivity growth. Matt Wood of PwC joins us now. And Matt, you're answering the questions that a lot of people have been asking, which is basically how many of us are going to lose our jobs and become irrelevant because of some of this new technology?
Well, it's looking like right now, none of us. In fact, counterintuitively, the number of jobs and the wages associated to them are actually going up, not going down. So we looked at over 1 billion job postings globally from 24 different countries, and we found that for organizations, whether they were advanced in their AI use or early in their AI use, they had more job postings than they had before. We found that the productivity of people working inside those organizations was up. We found that the revenue generation for those workers was 3x higher than it's ever been before, and that the wages associated with those workers were also going up. And so it's a little counterintuitive to what maybe some other folks are seeing, but our barometer shows a very, very different picture.
A really optimistic look for people who have the tools, have the capability of using artificial intelligence and machine learning to actually become more efficient, become more relevant at a time where Microsoft is cutting hundreds of jobs because a number of people currently in their roles can be replaced by artificial intelligence. How messy could this transition be? Because even though there are some people who get paid more, be more productive, and be more in demand if they have those skills, there are going to be even more people potentially who lag behind that and can't catch up quickly enough.
Well, for sure, the way that we are going to work is going to change. And for those organizations that are furthest ahead on the AI journey, the skills are changing the fastest. And this is a very humane problem. This is not a technical problem. This is a problem that we have to work through with all of our workers, with all of our staff. And as leaders, we need to make really sure that we're investing to make sure that all of our workers in every industry have the access to the skills and the education and the upskilling to be able to take advantage of this dramatic productivity gain.
Matt, the courts are going they just gave Donald Trump approval to take away 500,000 visas here in the U.S. What impact is that going to have on the AI sector?
Well, education is a remarkably vibrant place for AI to not just be used, but also to be created. Right. AI is very, very, very early, and a lot of the research that we need to do to advance the state of the art is going to come out of those sorts of organizations, those sort of institutions. Super important that they remain funded and remain active.
Well, Matt, let's talk data centers for a second because we got this big news in the market with Meta. I've seen some statistics that last year, for the full year 2024 here in the U.S., data center build-out accounted for roughly or more than 80% of the entire U.S. economy's capital expenditures for the full year. First we had Microsoft scaling back its plans following DeepSeek. Now we have Meta, buying or leasing a nuclear plant. Who are today's investors? Who's going to provide the long-term takeout capital for these data centers after all is said and done here?
Well, data centers are super interesting because they're not just data centers. It's actually more of a full vertically integrated stack of investment that covers just an entirely new ecosystem that is being built out across industries because of AI. So if you think of just the real estate that those data centers have to sit on, the energy infrastructure that has to surround those data centers, the data centers themselves with all of their disks and their GPUs and all of the infrastructure required to house and cool them. Then you've got the large language models that sit inside that infrastructure. You've got the applications that sit on top of those large language models. So there's a full ecosystem that bleeds from real estate to energy to computer science to big tech, which just didn't exist before. And this blurring of industries into new ecosystems is happening around data centers because of AI, and I think we expect to see it across multiple different industries going forward.
Given the massive investment we've seen from all these companies into AI infrastructure, how are you thinking about monetization? Mostly as you've seen competition pick up, what will the returns look like for all of this investment?
I think it's an interesting question. I don't personally see it as an investment that most organizations should be seeking a return from today. AI is more like intellectual infrastructure for your organization. We don't look at internet access inside an organization and say, hey, what's the return on investment of my bandwidth? Instead, you say, well, all of my work is done in a completely different way and in a much more efficient way and a much more productive way, 3 times more productive in the case of AI. What is the impact of not doing that? And so you see very, very few organizations today that don't enable broad, fast internet access to their organizations and to their teams. We'll see the same thing with AI. Most organizations will want for upskilling and retention and for hiring the very best people and keeping productive the people they've already got. They're going to want the most robust AI intellectual infrastructure inside their organization, similar to networking.
How advanced have companies been in the U.S. at adapting to some of these new tools, given the fact that it is quickly evolving? The bigger have an advantage with respect to data, with respect to resources. How much is this really bifurcated, the sphere from big to small companies?
It's not so much big to small. It's actually, again, a little counterintuitive. So those organizations that we see moving the quickest are actually the regulated industries. So financial services, insurance, healthcare, manufacturing, those sorts of domains where the compliance with the regulations around that they've had to live with for the past 20 years and maybe have felt like a bit of a headwind, particularly around data governance and data quality. Those are all the things that you need to get right to be successful in artificial intelligence. And so whilst that headwind has been there, it's actually driven all the right investments for those organizations to be successful with artificial intelligence. And as a result, the AI piece is just a small incremental lift on top of that. And they're able to move much more quickly.
Matt Wood of PwC, thank you so much for being with us.
You're welcome.
Really interesting. And you raised a great question, Cameron, which is essentially how much can shareholders expect to get this back in their pockets?
We also know that a lot of these companies have massive margins on their legacy businesses. They're near monopoly businesses. So as they're investing in areas that have far more competition, do we see the total ROICs for these hyperscalers, for these Mag 7 names actually come down? And how will investors digest that?
Especially given the fact that it has to be a flip to the equal weight versus the NASDAQ, which is what a lot of people have been arguing, that if you get this adoption, you could see a bigger benefit through the rest of the S&P.
Well, Lisa, you know, if you just look at the experience of companies like NuScale and TerraPower, these next-gen nuclear reactors require a 10-year build-out. So just when exactly is this going to be up and running for Meta? And when, I mean, I was under the impression that, you know, nuclear was going to miss the whole AI boom, but maybe I'm wrong.
We shall see. Right now, let's get a check on what else is going on around the world. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Russia and Ukraine held a second round of talks in Istanbul yesterday, but failed to reach a peace agreement, though the two sides did lay the groundwork for a new prisoner swap. Russia presented peace proposals that include Ukraine surrendering control of territory in 4 partially occupied regions, while Ukraine demanded an unconditional truce and proposed another meeting later this month. Meanwhile, Commerce Secretary Howard Lutnick says he expects the U.S. and India to strike a trade agreement before higher tariffs kick in on July 9th. He says President Trump's strong personal relationship with Indian Prime Minister Narendra Modi has made an easier path to trade negotiations with that country. And Toyota Industries said it received a $33 billion offer to take the company private. The deal will involve a tender offer for the shares of a supplier of textile looms, forklifts, and parts for Toyota Motors cars. A new holding company will be established to privatize Toyota Industries, according to the company, which says it plans to make an official decision today. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Coming up next, resetting U.S.-China relations.
It has been a whirlwind, I think, in the U.S.-China space. President Trump, of course, has sent some mixed messages around what he expects and hopes from China. I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China.
Coming up next, Leland Miller of China Beige Book, who will talk about not only what that relationship could look like, but some of the economic data we've been getting that kind of conflicts with itself from China. This is Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Just a touch softer today after yesterday's bounce, which really was, I think, the notable takeaway. Question will be whether we can repeat that today. Right now, down across the board, but not by much, considering the gains that we've seen after the biggest May return for a year, going back to 1990. Right now, under surveillance this morning, resetting U.S.-China relations.
It has been a whirlwind, I think, in the U.S.-China space. The very baseline issues between the two nations remain very much in place, even though domestic pressure forced both sides to bring those tariffs down. President Trump, of course, has sent some mixed messages around what he expects and hopes from China. I do think his long-term goal here is to reset the relationship with China, but to continue to have an economic relationship with China.
Here's the latest. The White House saying President Trump and Chinese President Xi Jinping will speak later this week week after both sides accused each other of violating last month's trade agreement. Joining us now is someone with tons of context, both when it comes to strategy as well as when it comes to the economy in China. Leland Miller of the China Beige Book. Leland, great to see you. Thank you for being here. I want to start with this question of what is at stake in order to even get a phone call between Xi Jinping and Donald Trump, something that we've heard a couple times before, but that, from what we understand, hasn't yet happened.
A phone call should be very easy, but I think the reality is that the Chinese side is very skeptical that the U.S. side will keep whatever commitments that it asks for, and that it will convey exactly what it wants, and that it will have a point person that will be able to have the authority to be able to make a deal for what for whatever the U.S. side wants. So, a call is easy, a meeting is easy. There's nothing that you really have to give away in order to do that. But I think that in Beijing right now, there's a worry that if they come to the table and President Xi looks bad, then this will be a net negative for the relationship and for China's leverage. So they're holding off on that until they think that they have a better hand. We'll see if it happens this week.
Leland, the renminbi is up 1.5% this year versus the dollar, yet it's fallen in each of the last 3 years. I had a number of friends in attendance at the JP Morgan Global China Summit last week, and they all came away with this bias toward a weaker dollar. Does that mean a weaker dollar relative to the yuan?
Well, the dollar and the yuan are tied very closely together. I mean, we pretend like the yuan is a free-floating currency. It's not. It's pegged to the dollar. So if you have a weaker dollar, you're going to have pressure on the yuan to fall. But I think that China will want to keep it a little bit up relative to that because their bias is for a little bit of upside appreciation in a falling dollar world. So, yeah, if you have reciprocal tariffs and the U.S.-China relationship and all these other things weighing on the dollar and the dollar's falling, then the yuan will be pulled down a little bit, but they'll want to have a little bit of an upward bias from it. So yeah, you should expect some mild, modest upward appreciation in a falling dollar world.
Leland, it was only a few years ago when multinationals claimed that they couldn't afford to pull out of China, given the economy's size, its overall influence. What are your thoughts on China as an investment destination? From the perspective of a U.S. institutional investor, is China investable now?
Well, I think you made a nice distinction between institutional investors and those companies that are in there with hard assets and a presence throughout China. Very difficult to extricate themselves at that point. If you're an institutional investor and you're looking at China, then you have to be asking yourself, what edge do I have here? Am I just waiting for this ridiculous thesis of things have been down for 11 years, but now they're going to bounce back in the stock market? Do you have an edge in a technology sector, but that's going to be closed off by export controls or by tariffs in the near future? It's not impossible to trade in China, but it's getting very dangerous. And most of the people who have traditionally done this have done this very lackadaisically. They look at Chinese data. They've got a DC consultant that tells them a little bit about China, and then they buy a bunch of Chinese tech companies. You can't do that anymore. So if you're still in China, then you better have a tremendous edge in terms of investing there.
Leland, the Chinese 10-year rate is a mere 1.7%, near multi-decade lows. Is there any signal to take from that about underlying Chinese economic health, mostly as we consider the rest of the world where long-end yields are screaming higher?
Yeah, absolutely. There is a signal. If you look at our credit data, China Beige Book credit data, it's remarkable what's happening on the monetary easing side. I mean, we've seen rates continue to go down, 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 down. And this is a time in which there's elevated inflation elsewhere. So what they're trying to do is, on the fiscal front, they're manning arming the cannons. On the monetary side, they continue to cut rates. There's a downside to doing that because you're hitting the profitability of banks and you're hurting savers. But right now, they're just trying to keep the economy going during the early onset of these trade tensions, trade war 2.0. So they're cutting rates, but it has a lot of detrimental effect, downstream in the economy.
How much fiscal firepower do you think that China has? There seems to be an assumption that China has a lot more room than other countries around the world. Is that the case?
It is the case. What's interesting is that for several years, while every headline, we'd see every day was, China stimulus, promising stimulus, pledging stimulus, it was never happening in 2022, 23, 24. We got to the very end of 2024 and early 2025. We have a fiscal activity index that showed significant things were happening and a significant borrowing and bond issuance by transportation construction firms. So they were really getting ready for what might be a real downside scenario. we've seen that ebb off a little bit. So we have not seen the blast to any type of cannon, but they are preparing in a way very differently than they did the last 3 years. This should have been expected. China does not want to do big stimulus. But at the end of the day, they're going to have to batten down the hatches of their economy if they get in a larger trade tiff with the United States.
Which is the reason why, Leland, and I think that all of us are trying to get at the ultimate question, which is who has the most leverage, who's in the better position economically right now as the U.S. and China go head-to-head. We got this data overnight that China's private factory gauge plunged the weakest going back to 2022. It went against some of the official data. Some people are saying it's messier, it's a smaller sample size. Do you think that China is hurting more or the U.S. is hurting more? Is it possible to even make that equation?
Well, look, first on the Caixin survey, I mean, we agree with the official data here. We're much, much bigger than survey a lot more companies than Caixin does. And we actually saw an improvement in manufacturing activity. Not great. It's down from a year ago, but it's up from the lows that we've seen the last couple of months. So there's something there. There's a lot more resilience, both in the consumption side, which is surprising, and the manufacturing side, which is not, in China right now. So I would take that away from the economic data. So I think at this point, look, we have to be watching the data closely, but also keeping in mind that China is looking a little bit more resilient than we thought going into the Geneva talks and beyond.
Leland Miller of China Beige Book, thank you so much for your insights. Really helpful and interesting that the official data is more accurate in this case, according to Leland Miller, than the private factory gauge. Cameron, I'm going to ask you the question that Damien asked, which is China uninvestable, or do you feel like there are sections that you like because of that potential impetus from fiscal?
We've been finding a lot of opportunities within China, mostly on the tech side, where they trade at such massive discounts to what we see within the U.S. But we have to keep in mind that there's just a lot more volatility, a lot more uncertainty in investing in some of these companies, which is reflected in those huge discounts that they've been trading at.
Well, I thought you asked a great question. Brilliant. Talking about rate differentials between the U.S. and China, I'll give you this one. China and Japan, that 10-year is only 17 bips differential right now. I mean, China is new Japan.
Well, maybe Cameron can find a song that represents that the next time that she's on. Cameron Dawson, hopefully it will be soon, because it was really wonderful to have you. Cameron Dawson, thank you so much, of New Edge. Coming up next, Chris Harvey of Wells Fargo, Henrietta Trays of Veda Partners, Marriott International CEO Tony Capuano, and Jason Draho of UBS. A real question here about the consumer heading into the summer. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Kickstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The economy is still, as of now, fairly resilient.
You still have a bigger growth engine in the U.S. than you have in most of the other parts of the world.
The gap between the what people call the soft data and the hard data has been pretty dramatic over the last few months.
It's just really hard to read the data right now.
The markets haven't really had to come to grips with the idea that the economy might be slowing.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to the second day of the trading day. President Trump back in D.C., and now everyone is focused on what the U.S. budget will look like, given the fact that he is making the rounds, calling, whipping, trying to get votes to get the Senate on his side. Meanwhile, we are expecting some sort of call between Xi Jinping and President Trump as that truce potentially starts to fall apart. And this comes as we still try to understand what the data means. We get, of course, job openings today. We get some factory orders data. We get some other ADP data tomorrow. Then, of course, we get that key non-farm payrolls report. Damian Sassower, so glad that you're still with us here today in the seat.
Thanks for having me.
I'm curious about whether this economic data on Friday actually is going to be the market mover, given the fact that very much front and center seems to be the deficit, seems to be a whole host of other policy considerations.
Well, I mean, you're looking ahead to Friday. I'm just trying to get through today. We've got durables. We've got auto sales. Auto sales are going to fall off a cliff this afternoon, probably. So, to your point, yeah, the payroll data definitely matters, but I think it's all about magnitude. Do you think that growth in the U.S. is going to slow off the back of this? Yeah, probably, but what magnitude? You think inflation is going to pick up due to tariffs? Yeah, probably, but what magnitude? So we're talking about magnitude here.
It seems like everything needs to get done all at once, right? That seems to be the way that it has been going in Washington, D.C. for a while. Right now, the focus for the bond market very much has been squarely on the budget and what's going to happen with the deficit, given the fact that there are concerns about bond vigilantes and whether this fiscal overhang is going to be unsustainable. How much do you believe that actually is what's driving the bond market versus just a lack of liquidity, a lack of conviction, and the back and forth about whether we actually will see expansion and whether we can take recession off the table?
Well, look at who plays in the 30-year, right? I mean, these are basically lifers. These are pension funds. It's not a very big, deep investor community, and that goes for Europe and Japan as well. I mean, in Europe, Euro swaps, I mean, it's all pension schemes. It's the Dutch. So, to your point, I agree with you. I think it's positioning. I think it's finding a clearing price for these bonds that not a lot of people want to own.
Meanwhile, right now, what we're looking at is people actually finding bonds that they like. You are seeing a bid into bonds, which is different than what we saw yesterday. You're not seeing as much of that positive feel in stocks. If you take a look, equities just a little bit lower, even though you do see bond yields lower. This is a correlation people want to be seeing, and this comes on the heels of an auction in Japan that went better than expected. It was a 10-year auction that actually had pretty good participation that came, Damien, after an adjustment by authorities in Japan, particularly the Bank of Japan, saying that maybe they would stop rolling off their balance sheet. In other words, maybe we'll just observe a little bit more of that to prevent some of this shakiness that we've seen in the bond market.
Well, I think the BOJ did the right thing last week in going to the market and asking them what their thoughts are. That just shows an openness and a lack of, just a transparency that you didn't see previously. So I think, look, the market is trying to come to terms with, where is that clearing price for the long end of all these curves? Where is term premia going to settle in here, not just in the U.S. but abroad.
The market is trying to grapple with how to get to summer vacation at a time when it seems like there is always a new narrative to be held. Coming up, we've got Chris Harvey of Wells Fargo as markets are whipsawed by everything, renewed trade concerns in particular. Henrietta Trey's of Veda Partners as the White House pushes for a call with Chinese President Xi and Marriott International CEO Tony Capuano on the outlook for summer travel, which we want to get to. We begin this hour with stocks lower, given back tech-fueled gains as trade uncertainty weighs on investors. Chris Harvey of Wells Fargo staying bullish, writing tariff risks, both in terms of the news flow and actual effects on consumer spending, are priced in, if not overstated. And with Fed easing on schedule, we see a constructive second half for equities. Chris joins us now. Chris, wonderful to have you. Thank you so much for being here.
Good to be back.
So the positive spin on this is that you do believe that there is not going to be some sort of inflationary wave from the tariffs and that Fed cutting is squarely on the table. Why is that good for equities if it potentially could come on the heels of some weakness?
It's good for equities. Well, lower rates, the Fed getting in motion is generally good for equities as long as it's outside a recession. And I don't see a recession, right? Credit spreads are still incredibly tight. If you look at the consumer, we can argue about how strong the consumer is, but the consumer is holding up pretty well. And when we look into the second half of this year, one of the things we haven't seen is really the positive effect of the change in regulation. We'll start to see that with a stress test. The other thing is M&A activity has been very muted. We've had a massive repricing here. The secular AI trade is out there, and it's going strong. I think the AI Diffusion Act, or the mitigation of the AI Diffusion Act, is still understated. And if we look at the consumer, right, if we really stretch, right, maybe 20% of what tariffs touch, the consumer spends on. And if we add 10, maybe 15% of that, and we assume that all of that, you're not looking at a big upward move in spending or a big hurdle for the U.S. consumer. And the U.S. consumer is very, very savvy. They're going to shift around their basket. They're going to look for where they find utility. And tariffs at this point in time, I think, are just overstated. The fear is more important than the fact, right? When I talk to people about fundamentals, they're like, yeah, fundamentals are actually pretty good. The soft data, we're really discounting the soft data because when we look at the prediction markets, they're telling us something else. When we look at the hard data, it's hard to find a really difficult story. And so people are afraid to be bullish, I think. But when they look at the fundamentals, it's hard for them to say, yeah, there's a recession looming. Hey, job cuts are looming, and the wheels are about to fall off the cart.
I hear you, and it seems like a lot of people believe that. HSBC's Max Kettner came out this morning and said, look, you see the buy the dip again, and it just highlights the strength that you've seen in the market. The pushback that I would say is the ISM manufacturing survey yesterday. Some of the commentary that we heard, this from the electrical equipment, appliances, and components sector. The administration's tariffs alone have created supply chain disruptions rivaling that of COVID-19. Then you have an unresolved trade deal with China will result in empty shelves at retail for many do-it-yourselves and professional goods. This according to the paper products industry. How do you fully discount that?
No, don't fully discount it, but the thing that we have to watch, and I think that's most important, is will we make progress over the next couple of weeks on trading tariff? Will we have something from India, from Japan, maybe from the EU, North America? And if we do, you can start to look through a lot of that information. If we don't, then yes, things will start to come down to roost. We may get a lot more volatility, and you have to grit your teeth a little bit. But ultimately, I think we're making progress on trade and tariff, and I think we will continue to make progress on trade and tariff. And if so, you can start to look through that.
Chris, where do you and the team at Wells Fargo stand on where the U.S. effective tariff rate is going to be by the end of this year?
So we're thinking somewhere in 12 to 15%.
Okay.
I'm a little.
And that's not going to stoke a recession here in the U.S.?
I don't think so.
Okay.
I don't
Interesting.
think so. Right? I'm closer to 10. Like my philosophy coming in here was we should have just put a 10% tariff on everything across the board. They had Congress, they should have mandated it. Everyone understands the seller's fee, whether you pay that through Airbnb or the New York Stock Exchange or Amazon, right? That was easy to sell. The unintended consequences weren't as big as what we're doing right now. But if you get to 10%, think about it this way. A third is eaten by the exporter, a third is eaten by the corporation, a third is eaten by the consumer. That's fine.
So margins, corporate margins, the pass-through of these price increases onto the U.S. consumer, you think the corporates here in the U.S. are going to be successful in pulling that off?
So when we talk about corporates, right, what we're talking about a lot of times now is we're very positive or constructive on the AI trade, right? And if you're tied to CapEx and CapEx spend, it's a much different story than if you're tied to consumer and consumer spend. And so you can't just say corporates across the board. Right. If you're tied to the consumer, yes, there are certain companies, and if you look at some of the general merchandisers, it's been a little bit tough, right? If you look at some of the tech companies, not so tough, right? And our analysts have done a lot of work on data centers and what would happen to data centers if the tariffs stay in place. And the cost to data centers is actually 5% or less for building a new data center, and that's just not prohibitive in any way, shape, or form.
So we expect U.S. equities to rally through the end of this year, or maybe not, and certainly not in a linear fashion, but, just take me through the fact of which sectors are going to do the heavy lifting there. I mean, you talk about AI, I imagine you think it's going to be technology again.
We think it's going to be technology. We think it's going to be more your growth companies. If you look at the AI trade, it is a very robust, secular, U.S.-centric trade. And what is the S&P 500? S&P 500 is a growth index, right? I've been talking to people, recently people have been talking to me about mid caps and small caps and so on and so forth. And I think eventually they can work, but you need the Fed to get in motion. You need the Fed to start cutting rates. But if you look at the broader market is really driven by growth in technology, and growth in technology is okay right now. Actually, not bad.
So what's the risk event for you?
I don't like this whole taco thing that's being thrown about, and I don't think it's on deaf ears, right? So Trump doesn't want to be seen as weak; he wants to be seen as strong. So does he go out of his way to say, no, that's not happening, right? That's a concern, and that's a concern to other people. The concern is, hey, can rates go higher? Sure, rates can go higher, but I think the real concern is what we've been talking about or implying. If you don't know, you know. If at the end of June we still don't know what's happening when trade and tariff, then you have to start making some of those hard decisions. And that's the big risk. Because if you don't know, then I know that I need to start tightening the belt. I know I need to start bringing down costs. I know I need to start looking at labor, and that will start to cascade.
It's in June, so is the range getting a lot wider given the fact that you could have both of these things, especially given the Reuters report overnight talking about how there was a memo drafted to send out to all the trade partners today by the U.S. saying, hey, we want your best deals and we want them today?
Yeah, I think time is of the essence. Obviously, we've all seen what's happened with the VIX and volatility in the equity markets this year. This will not be a calm market. The market is expecting some sort of resolution or some sort of progress. If they don't get that progress and we go the opposite way and we start putting in more and more tariffs and not making progress, we're going to have a problem. So is the range of outcomes large? Yes, it's large. How do you handicap that? That's a much different conversation or question.
Have we learned anything in the past couple of weeks that has changed your allocations in any material way?
Have we learned anything?
In the sense of anything concrete.
That's a loaded question. No. Well, I pose this to a bunch of people. If you knew today, if we rolled the clock back to the beginning of the year, and you know what you know today, what would you think the market would look like? What would you think the economy would look like? And most people said, I would have thought the economy would be in much worse shape. The economy is much better shape than people think, given what we have right here, right now. So what we've learned is U.S. economy is still robust. Some people think, and I think it's fair, right? There's a lag effect to trade and tariff, and maybe we'll see that. But ultimately, if we get that, not resolution, but if we get that progress, you can start looking through it. If you don't get that progress, really tough to look through it.
A really important month, and I'm so glad that you're going to be with us. Chris Harvey of Wells Fargo will be with us throughout the hour. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Shares of Constellation Energy are surging more than 14% in the pre-market after it agreed to sell power from an operating Illinois nuclear plant to Meta Platforms starting in mid-2027. The deal could spur construction of a new reactor at the site as AI sends power demand soaring. Meanwhile, new details are emerging about the suspect in this weekend's attack in Boulder, Colorado. The FBI identified him as Mohammed Sabri Solomon, who came to the U.S. in 2022. On Sunday, he brought flowers and disguised himself as a gardener in an orange vest so he could get as close as possible to members of the Jewish group before attacking them with incendiary devices. And Elon Musk is selling $5 billion in debt for his AI startup, xAI. It's the latest in a series of fundraising efforts across his business empire. Morgan Stanley is set to be shopping the debt. Musk has also raised $650 million for Neuralink and is selling $300 million in XAI stock through a secondary offering. He's so busy. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. Maybe that's the good kind of deal making for a lot of these banks. A big question about whether it will pick back up in the second half of the year. Up next, pushing for a deal.
President Trump has talked about wanting to meet with President Xi. Has that call been scheduled?
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls.
Henrietta Trey's of Veda Partners joining us next. This is Bloomberg Surveillance.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
This market looks like it's going down, but it is not one that likes to end the day down. And what we're seeing right now is some of those losses getting clawed back as time goes on, which seems to be very much what we have been seeing over the past few trading sessions. The Nasdaq now down just 0.1%, the Russell 2000 almost flat, and S&P futures lower by 0.25%, which you can see in the bond space. And this is notable. Yields lower, and it is on the heels of Japan. It seems like Japan, Damien, is driving everything this morning.
Well, I wouldn't say everything, but if you look at the global ag, and most people don't realize this is the benchmark Bloomberg Global Aggregate Bond Index. It's up 5.5% this year, and the reason is most of those bonds are non-dollar denominated. So forget about the declining dollar and all the currency risk that's embedded within that index. Your bond portfolios, if you're diversified, are doing well.
Well, maybe not, though, if you're in the U.S., and that's a real question when it comes to some of the fiscal considerations. Under surveillance this morning, pushing for a deal.
President Trump has talked about wanting to meet with President Xi. Has that call been scheduled?
I can confirm that the two leaders will likely talk this week. And as always, when there are foreign leader calls, we will provide a readout of those calls. The European Union came to the table thanks to President Trump's threat of tariffs. And now we are seeing that they are negotiating in good faith with our delegation. As you know, we are in discussions with many other countries around the world as well who understand the need to cut a good deal with this president and the administration.
Here's the latest. Reuters reporting that the Trump administration is urging countries to make their best trade offers by tomorrow. This comes after the White House says Trump will likely speak with Chinese President Xi Jinping later this week. Bloomberg's Tyler Kendall joins us from Washington. This as we hear about a trade deal with India potentially to be announced in the next few days. What do we know about the state of play, about all these deals that are being made?
Yeah, hey, Lisa. Well, it does appear that the White House wants to show some sort of forward progress after we really haven't gotten any sort of update since that agreement framework that was reached with the United Kingdom. And perhaps we're getting some clues as to why. We heard from NEC Director Kevin Hassett, who has previously said that deals really are imminent, say that ultimately China has been the, quote, laser beam of this administration's focus. And perhaps that's taken away some of the momentum towards other deals. Now, amid this Reuters report, we should say that it has, according to the reporting, has asked these other countries to come forward and put up basically their best offer, which of course would include a lowering tariffs, but also boosting some U.S. goods. We know that U.S. LNG and agriculture has long been a priority of this White House, and then how they're going to address those non-tariff barriers, which this White House has really been pushing, needs to be at the forefront of any conversation going forward here. Now, at the moment, Lisa, we still aren't quite sure exactly what sort of concrete details we are going to get. Of course, the U.S. is under active negotiations with those countries that have been prioritized, that are geographically close to China, such as Japan and India, with Howard Lutnick saying that he's optimistic a deal could be reached before that 90-day pause is up. And then also the European Union, which we know has sort of had this fire lit under it to try to get some sort of deal soon.
Bloomberg's Tyler Kendall, thank you so much, as always. And we'll be tracking the progress throughout the morning. Joining us now, Henrietta Trace of Veda Partners. Henrietta, I'm wondering why the market isn't paying more attention to this. In particular, that Reuters story talking about how there could be a deadline in the sense that maybe there's a level of impatience as there aren't as many deals that have come to the fore as some had expected.
Right. We're at 0 deals in 60 days, and we need to get to 90 deals in 90 days. So I think the market is doing exactly what it did for the entirety of 2024. It's continuing to sort of trust in Trump. I hear it from crawfish boils to calls with clients. People are saying, well, it could happen, and that's precisely what the administration's comms team delivers. When Caroline Leavitt says, I will tell you with certainty that there might be a call, that obviously suggests that there may or may not be a call. The biggest problem really is that most nations don't know what President Trump wants. So the biggest news item, and as you point out from Reuters this morning, is that USTR is saying, hey, bring us your best offer. And that's because the president has told us he's going to be sending letters instructing roughly 100 nations as to what their go-forward tariff rate is, and he needs an excuse to bring those rates down. If you're going to put 50% tariffs on a nation that does $293 million worth of trade with the United States, that's nonsensical. You do need a reason to put them at a much lower rate. And I think that's what the White House is searching for, a reason to lower rates and avoid the July 9th Liberation Day implementation.
Henrietta, you're down in New Orleans. I'm up here in New York City, but up in Westchester County, the residential real estate market, we like to call that going to highest and best. Let me ask you something. Going to highest and best, all cash, no contingencies, is that the right way to run trade negotiations with your trade partners?
It's funny, I'm actually from Westchester, so this is great for me. The highest and best idea is, come to the White House with anything. So what we're going to see, I'll point to the EU because I think that's one of the most important ones, and it's one that I think has the most risk for higher tariff rates, all the way up to the 20% Liberation Day rate, for example, is that we want to do agriculture trade with the EU. We want to have genetically modified poultry go to the EU. If you go to the EU and ask them if that's acceptable to their population, they will tell you no. Those political operatives will pay a price in Brussels should they agree to those trade terms. And that's the same thing we're seeing in Japan and South Korea as they face voters. And so the biggest question we have is it a good thing for nations to negotiate with President Trump, or is it seen as weakness on the part of their leaders? Australia and Canada would suggest that the strategy of being tough with Trump and coming with an offer, but not something that capitulates and gives away your national protected resources like agriculture trade, is really where folks stand. And that is, of course, the story of trade going back to the beginning of humanity. Everybody wins or everybody loses.
I want to link what we're talking about to what Chris Harvey, who's here with us this morning, just was talking about, that he's worried about the taco stuff, which is the Trump always chickens out kind of framing. Whether that's irked the president enough to say, okay, I'm going to take a hard line and go through with some of this. Do you get the sense that that actually is something that's increasingly on the table with some of this demand for the best offers by the end of today?
I think the taco stuff, if we're going to play what's your emotional response in the White House, then, that's a question for a therapist, I think, not for an economist. But what I do think, and I lived through the first trade war, is that there are very emotional responses and reactions that happen in the blink of an eye in the Oval Office. I remember them viscerally, and I can tell you exactly where I was, sort of like people can say, where were you when JFK got shot? I can tell you where I was when the List 3 tariffs went on. Those are a very big sort of knee-jerk reaction. The impulsiveness of this administration is a holdover from the first term. So I don't see this as new. If he's bothered by, you know, investors calling him Taco, I mean, get used to it. That's what Wall Street's like.
Henrietta, I have a question, right? So it sounds like you're not so optimistic on deals getting done in the short term. Paint us a picture. What do you think is going to happen between now and the end of June?
Sure. I think that we're going to get increased Section 232 tariffs. Specifically, I'm most concerned about pharmaceuticals, lumber, which is obviously critical for the housing market, including up in Westchester. I'm expecting Section 301 tariffs to rise. I'm getting a lot of questions from clients right now about the actual process. How many days does it take to conduct an investigation? How many days does the president need to notify the Federal Register or Congress or collect comments? And it's specific, you know, 270, 90, 15-day delineations. And all of those are optional. The president has the authority to escalate Section 232 tariffs on steel, aluminum, automobiles, and automobile parts as it stands today. In the works are about 7 other items that will all see tariffs as he sees fit. All that Commerce needs to do is publish those reports. And then we have the Section 301 tariffs, which are, of course, covering all of our trade, $550 billion worth of goods with China. So I think what I'm seeing from investors in Wall Street is a focus away from sort of the macro, what's the global tariff rate, which I think is not a relevant conversation in this sort of questioning IEEPA space, but what sectors are going to be targeted. And so that's where I'm spending my time. I think that's where folks need to concentrate. All of China is exposed, and then pharma, semiconductors, et cetera.
Henrietta Trey's of Vita Partners, thank you so much. We saw this not so long ago with the auto sector, right? I mean, Chris, at a certain point, we saw that with respect to, is Ford and GM investable if they could potentially be in the crosshairs of all of these tariffs?
That's right. And the big concern is, does Lutnick come on and say, hey, we're going to roll out the electronic tariffs? Because that has big ramifications for a very important sector, the tech sector, be it the iPhone market, semiconductors, what have you. And so that has broad-reaching effects, and that's a concern.
You know, I have to say with Henrietta, I know she's focused on the sectors, but I'm an emerging markets guy, and so I focus on the countries impacted. And I take your point, you know, is India ready to do a deal? Is Japan ready to do a deal? If one is announced, just how quickly will the rest follow? Are they going to be like dominoes, or is this going to be a long, drawn-out experience?
And who feels like they have the actual leverage at a time where right now it had been that maybe the rest of the world would have the real pain. Now it seems like that's being turned on its head, at least so far in trading action. Coming up next, we'll find out about summer vacation and who's taking it. Marriott International CEO Tony Capuano on the outlook for summer travel, which should be happening. This is Bloomberg Surveillance.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Coming into the second day of the trading week, we have 2 hours to go before the opening bell. We have that bit of softness across the board, but not much, especially given where we were earlier this morning. Futures lower by 0.2%. You can see it's actually turned positive on the Russell 2000. Yields a bit lower as people take a look at a successful Japanese bond auction overnight, 2 hours away from the opening bell. Here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Dollar General. Those shares are surging up 10%. It just reported results. The retailer topped expectations in Q1 and boosted its full-year comparable sales forecast. That's because it's gaining ground not just with its core customers, but also with new shoppers that are trading down for more expensive stores. Obviously, that's a bit worrisome when it comes to the health of the consumer, but it's good for this company and good for the stock this morning. Next up, I mentioned this stock earlier, Bumble. Those shares are falling more than 5.5% after JP Morgan hit it with a downgrade. They say that the recent rally has gone too far and that with revenue and paying users expected to drop, they're now setting a $5 price target on the stock. And the problem, they say, is that Gen Z is just not feeling the love with this app. But I hope they do find love and maybe they go to Signet Jewelers, which is my next stock. Those shares are soaring up 13%. This is the parent company behind Kay and Zales, and it just reported better than expected earnings in Q1. It also raised its profit outlook for the full year and lifted the low end of its sales outlook. They have been making changes to their strategy, including offering more lab-grown diamonds and gold jewelry, and it looks like those changes are working for them. Lisa?
Yahira, it sounds like someone just got married. Congratulations. That was fabulous. I love it. On our radar this morning, President Trump working the phones and social media trying to sway GOP holdouts on his massive tax package as it works its way through the Senate. The bill passed the House last month, but now faces opposition from both moderates, conservatives in the Senate. The goal is, Damien, to get it to that July 4th deadline, which seems like it's going to be a pretty high task.
Yeah, no, I completely hear you. You know what's interesting? I just had somebody texting me about the carried interest and private equity, and I hadn't seen anything in that bill about any of that, about the impact on the uber wealthy tax bracket. But, you know, I guess we have to look a little bit deeper and see where these revenues are coming from and whether or not the market even cares.
Yeah, there's a real question here about what people care about more right now. Is it the tax bill with the potential ramifications for the deficit, or is it trade? And we'll get to trade in just 1 second, but Chris, from your perspective, which is more important?
I think trade is more important, but right now the narrative is all about the deficit. People are talking about the back end going up, back end yields going up. People are talking about the deficit and taxes. But the funny thing is, we've had a deficit this big for some time. The deficit looks like it's going to stabilize, yet people still talk about the deficit and how that's going to cause back-end rates to go up. Not really sure what's changed, but there's a lot of narrative, a lot of talk just about why rates should go higher at the back end, and that's really the conversation of today.
On the trade front, the White House saying it wants countries to provide their best trade offers by tomorrow. Reuters reporting a letter from the Office of the United States Trade Representative asking countries to list their best proposals in a number of key areas, including digital trade, non-tariff barriers, and more, a real question of trying to expedite a time frame, whereas Henrietta Trey said there have been 0 deals in 60 days. We have 90 days. We've got 30 more days to get 90 deals at a time when these are very tight deadlines.
Well, Lisa, as I mentioned, this is what we call going to highest and best in the residential real estate market. Our next guest can probably tell us a little bit about that. But truthfully, you know, these countries, the way their governments are structured, the way, you know, to get a deal done just because Donald Trump wants it immediately, it seems like a bygone conclusion that that's going to be a tough bridge to swallow.
Yeah.
Yeah, I think so. So to get a deal done, and you're seeing this with the EU, is there's a big bureaucracy there. You're really not sure who's leading the charge. And again, what you said earlier is, what exactly does the U.S. want? So there's that uncertainty breeds more uncertainty. It makes it difficult. I think if we can get things done in spirit, then the market will accept that. If we don't need ink on a piece of paper at this point in time, but an agreement between parties, an announcement, a framework that people are talking about, then we can take that framework and then we can push that out to other countries. The market would really like that.
Meanwhile, in other news on the layoff space, Microsoft cutting hundreds of jobs just weeks after its biggest layoff in years. Sources telling us here at Bloomberg over 300 people were told yesterday their positions had been eliminated, something we're watching just in terms of efficiency, as well as some of the big tech giants that are less capital intensive, at least on the human side, when they can potentially get efficiencies from artificial intelligence. We'll get back to that in just a little bit. This, of course, also as Disney is laying off several hundred employees across its film and TV businesses. We do want to get, however, to the main event, which is summer travel, which we all want to do. My co-hosts have already done it. That's why they're not here. Summer travel season is here. And while temperatures are finally heating up here in New York this week, the forecast for the travel industry remains a real question mark. Airlines, cruise operators, online booking sites like Expedia cutting gross booking forecasts for the year. Joining us now is someone who knows much better than I do and much better than anyone else, Marriott International CEO Tony Capuano. I'm just curious, Tony, thank you so much for being here.
Thanks for having me.
Thanks for not being on vacation, although maybe this
Somebody's
is vacation.
gotta work.
Yeah, exactly. I am curious about whether you have seen any kind of drop-off in any material way, or whether that resilience that we see in the hard data really has been a theme for you as well.
So we just did Q1 earnings. January and February were gangbusters. And then you saw the consumer pause a bit in March, and we saw some softness in March. But April and even the early days of May, we started to see a little more stabilization. So the days of post-pandemic double-digit rate growth is behind us, and we're seeing more stability. But we saw globally a little over 4% RevPAR growth in the quarter. Softer in the U.S., about 3%, closer to 6% internationally. And I think that's a theme that will continue. We'll see we'll see growth, but a little more modest growth in the U.S. Every international market except Greater China, with really strong both RevPAR and unit growth.
Can you build on that in terms of what's behind it? Is it this idea that the rest of the world doesn't want to come to the U.S. because Canadians are mad? Or is it that right now it seems like the U.S. is the place where people are showing the greatest amount of discretion with respect to spending?
Yeah, there's a few things in there. Maybe I'll attack the narrative a little bit about inbound. To be sure, we're spending a lot of time with Secretary Lutnick's team, with Secretary of Transportation's team, because there is some concern from international travelers about, are they welcome in the U.S.? What's their experience going to be coming through customs and immigration? With that said, in Q1, we saw inbound from Canada down about 5%, but total international inbound for our business was up. And so the drop in inbound Canadian was offset by inbound from other parts of the world.
Tony, is this the year where ADR growth for limited service hotels actually outperforms that for luxury hotels? I mean, talk to us about consumers' relentless search for that White Lotus experience.
I think it's going to be the inverse. In Q1, the strongest occupancy growth we saw globally was in the luxury tier.
Yep.
The Select brand, slow and steady on the occupancy side, but not nearly the pricing power we saw coming out of the pandemic.
Well, I want to shift gears with you, just if I may. You know, I know we want to talk about tourism as we head into the summer. At least that's what Lisa wants to talk to you about. But I want to talk to you about hotel investment. I mean, the U.S. saw hotel investment down 11.5% in last year. It's down 40% since 2019. Are international opportunities crowding out the U.S. market? Or are you seeing something similar abroad?
Yeah, so when I think about our growth, our investors, our owners, and our franchisees, they have all gladly and willingly decided to invest in an industry that is cyclical by its nature. The good news is most of them are very long-term asset holders, so they're not necessarily timing their investments for a quarter or two. These are assets with 20, 30, 40-year useful life. It's not lost on me that against the backdrop of a lot of economic headwinds, a lot of uncertainty, we signed more deals and more rooms in 2024 than in any year in our 98-year history. In Q1 of 25, with more and more headwinds and uncertainty, most productive growth Q1 we've had in 98 years. And so what that would suggest is both here in the U.S. and internationally, the investors believe long-term in this fundamental shift from the consumer to prioritizing travel and experiences in their spending.
Tony, a quick question. So what's the difference between what you see on the business side and the consumer side? Is there a big difference?
Business side, meaning business travel?
Business travel, excuse me.
So we think about our business in terms of three segments. The group segment, which has been the strongest segment for the last number of quarters. In Q1, global group RevPAR was up 8%. The other thing that's nice about group is we've got more visibility over the medium term because those customers tend to book out a few years. The two transient segments we have, leisure transient and business transient, which is your question, the booking window is sub 21 days today. So I can tell you what I know today, but with the caveat that trends could shift relatively quickly because we have such a short booking window. Within business transient, we look at small and medium-sized businesses and then the big multinationals. Small and medium-sized demand recovered several years ago. It was one of the first segments to recover. Big multinationals are still down double digits from where we were pre-pandemic. The good news is it's growing sequentially quarter over quarter, but modestly. In the quarter, business transient was up 2%.
And just to follow up to that, on the consumer side, are you seeing people book later and later?
We are.
You are. Okay.
We are. And we had, I'm here for the NYU Investment Conference, so I did the CEO panel yesterday, and we all had a similar perspective that while we're pleased with the level of growth that we're seeing, you sort of go to sleep at night and wonder, I wonder what's coming tomorrow, because that consumer, because of all this uncertainty, is sort of standing on the edge of the pool saying, should I book, should I wait? And thankfully, so far, they've been booking.
Well, this is a reason why I think a lot of people have been wondering what the read-through is for the consumer. And you've been talking about how it is down in the U.S., or it isn't necessarily growing as quickly as in the rest of the world. How do you see that manifest? Is it with respect to an inability to absorb higher pricing? Is it for people who are looking for value in the very many ways that you can put that out there?
Yeah, I think if you look at our brand strategy, it is reflective of exactly what you described. So we have brands from mid-scale all the way to ultra-luxury, but we're seeing a bifurcation of the consumer in the U.S. and in many markets where we operate. That's why you're seeing us double down on the luxury end of our portfolio, because that consumer has almost an insatiable appetite for travel. It's also the reason that 2 years ago we made a big push into the mid-scale segment, which was a segment we didn't operate in just 2 years ago. And what we hear from that lower income consumer, they absolutely, just like the higher income consumer, are prioritizing travel and experience, but they need to do it through a value lens. And our entry into mid-scale is allowing us to open the aperture a little bit and bring them in.
Before we let you go, I want to talk about the other side of the equation, which is the hiring side.
Yeah.
And I remember during the pandemic when it was really hard to get everybody back. And I wonder from your perspective, especially with some of the questions around immigration and the changes that have happened there, whether you've noticed anything with how hard it is to hire people, whether that's shifted either salaries or just some of your recruitment plans.
Yeah, thankfully, some of that confidence around the job prospects in the travel and tourism sector that was shaken in the early days of the pandemic seems to have faded in folks' memory. We've got lots of candidates. Our number of open positions here in the U.S. is lower than it was pre-pandemic. Wage rates are certainly rising, but every time the job report comes out, you see that travel and tourism sector leading in terms of job creation. And so we are having good luck filling open positions.
Marriott International CEO Tony Capuano, thank you so much for being with us. Really appreciate
Thanks for having me.
Great to see you, and hopefully we all get to go on vacation. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Uber has named longtime executive Andrew McDonald as its first chief operating officer since 2019. McDonald will oversee both the mobility and delivery businesses. The move is part of an executive shakeup at Uber, which includes the departure of the senior vice president of delivery and the promotion of 3 long-serving employees to their leadership team. Meanwhile, Klarna is test driving debit cards for U.S. customers as it looks to expand further into banking services and chases revenue. The fintech giant says 5 million consumers are on the waitlist for the Visa-backed card. Customers will be able to make real-time transfers and deposits alongside Klarna's signature buy now, pay later service. And Coco Gauff beat Ekaterina Alexandrova in straight sets to book her place in the French Open quarterfinals. The number 2 seed will face fellow American Madison Keys, who defeated Haley Baptiste. Meanwhile, Novak Djokovic earned his 100th career win on Paris's red clay by overwhelming Cam Norrie. That's your Bloomberg Brief. Lisa?
I was wondering where John was. Now I know. Obviously, he's there. Obviously. Up next, slowing growth.
The economy is growing below potential. The markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data.
Coming up next, we'll address that with Jason Draho of UBS. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
A bit softer just here ahead of the open. We see futures lower, but just lower. And they've actually turned positive on the Russell 2000, up now 0.1%. Now just down 0.1 for the NASDAQ. The S&P down 0.2%. This really interesting based on what happened yesterday, which was pretty much the same thing. Started soft and ended with firmly gains across the board after the sense that maybe things aren't so bad and why not buy the dip. Under surveillance this morning, slowing growth.
The economy is growing below potential. The markets haven't really had to come to grips with the idea that the economy might be slowing. We haven't really had that one piece of very, bad hard data. Even though the stock market's had a really good run over the last 12, 18, 24 months, that hasn't stopped labor market conditions from continuing to cool off.
Here's the latest. The OECD slashing its global economic forecasts, citing the impact of tariffs and uncertainty. Jason Draho of UBS writing, the resilience of the U.S. economy will continue to underpin markets even if growth moderates. Jason joins us now, and it's kind of this two poles of the discussion. On one hand, you have Neil Dutta saying, look, the market is weakening. You can see what's going on in housing. You can see what's going on with sentiment. And then you say, well, even if it slows, it's coming from a very high base, and you can see in a lot of the earnings, people are still doing okay. So how do you parse those two poles?
Well, I think it comes down from a market perspective, like what's the market price and what do people think? And so a slowdown in growth is already expected. Last year, we grew at 2.7%. Consensus coming into this year was 2.3%. Bloomberg consensus is down to like about 1.4%. So that's sort of, to me, kind of the bar. Like, is the market sort of pricing that or not? So if we get some moderation, that's expected. It's really, you need to me, like, get a big downside surprise. We need a payrolls report on Friday that is like sub 100,000 or later this summer, similar to what happened last summer, where you had that July jobs print that was really disappointing. Then the markets kind of freaked out. Until we see a really disappointing data point where you think, well, maybe growth is going to be sub 1%. I think the market just sort of kind of looks to a lot of this noise at this point in time.
Jason, you're head of asset allocation for UBS Wealth Management. I need to ask you about private credit and private equity here. I mean, private credit's consolidating. Private equity fundraising has plunged by more than a third over the first 3 months of the year, I think. Investors are heading to Berlin for that super annual event, to raise money. And, I just want to hear, what is your thoughts on all these continuation vehicles, deteriorating CLO demand, M&A activity falling off a cliff? I mean, what is the bullish narrative for private credit in your eyes?
Well, for private equity, at least, we know like the flywheel of how they can buy then exit. That's been sort of that's been delayed, and so their ability to exit, raise new money, that's impaired. This is could go on for a little bit longer this year, but I think that's not a fundamental broken model at all. I think for private credit, it's something where the way we kind of think of it is like from an allocation perspective, how much do you already have in your portfolio? So it's true these asset classes might be facing at least a little bit of near-term stumbles, but when we think about what our average client is doing, they're still significantly underallocated to what we think should be alternative asset classes, private markets. These are secular allocations. These are not things you should be thinking about trying to get in and out one quarter to the next. So from a long-term perspective, I think we'd say most people are still underallocated.
Jason, the linchpin for the economy for spending is labor, right? Tell me what you're seeing with labor in the here and the now, and then tell me what you're expecting in the 1, 3, and 6 months, because I keep hearing labor's going to get worse, labor's getting worse. We just heard labor is cooling, right? But we're not hearing about mass layoffs. When I talk to people, they're not saying, hey, we're getting ready to fire a ton of people, but I keep hearing that labor is going to get more and more challenged. What are you seeing and what are you expecting?
Well, I think that the general idea is that everyone expects the economy is going to slow. Tariffs are going to be inflationary, and they're going to be bad for growth. We've yet to see that in the data. This gets into the kind of the data resiliency point. I do think back to a couple of years ago when everyone was forecasting a recession because the Fed's going to raise rates, and instead the data went the other way. So I'm a little bit, at this point in time, kind of the boy who cried wolf on the data. I want to see the data actually kind of roll over. I think that's sort of a consensus view among investors is that low conviction, if you're running a business with a low conviction on the macro outlook, you don't want to fire too much. At the same time, you're reluctant to hire. So the market's in it, like the labor market's in a bit of a holding pattern. I think that's a general nature for the economy as well. So until you really see demand destruction, to the point where like forecasting, you just don't need that labor supply. I think companies are going to hold on to labor, hiring will be moderate. But if the consumer holds up, that sort of cycle, it won't break. And so you need one of these legs to break, and it really has to be the consumer. And the consumer's only going to break unless tariffs go up, real incomes decline, and then that's a problem. And we just don't see that yet.
When you put what we're talking about together in this idea of how to construct some sort of asset allocation, it raises the question, what's the biggest risk? Is it the question of inflation? Is it the question of potential downside risk to growth? Is it something that has to do with the risk asset portfolio, which traditionally has been stocks, or does it have to do with the risk being inherent in bonds? I just wonder, from your perspective, do you agree with so many people on Wall Street right now that stocks seem like a less risky asset class than the long end of the yield curve, given the exposure to a whole host of different risks that seems unquantifiable right now?
So I think the 30-year right now, it's in, I wouldn't say its own world, but clearly the factors that are driving are different than what's driving, say, the 5-year. If you think about the Treasury curve and the relationship between equities, it's relatively well behaved in terms of diversification. Equities, rallying, you see, rates rise at the front of the curve, and that, or vice versa. So I think that part is sort of working fundamentally. The 30-year, it's less liquid, not a big natural buyer base. It's going to do its own thing. So I'm not sure I'd want to interpret too much on that 30 years doing. I'd rather look at like how is the 5-year reacting to the data? How is that part of the fixed income portfolio, correlating or not correlating with equities? I think for the most part, that's kind of relatively well behaved. So I'd want to just, tamp down a little bit of the information I'm getting from the 30-year.
In other words, you're rejecting this idea that 60-40 is dead, and that isn't necessarily a ballast to have bonds in your portfolio.
I think, well, right now we're saying kind of buy up to the 5-year point of the curve, kind of that area. So that's, in that case, it's working. 30-year, we'd see kind of be cautious on sort of taking that duration risk right now because it is hard to predict.
Jason Draho of UBS, thank you so much. And I think a lot of people, it seems like Chris would agree with him.
I would agree, right? If today's your first day on the job, what would you be saying? Would you be saying, oh my goodness, we're going into recession? Oh my goodness, the consumer's collapsing? You would not be saying that, right? There's a lot of fear about the unknown. There's a lot of fear about what could happen. But when we look at the data, you're not seeing it in the data. You don't want to put your head in the sand and say everything, I don't see anything, right? You have to be concerned about it. You have to be respectful of it. But at the end of the day, you have to follow data. And the hard data is telling you something else. And I really do discount the soft data. And I look to the prediction markets, and they tell you something much different.
But Chris, it's not the first day on the job for a lot of traders on Wall Street, right? I mean, they've lived through these markets many, many times, and credit spreads are just not reacting to some of the risks that are inherent in the economy.
We talk about this all the time. I've never seen a recession with credit spreads at 90 basis points over, right? And if you look at the issuance that's going on, you and I could issue $500 million worth of bonds. Now I'm exaggerating, but that market is healthy, and it's healthy, and it's funding. And that's very, very important because credit is getting to where it needs to go. And this gets back to CapEx and our thought that where you want to align yourself is with that CapEx, because the companies are issuing the debt, they can spend it. They're cautious, but they're still saying, I still need to spend, and they are.
Chris Harvey of Wells Fargo, thank you so much for spending the hour with us. Damien, you're still with me. Coming up, we've got Tom Kennedy of JP Morgan Asset Management, Congressman Andy Barr, Ballerina Lurici of T. Rowe Price, and Vishy Tirupatoor of Morgan Stanley as we parse through just what will be the main theme of the day, given the fact that we've got the roulette wheel of trade, we've got the roulette wheel of the budget discussions, and the roulette wheel of the economic data. This is Bloomberg.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity, ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I think the market, has probably some near-term upside.
We do remain a bit more cautious on the long end of the curve.
When we look at the equity market, we see more risks on the downside than the upside.
If things stay status quo, then I think you have the opportunity to see the markets move higher.
What's going to drive things higher? And then it's got to be the environment and earnings.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 90 hours and 90 minutes until the start of the trading day, 90 days until the start of the trading month, and we are clawing back losses. A real bullish tone in the markets over the past few days with any sell-off getting bought. HSBC's Max Kettner writing this morning. Recent dips in risk assets have been very short-lived amid less supportive news flows. Our sentiment and positioning indicators are still flashing buy signals. This has been the tone that we have seen over the past few days. Right now, we are seeing slight declines. Damian Sassower alongside me today, and I'm just wondering what you make of this increasingly bullish tone, even amid so many question marks on the trade front as well as on budgets.
And then the run-up to payrolls this week. I mean, look, I have to look abroad. I have to look at all these central banks that are meeting. We have Canada tomorrow. We have Poland tomorrow. We have the ECB on Thursday. We have India's probably going to cut rates on Friday. The stimulus is there globally, and the question is it going to feed through into asset valuations? My guess is, possibly.
Yeah, well, right now it also feels like people are looking past a lot of what they don't know and looking to what they do know, which is that earnings came in very strong, that there clearly is a sense that not only it was the negative data in sentiment really bearish, but it's actually coming up to the hard data. The hard data is actually hanging in there. So what is the incentive for people to truly throw away a rally that has really been the pain trade for the past couple of weeks?
Well, has it really been inventory building and front loading? I think that's what the market has to kind of parse through.
And that's the question about the data and the integrity of the data. Today we get JOLTS job openings data as well as manufacturing factory orders and durable goods. Tomorrow we do get the beige book, which I actually think is going to be interesting, as well as the ADP. I do find it fascinating. Hold on a second. I actually think the anecdotal information right now is really interesting. I read the ISM manufacturing survey from front to back yesterday because that's what I do in my free time. Thursday we get initial jobless claims. I'm just moving on really quickly from that. And Friday non-farm payrolls. I just wonder what we can do with this, because a lot of people have been saying that the actual headline number is going to be a lot lower than it has been in the past number of years, just simply because we're in a low churn, low job creation kind of market.
My question is, what is immigration going to do to some of these future payroll prints? I mean, can we really rely on them now that Trump just got the court approval to remove 500,000 visas, 500,000 jobs? So, my question is, we're looking forward into the next, few months. Are people going to put less onus on the payroll data? Possibly.
Well, it sounds like a soup, but the soup is getting less bad, at least when you take a look at futures throughout the start of the day. What we have seen is futures clawing back earlier losses, with the Russell 2000 actually turning positive. Now 0.2%. NASDAQ basically flat. The S&P futures lower by just 0.1%. In the bond market, a bid, and this is a shift from what we have seen over the past few days. And an important one, what you're seeing is a bid across the curve, in particular in duration, 3 basis points lower. Not a huge move considering the fact that this trades like a penny stock for the 30-year, but still notable given the fact that we got that Japanese bond auction that went well. 30-year yields at 4.93%. And then in the currency space, also kind of turning the recent narrative on its head. Dollar strength, who knew? You've got the euro weaker just slightly versus the dollar, 113.93. Coming up this hour, Tom Kennedy of JP Morgan Asset Management. A shifting policy calls for new portfolio construction. Congressman Andy Barr on why he says the Senate must pass President Trump's big, beautiful bill, and Vishy Tirupattur of Morgan Stanley on why he prefers U.S. assets. We begin this hour with stocks steady as trade uncertainty persists. Tom Kennedy of JP Morgan Asset Management writing, as we deglobalize, higher inflation will likely come, and bonds are unlikely to be the best diversifier in a portfolio. Tom joins us now for more. Tom, so glad to have you here. Welcome.
Good morning.
So why is it that everyone is getting more bullish on stocks, but more bullish on bonds at a time when it doesn't seem like we're really facing runaway inflation?
Yeah, when we're talking about the sentiment in the market, I love listening to you guys set this up. But what's happening in the background is that betting markets have decreased its probability assigned to a recession in the next 12 months in the U.S. by 35 percentage points in just 2 weeks. This is a massive move, and for the first time since the tariff news really came out earlier this year, you actually now have betting markets recession probabilities below what economists are suggesting. So this is a new regime. I think it feeds into this bullish sentiment that's happening. Things are shifting so rapidly, and to us, that makes a lot of sense.
Well, Tom, why do you suppose that is? Is that because of the fact that they think deals are going to get done, that Trump's going to do a deal with India, they're going to do a deal with South Korea, with Japan?
I think that's part of it. I do think the Trump administration has suggested that the negotiations can happen, and they've backed away from some deals. But most importantly, you're still seeing inventories get to America. Yeah. This year so far, shipping from China to America is up 6% relative to last year. Now, there's lots of volatility month to month, but we don't have this embargo risk, really. The second is that spending is slowing in Chase, where we get the best data on the planet. Spending is slowing, but more natural when you have high interest rates. And third is corporate margins, which you guys hit on, are still extremely healthy. So the risks of layoff are relatively low if we can work through this tariff risk. So to me, a lot of this volatility is related to the Trump administration, but things are still working, things are still progressing, and the hard data is turning really nicely, or at least not coming down towards the soft data.
Tom, I want you to put your real estate hat on for me. Operating expenses in real estate, through the roof. Do you think tariffs are going to be inflationary for the U.S. economy?
If they are, they support real estate in a really interesting way. The way that real estate works, and you move through a higher interest rate environment, is the first phase is we have to reprice those assets, and we really have done that. You saw commercial real estate prices move down about 25% as the Fed hiked rates. Very aggressive. But to your point, now costs rise, higher inflation, higher interest rates make it really hard to build. And now we're walking into a supply problem for real estate.
There we go.
So as we move out of the next 2 to 3 years, you're looking at really no supply coming across office all the way to residential. And across all of those, new starts are down almost 75% from the peak. So this problem of repricing now moves into a phase where supply becomes your bigger problem. And most real estate investors would sit here and say, if you look back through history, too much supply is always the problem for commercial real estate and real estate in general, but we're walking into a phase where there's not a lot of supply.
This actually goes perfectly to this question of inflation and what the real risk for bonds actually is. It's really good that you're bringing up real estate, because that's the argument people bring for disinflation. Look at what you see with the glut of homes for sale. Wouldn't that lead to lower pricing? You're making the argument, not really. On the flip side, you're saying that this is people pricing out recession. So is the move that we're seeing in bonds a positive story about growth, or a negative story about stagflation with higher inflationary risks on the horizon?
Yeah, I think you're running the risk that stagflation is the scenario we walk through. Now, that's a big word we all use, and it never gets defined. What I'm describing as stagflation is a world where growth can remain consistent with what we've experienced for maybe the last 18 months, but inflation is not below 2%. It stays a little bit above 2%. And the question becomes what the central banks do in this environment. My time at the Fed inflation was below 2% the entire time. Growth was the thing that decided if they hiked rates or cut rates. And now if inflation stays above 2%, it's not that simple. And we need to price more interest rate volatility, which means it's hard to price new financing. And you also have an environment now where rates are just higher for a period of time. It comes back to this portfolio construction piece. It's where you started. Portfolio construction has to be different than what we had in the regime before COVID, where inflation was persistently below 2%. If we're going to see inflationary pressures move through this economy, interest rates will be higher, and maybe they won't be the same diversifier that they were.
So when you say portfolio construction, a lot of people would simply say, okay, you don't like the 60-40. Okay. And this is another way of saying it, right? Is there a more sophisticated way to put it in terms of how you have to think about what risk is, what you're trying to mitigate, what your new ballasts are at a time when there is this sort of uncomfortable inflation with slowing growth?
Harry Markowitz created the 60-40 portfolio in the 1950s. It didn't get broad-based adoption until the late 1990s. Why? Well, something critically changed in the late 1990s and in the early 2000s. The era of globalization hit its golden era, where any input I can get throughout the world, I'll take it, send it to me. I don't care what the consequence is. But now you fast forward, COVID hits. Oh wait, we need to keep supply chains a little more resilient. Now we have rising geopolitical risk. And then we can add on the deficit woes, which a lot of people want to jump to, but we're not seeing meaningful differentiation in how the dollar is being used globally. But in that world, if peak globalization is behind us, inflationary pressures are higher, and the same diversifiers won't work. And really, when I'm, rubber hitting the road, the Fed doesn't have as much control of the long end as they've had for most of our careers sitting at this table. So something is a little bit different. As we sit and breathe here, this is something to talk about the rest of this hour. The 30-year real rate is at the highest level it's been since we've had a 30-year tip. Why? Why are people not jumping into it? Well, it's because there's lots more uncertainty. Things are changing.
Tom, and it's no man's land up above 270 on the 30-year real yield. I was looking at that yesterday, but you're talking Markowitz mean variance optimization. That's squarely in my wheelhouse. So let me ask you this. Alternatives, and the role alternatives play.
Yeah.
But the thing that I have a problem with is the illiquidity of alternatives. Are investors that you're speaking to, that JP Morgan Asset Management is taking care of, do they understand that when things get tough and the gates go up, they may not have access to those funds?
JP Morgan did this amazing family office survey last year. So the wealthiest families, how much of their portfolios in alternatives? When I asked this question at like a cocktail party, people have no clue. 45%. So the wealthiest families, endowments, are able and already willing to give up the liquidity. When you look at the average person in, say, a wealth management office, 5% of their assets are in an alternative. So there's room to grow. The second point, though, is the asset management community is finding ways to add you more liquidity.
Oh, yeah.
Think about non-traded REITs as an example, where you can provide monthly liquidity to an investor, and now it's our job to find the assets that can optimize that liquidity. And in real estate, as an example, for a non-traded REIT, residential and industrial properties have multiples more liquidity. They turn over a lot more in the market than, say, office or data centers. So this is the optimization and evolution that's happening.
Okay, and we need to move on, but just quickly, this is something that starts to worry me after having lived through 2008 and 2009. When you start giving something the appearance of liquidity that is not inherently liquid, alarm bells start going off. At what point are we going to just slow walk back into that kind of paradigm of liquidity mismatch?
Yeah, and this is an important thing. It's not completely give up on liquid bonds. It's not completely all in on quote unquote less liquid ideas. But this is the balancing act that has to happen. And when I look at that paradigm between family offices and average investors, that's just a chasm that's too big. There's room for all of these products to coexist, but I think the shift that's most likely to happen with higher inflation, higher interest rates, is this move towards alternatives and balancing that liquidity, Damien, to your point.
Tom Kennedy, we could talk about this for an hour, and luckily we have an hour. We'll be talking about a lot of things going forward. Tom Kennedy of JP Morgan Asset Management will be sticking with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Dollar General shares are rising more than 10% in the pre-market. The discount retailer reported first quarter profit and sales that topped analyst expectations, and it boosted its comparable sales forecast for the full year. Dollar General also said it expects to mitigate a significant amount of the tariffs currently in place. Meanwhile, Africa is set to be the largest beneficiary of the $200 billion the Gates Foundation plans to give away over the next 2 decades. Co-founder Bill Gates made the announcement at an African Union gathering in Ethiopia on Monday. The organization said last month that it plans to give away the money over 20 years before shutting down in 2045. And President Trump has changed his official portrait less than a year into his second term. The new image carried on the White House's social media channel swaps the turquoise tie for his favored red power one and switches the background from the U.S. flag in what appears to be a stateroom to black. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. News you need on a Tuesday. Up next, the morning calls plus Congressman Andy Barr on why he says the Senate must pass President Trump's big, beautiful bill. That's coming up next. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
We just had the best month for a May going back to 1990. And meanwhile, people are saying, should we sell? And the answer, at least on the outright, seems to be no when it comes to stocks, given the fact that we've seen that rally. When it comes to bonds, there is another story. And the 30-year is the question, who wants to buy a 30-year bond with a yield near 5%? Getting a little traction today, but still clawing really awfully close to that 5% level, which has been the pain point. We'll get to that in 1 second. Time now for the morning calls. First up, Piper Sandler raising his price target on Lululemon to $315, looking for the company to report better than expected earnings on Tuesday. Next up, Morgan Stanley lowering its price target on Campbell's to $35, expecting a challenging year ahead if tariffs stay in place. And finally, JP Morgan upgrading Pinterest to overweight, pointing to solid user growth and better ad capabilities. with the ability to click on links and shop directly from Pinterest, so I hear. Turning to policy, President Donald Trump trying to sway Republican holdouts on his one big, beautiful bill. Trump posting on Truth Social, I call on all of my Republican friends in the Senate and House to work as fast as they can to get this bill to my desk before the 4th of July. Republican Congressman Andy Barr of Kentucky voted in favor of the president's bill last month, and he joins us now. Congressman, thank you so much for being with us today.
Good morning, Lisa.
Good morning. So I want to start with asking about the deficit, and I'm watching that 30-year bond yield, as everyone in Washington, D.C. is. Do you believe what President Trump said on his Truth Social post last night, that this doesn't add to the deficit, even though you have a whole host of different estimates saying that it will add $3 trillion to the deficit over the next 10 years?
Well, Republicans are also watching the 30-year. We're watching the 10-year. We're watching instability in the bond market. We're looking at weakness in demand for treasuries. But blaming the big, beautiful bill for weakness in the treasury market or instability in the treasury market is like blaming the firefighter, the arsonist blaming the firefighter for the inferno. We just went through 4 years of a drunken sailor's spending spree by the Democrats that put us, way behind the 8 ball. Also COVID, and there was some bipartisan spending associated with COVID. But it's very rich for Democrats to accuse Republicans of fiscal irresponsibility when we just went through this spending binge that produced 40-year high inflation, 20% increase in prices. Look, the bottom line is we know we have to achieve greater fiscal discipline. And frankly, we need some bipartisan work on mandatory spending reform. But what we also need is economic growth. We will never balance the budget. We will never get our fiscal house in order without robust economic growth. I believe, as Kevin Hassett has argued, that this legislation, this one big beautiful bill, could produce, along with the deregulatory project, along with more energy production in the United States, that we could achieve that 3 to 4% GDP growth. That's the kind of dynamism that is not accounted for by the Congressional Budget Office and some of these static scores.
So let's talk about that, why it's not being accounted for that in places like the Committee for a Responsible Federal Budget that expects this to increase the deficit and says that it only cuts spending by 0.8% of GDP. Where are people not including growth that you see as being part of this bill?
Well, the CBO just doesn't. They were off $1 trillion, underestimating revenue reflow that came as a result of growth from the Tax Cuts and Jobs Act in 2017. The CBO has a terrible track record of not including the dynamic impacts of these tax cuts. And in this bill, not only does it make key features permanent, providing that certainty and stability for private sector investors, but the business tax cuts are really the rocket fuel that are included in the bill. So bonus depreciation for 5 years, pulling forward all that CapEx. There's a reason why the Atlanta Fed is projecting 4% GDP in the second quarter, because businesses and business optimism is increasing because of anticipation of R&D, interest deductibility, increasing the small business pass-through deduction from 20 to 23%, making that permanent. So these business tax cuts are really increasing business sentiment, and I think, again, pulling forward that investment that can really allow this economy to take off.
Congressman, you sit on the House Select Committee on the strategic competition between the U.S. and Chinese Communist Party. What is going on between President Xi and President Trump? Where are we with that relationship right now?
I think President Trump is the first president, Republican or Democrat, in our lifetimes who has taken the threat from China seriously. Under this president, no more unfair trade deals, no more Chinese fentanyl poisoning our people through the southern border, and no more spy balloons coming across the continental United States. Deterrence, peace through strength, that is the idea. The big, beautiful bill, to the extent we increase spending in there, there's more military modernization dedicated for the Western Pacific Theater. That's what we need. We need to win this competition. We need to be the best version of ourselves. We need to enhance, of course, our investment in defense, but we also have to be strong economically, and we have to grow. China has its problems. We have a debt problem. But we can produce growth by being free market capitalists.
There is a question, though, in your quest to be free market capitalists of both getting revenue from tariffs that have to do with continued trade, albeit with something of a tax, versus decoupling in its entirety. And what you see from a lot of the data right now is that trade is going down quite considerably, and exports from the U.S. are going down quite considerably. So how do you account for some of the revenue and the growth from some of these tariffs if you're also talking about potentially decoupling in certain key industries between some of the biggest economies out there?
Well, you know, I liked what Jamie Dimon said at the Reagan Economic Forum in California. When he said I'm being associated with that. When he talked about, you know, strategic de-risking from China on those national security sensitive industries, not complete decoupling on things like tennis shoes or basketball shoes or apparel or things that do not implicate national security. What I would say about in general, as a free trader, why I support President Trump's agenda is because of the enormous potential that this has to actually open up markets for American exporters. If we can open up India, for example, and reduce their protectionism and their trade barriers against our exporters, that is massive. And if you think about it, from where we were on Liberation Day to now, we're back in basically a bull market with a correction embedded. Every trade deal that is inked from here on out is, again, jet fuel for the economy. We get the certainty of trade deals in place with more market access for American exporters, plus deregulation, plus the tax cuts. I do see 4% GDP.
What do you think the Senate is going to do to change the bill that you would be okay with in terms of cutting salt tax deductions, potentially adding back and potentially even increasing some of the CBO score for the deficits with respect to Medicaid? What are you going to be okay with?
Well, look, we've got to get this done. I think we have to have an ability to compromise on some of these details, whether it's SALT, whether it's Medicaid. I welcome fiscal hawks in the Senate saying, hey, we need to do more on the spending restraint side. So Ron Johnson, my colleague, Rand Paul from Kentucky, good for them for asking for a reduced size and scope of the federal bureaucracy. I like that. Let's codify some of the DOGE savings. But at the end of the day, we have to get this done and deliver this. 77 million Americans voted for this pro-growth agenda. I think at the end of the day, we'll come together, we'll get it done.
Congressman, thank you so much for being here.
Great to be with you.
Congressman Andy Barr here in New York. And this really is the key question, Tom. Ultimately, what gets done in what form and whether it's going to generate more growth than people are expecting, because that really is one of the key questions at a time where everyone seems to be focused on the deficit.
Yeah, Congressman Barr, you're really separating out the issues for investors here too, which is, can we balance that growth with reduction in expenses so that the Treasury market will function? And you did it very quickly, but you highlighted some of these critical connectivities between the U.S. and China, which may have some national defense issues. So much on your plate to deal with. Well done.
This is the reason why. I mean, this is the reason why, honestly. I think a lot of people are having a hard time understanding the bill and understanding exactly what to pay attention to, Damian, given all the potential competing headlines.
Yeah, no, I mean, look, the deteriorating relationship between Xi and Trump, is it really deteriorating? You know, we don't know what's really going on inside the White House, inside the Oval Office, inside the West Wing. So, you know, I mean, it's anyone's guess at this point.
And it's anyone's guess what some of the data is going to point to as well. Coming up, we're going to be speaking about that ahead of payrolls Friday with Bluina Yurici of T. Rowe Price. We've got eco data that includes the JOLTS data that we get later today. Fed speak, of course, non-farm payrolls. This is Bloomberg.
the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The closer we get to the start of the opening day, what you can see is any losses getting clawed back. Right now, you can see futures pretty much unchanged, actually in the green for the NASDAQ and the Russell 2000 up now 0.4%. S&P futures basically flat. If you take a look at the bond market, a rally there after a successful Japanese 10-year auction. What you can see is that rally even in the 30-year Treasury that nobody seems to want to buy. Yields lower by 3 basis points, 4.93%. The 10-year 440 still solidly sub 4% on that 2-year. 1 hour away from the cash open. Here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We start with Constellation Energy. Those shares are soaring nearly 10% after it signed a giant energy deal with Meta Platforms, the Facebook parent company, agreeing to buy nuclear power from Constellation's Clinton plant in Illinois for the next 20 years. All of this meant to fuel Meta's AI operations with clean around-the-clock energy. The deal could even lead to them building a brand new reactor at the site. So the AI spending showing no signs of slowing down. Next up, we have the latest retailer to report, and that is Signet Jewelers. Those shares are soaring now, up 17%. This is the parent company of Kay and Zales Jeweler, and it just reported better than expected earnings in Q1, and it also raised its profit outlook for the full year. They have been making changes to their strategy, leaning more into offering lab-grown diamonds and gold, and it looks like that strategy shift is working out for them. And last up, we have Dollar General. This was an interesting one. Shares are soaring nearly 10%. They also reported better than expected results in Q1 and boosted their full year comparable sales forecast. That is because they're gaining ground not just with their core customers, but also with new shoppers that are trading down from more expensive stores. And when it comes to tariffs, that was the big worry for Dollar General since it imports heavily from China. But they said that they're going to be able to mitigate a significant amount of the tariffs that are currently in place. Lisa?
Yeah, thank you so much, Jaira. I was just reading more about Dollar General saying that they did caution that consumer spending could be pressured by tariff-related price increases, but managing to move forward with this. But really interesting, Tom, the fact that you get some sort of better-than-expected results because of trade downs at a time when people are cost-conscious.
Well, we're actually seeing that in our real estate portfolio, too. Retail platforms are actually holding in okay, but what you're seeing the customer do at our properties is trade down to more away from discretionary ideas to non-discretionary ideas. So, and this was actually happening before the tariff news. So there is a slowdown in the consumer that's happening. We would characterize it more as normalization rather than a meaningful slowdown, though, in the grand scheme of things.
Which is the reason why people are parsing through the economic data to understand whether it's going to be north of 1% or sub 1% when it comes to growth. With that economic data, as well as Fed speak on deck, Michael McKee of Bloomberg Economics, what are you looking for in a really packed week for economic data?
Everybody's going to be focused on jobs, Lisa, and then in the coming weeks, we're going to be looking at inflation, the two pillars of the Fed's dual mandate. We had some Fed speak earlier this week, yesterday, from Chris Waller, the Fed governor, and Austin Goolsbee from the Chicago Fed, and both of them basically suggesting something called good news rate cuts were possible by the end of the year. And here's what they're talking about. Waller is looking at the inflation numbers and looking at the idea that it is important that inflation expectations stay anchored. And if they do, a one-time move in inflation because of the tariffs would not affect things. And here's the problem. The University of Michigan numbers, as you can see, show big increases in what people think is going to happen over the next year and the next 5 years in inflation, but market-based measures show much, much less, that inflation is contained. And Waller is saying basically he believes the market-based numbers, so if we get a one-time move up in inflation, it'll be okay. Goolsbee and Waller both watching the other side of the mandate, which is unemployment, which the Fed is going to look at as a signal for whether the economy is significantly slowing. And right now, we don't know because it's way up in the air, although there are some questions about whether this is going to be the kind of last hurrah for the labor market. JOLTS out in just about an hour and 20 minutes. Their job openings expected to fall. ADP is expected a very slight increase in jobs, but they were way off last month. Payrolls supposed to come down a lot. It's unemployment that's holding in steady. And that's what everybody's going to be looking at to see if there is any kind of movement there that would disturb the Fed. So watch for the jobs report on Friday. Watch for the inflation numbers coming up ahead. And if you want to bet on a Fed rate cut at the end of the year, good luck to you.
Michael McKee, thank you so much. I think a lot of people have thrown their hat in that ring and then taken it out and then thrown it back and then, basically sat on it. Right now, Lorena Larici of T. Rowe Price joins us to talk about that economic data ahead. Lorena, what does a good jobs report look like? What does a bad jobs report look like, given the fact that a lot of people are saying the headline number is going to come down quite significantly?
We also expect a deceleration in the pace of employment growth this year. I think that's been quite well telegraphed because we have this uneasy equilibrium in the labor market where firms are not hiring. Demand for labor has actually slowed quite significantly, but they're not firing either because we did have those post-pandemic shortages of workers, and I think companies are very cautious about talent. So I think the labor market equilibrium is quite uneasy. A good news report for me is one where the unemployment rate does not tick higher. I think this is what would really concern the Fed, broad-based layoffs. And also we need to see in this uneasy equilibrium, is the wage growth and wage inflation rate going to slow or stay sticky where it is? I think we need wage inflation not to accelerate from here. We'll be watching those inflation expectations very closely. Indeed, I think it was a very interesting choice of words by Governor Waller to say that this hit to inflation is going to be a one-off shock to the price level and not persist, because the last time the Fed went on that assumption, we all know what happened. So I think we got to watch very closely those inflation expectations and what happens to wage demands once the effect of higher tariffs hits consumer prices.
Lorena, the Fed has made no secret about its asymmetric view on policy rates and inflation, opting to ease first and ask questions later. Yet despite that dovish bias, I think the market's only pricing in, 2 cuts before the end of this year and a terminal rate of 3.25 by the end of next. Is the market right?
The market has been oscillating a lot in terms of price cuts for this year, and I think it's been responding to whatever has become the dominant narrative. At one point, it's the growth scare, then it is the inflation shock from tariffs. Now it's the fiscal package. I think for the Fed, it's going to be very tough to cut interest rates this year. I still have 2 cuts in my forecast towards the end of the year, but I think that window might be closing quite quickly for the Fed. If we don't get a meaningful deterioration in activity and in rate and the inflation shock from tariffs baseline scenario, I think it's going to be pretty tough for the Fed to justify easing policy with accelerating inflation and a labor market that is holding up.
Yeah, Lorena, really nice. What's the differentiation from you for a demand side driven report on Friday versus a supply side driven report on Friday. And what I'm getting at is the immigration numbers into this country are abysmal. The border is effectively closed, and a big piece of what you suggested is during COVID, immigration filled in that supply gap. Are we on the other side of that? Or is this really a supply issue or a demand issue in your mind?
So I think it's both, but let's unpack this because I think it's going to be very, very important in terms of what happens with the path of the unemployment rate for this year. So we have a slowing in demand for jobs, and we see that because the vacancy rate in the jobs has been declining. What we don't have is mass layoffs so far. So all this uncertainty about the business climate has not led to firms laying off workers. We also have an administration with a policy to restrict labor supply, foreign labor supply. That we know because those border crossing statistics that you mentioned, they've come down a lot. We also see the labor force participation of foreign-born workers declining significantly since the end of last year. So we know that, and I think this declining labor supply is coming at the same time as the demographic forces in the US with the baby boomers retiring. So the supply of workers in the economy is going to slow down a lot this year. What we saw post-pandemic with increase in net foreign-born workers in the economy was that we entered some kind of virtuous circle where we had vacancies, we filled those, extra workers created more aggregate demand and so on, and the economy was able to sustain above-trend growth for quite some time. I think we'll be seeing the opposite of that this year. But now, if we don't have broadly based layoff and we have a declining labor supply, the unemployment rate in the economy is probably going to stay sticky or trend lower. And that's going to be a supply effect. And I think if you're the Fed and you don't see that increase in the unemployment rate or the SAM rule being breached, you're going to be pretty cautious about cutting interest rates in this environment with heightened inflationary risks.
Yeah, how much of this supply issue, Lorena, is impacting the expectations for growth in this country?
I would say a fair bit. I think it's that and uncertainty about the climate of doing business, uncertainty about what's going to be in this fiscal bill. Again, this is an interesting one because there are lots of components of the bill that came out of the House that support spending and investment with 100% capital depreciation and expensing for investment and so on. But you also have Section 899, which you all have discussed in depth today. I think that makes it harder for FDI coming to the country because they will not know which countries will be in the list and what different types of capital, how they will be treated.
Yeah, Lorena Urici of T. Rowe Price, thank you so much for being with us. It really has been this confusion. We keep talking about the negative sentiment. The data comes out. It's sort of a tale of a lot of different aspects, and it doesn't actually speak to a materially weakening labor market aside from just low hiring, low firing.
Well, Lisa, we've had a lot of people come on today railing all over the 30-year. And, you know, I've just done a little back of the napkin calculation here. I'm using cross-currency basis swap spreads. You know, you can get a 30-year JGB hedged into dollars, 6.85%. So why would you buy a 5% 30-year in the U.S. when you can get 250 basis points more by buying JGBs and hedging out the dollar exposure?
I love how you're mapping that out as we talk. He's sitting there calculating this. But Tom, I mean, to that point, I think the idea of feelings versus reality, there have been some really fundamental changes that have been going on under the hood. And I wonder how much some of the sentiment has to do with entry-level people not being able to be hired or not getting jobs right out of college. Whether there's been a weakening that hasn't been as pronounced in the numbers as it has in how it feels for certain people when they go out there.
Yeah, this polarization concept you can now see in the way you survey Republicans versus Democrats, for an example. During the Biden administration, Democrats felt their consumer sentiment was better than Republicans. We're all living in the same United States, but sentiment is a completely different narrative. I think it helps explain why soft and hard data can diverge and why most economists are now pulling back some of their confidence in what the soft data today tells you about the future. Those surveys are just not as meaningful. But Lorena really hit at a really critical development that's going on in this country that really hits at Congressman Barr. Like, we need growth, but the simple ways you get growth are productivity and people. And at the moment, Lorena didn't give the number, but you're seeing border encounters at the Southwest land border at like 10,000 per month. Last year, in the month of May, you were at 200,000. The year before that, something similar. So these are challenges for the administration.
Well, Lisa, I mean, the remittance data out of Mexico just printed, right? I mean, it's falling at about $1 billion a month. That's $1 billion a month, and Mexico relies heavily on remittances from the U.S.
I'm glad that you said that. Actually, I was just looking at that yesterday. The remittances to Mexico from the U.S. fell 12%, which is the biggest drop in more than a decade. And that really goes to this question of, are there the people here to even be sending back, let alone, just what that means for the respective economies. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. A vote count is underway to determine South Korea's next president. According to an exit poll released soon after the voting ended earlier this morning, Democratic Party nominee Lee Jae-myung is on track to win. The final voter turnout for the election reached its highest since 1997, according to Yonhap News. Meanwhile, Microsoft has cut an additional 300 jobs just weeks after its largest layoff in years, where the tech giant slashed 6,000 roles. The cuts underscore the industry's efforts to trim costs even as it plows billions of dollars into artificial intelligence. Microsoft's previous layoffs fell hardest on software engineers, but it couldn't be determined what kind of jobs were affected this time around. And Coco Gauff beat Ekaterina Alexandrova in straight sets to book her place in the French Open quarterfinals. The number 2 seed will face fellow American Madison Keys, who defeated Haley Baptiste. Meanwhile, Novak Djokovic earned his 100th career win on Paris's red clay by overwhelming Cam Norrie. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Wonderful work this morning. See you tomorrow. Right now, up next, setting you up for the day ahead. Plus, Vishy Tirupattur of Morgan Stanley on his preference for U.S. assets at a time when so many people are saying, sell America. This is Bloomberg Surveillance.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The more everything changes, the more everything stays the same. Still budget negotiations down in Washington, D.C. Still a question around what kind of trade deals are going to get done. And still a question around the economic data. What does it mean? What we can see is what it means in markets is a pretty sanguine backdrop, pretty somnolent this morning, flat pretty much on equities. And what you're seeing is a little bit of a rally in bonds, but that too is fading as the day goes on. You're seeing something counterintuitive in the currency space also. Little bit of dollar strength, although that comes after a massive dollar weakening throughout the year, down more than 8% for the DXY, the dollar index, as people look to the questions of what U.S. policies mean for both growth and the fiscal overhang. Counting down to the opening bell, this is what we are watching. 10 a.m. we get durable goods and JOLTS, plus Fed speak from Goolsbee, Cook, and Logan Wednesday, ADP employment data and ISM services on Thursday, the trade balance, and another round of jobless claims. Watch the continuing claims in particular, plus German Chancellor Merz meeting Trump at the White House. And on Friday, the big one, or it should be the big one, which is May payrolls. And I say that because so often it seems to not actually matter at these kinds of what does the data mean moment. Turning back to markets, Vishy Tirupattur of Morgan Stanley writing this. Despite unprecedented policy uncertainty, the global economy is still in expansion mode. We believe that U.S. assets will remain compelling versus the rest of the world. Vishy joins us now for more and to tell us why cricket is the best sport out there, which we can get to in just a minute. But Vishy, I want to start with this idea that Morgan Stanley's put out there. Thought it was a fascinating argument over the weekend. Essentially, buy everything about the United States. Buy bonds, buy stocks, just don't buy the dollar. How do you do that?
So what we are saying is that the investing is really about relative value and what's in the price and what's expectations going forward. I think we can make a pretty good case for each of these markets, the bond market, for the equities market, and for the credit markets, that the better opportunity is in the US versus rest of the world. At the same time, the strength of the dollar that has been a big thing for many years now, for well over a decade. We've had yield differential and growth differential and policy certainty, at least less uncertainty about policy. All of those things are no longer that compelling. So we expect the dollar weakness to persist for some time. So if you're a US investor, US dollar investor, great. If you are a non-US investor, the US opportunity is still the better opportunity, but hedge your currency. For years, putting money in dollars, putting money in US assets, and not hedging actually was pretty good, worked out pretty well. If you put money in during good times in US equities, as if markets start to deteriorate, allocate to treasuries, but don't hedge currency, it was a pretty good strategy by and large in the aggregate. So that not hedging for non-US dollar investors we think will be a problem. So what we are recommending is people hedge the currency exposure, but still we have the largest market. We have if you take the US Treasury market, US Treasury market is 10 times the size of the European government bond markets, say all AA plus European government bond market, you add them together, US Treasury market is 10 times the size. Yep. US stock market is 5 times the size of the European stock market. US credit markets, investment grade markets, 4.5 times.
I'm laughing because everyone around the table is like, well, so go ahead, Damien.
Vishy, you're the chief fixed income strategist for Morgan Stanley, and I love it when rate strategists start talking about currency risk premia, and that's exactly what we're doing right here. And look, I know I'm sitting in the chair right now, but my day job is I run emerging market fixed income research for Bloomberg Intelligence. EM local government debt up 9% year to date. Best performing asset class in global fixed income. What are your thoughts on it?
We are pretty constructive on EM, actually. Actually, EM local currency as opposed to EM hard currency. We like your EM local currency. EM is, as you know, EM is not one blob. There are very idiosyncratic stories across the board, but across I think broadly speaking, we are pretty constructive on EM fixed income in general.
Hold on here.